All right, good morning, Wednesday, March 31st, 2021. Welcome to Yahoo Finance Live. I'm Miles Upton, joined as always by Julie Hyman and Brian Sazi. Final day of the first quarter. Futures pointing to a mixed open. We see tech in a leadership position once again this morning. Nasdaq futures up about 0.6%. Dow futures slightly in the red as, again, we wrap up this eventful first quarter of 2021. Well, the president wants to fix America's roads and bridges, but how much will it all cost? We'll break down exactly what is in Biden's landmark infrastructure plan coming up in just a bit. And shares of Chewy surging this morning. The company reporting a surprise profit. Stock here up some 15% in pre-market trading. The CEO will join us this hour to discuss the company's latest quarter. But let's begin this morning with our top two stories, both on the U.S. economy. President Biden set to release his long-awaited $2 trillion infrastructure bill this afternoon, and ADP coming out with some private payroll data just a few moments ago, coming in a bit light of estimates ahead of Friday's U.S. government jobs report. We've got full team coverage this morning. Yahoo Finance's Jessica Smith and Emily McCormick join us. Jess, let's begin with what we expect to hear from the president this afternoon, sometime in the 4 o'clock hour, rolling out exactly the contents of this infrastructure package.
Yeah, Miles, and this is the first of two long-term economic recovery plans that the Biden administration is going to release in the coming weeks. The first will be today, later this afternoon, and it's going to be focused on infrastructure. This is a $2 trillion plan. That spending will be spread out over the course of 8 years, and there are tax hikes and tax changes to pay for it over the course of 15 years. So what exactly is in this plan? More than $600 billion in transportation infrastructure. So that will include highways, roads, bridges, public transit, rail, a big investment in the electric vehicle space, including rebates and tax incentives for people to buy electric vehicles, grant programs to start building electric chargers all around the country. The plan also calls for $300 billion to fix and modernize the nation's water systems, broadband access, and the electric grid with a focus on clean energy. It also has hundreds of billions of dollars for things including affordable housing, workforce development, research and development, and measures aimed at securing the U.S. supply chain and boosting U.S. manufacturing. Now, of course, the big question here is how do you pay for it? And the Biden administration wants to see a corporate tax hike to 28%. That's up from 21%. They also want a global minimum tax for U.S. multinational corporations to 21%. It also has measures to prevent companies from using tax havens or offshoring jobs. It ends tax breaks for fossil fuel companies, and it ramps up IRS enforcement of corporations. Now, Republicans, of course, are not going to be happy about these tax hikes. We have heard them really sound the alarm in the past few weeks. We also have heard from the Business Roundtable, made up of some of the CEOs of the nation's biggest companies, saying that there should be a bipartisan infrastructure plan, but they're going to oppose those corporate tax hikes. And then we've heard from progressives like Congresswoman Alexandria Ocasio-Cortez, who says this is not big enough. Now, on a call with reporters, a senior administration official would not say whether or not they're going to try to push this through reconciliation to do this without any Republican votes, but it's looking like that might have to be the option. The senior administration official did say that President Biden is open to other ideas and ways to pay for things potentially, but he is not compromising on the urgency of the moment. The administration has made it clear that $1.9 trillion plan was a rescue plan, and now this is focused on recovery and creating long-term jobs for America. Now we'll send it over to Emily McCormick, who has details on today's ADP numbers.
Thanks, Jess. And that's right. We did get a report this morning from ADP showing that U.S. private employers added back more than 500,000 jobs in March for the best gain since September. Now, specifically, private payrolls grew by 517,000, according to ADP. Now, this was slightly below estimates, with consensus economists looking for private payrolls to rise by 550,000 for the month. But we should note that this did still accelerate from the upwardly revised gain of 176,000 private private payrolls in February. Now, taking a look by sector for March, we did see that the services sector again handily led the way in recovering jobs, with those payrolls climbing by more than 400,000. Now, some of the most badly beaten down industries saw the biggest gains last month in hiring. We saw that leisure and hospitality payrolls rose by 169,000. So those easier restrictions around indoor dining likely playing a big role there. And we also saw trade, transportation, and utilities jobs rise by a notable 92,000. I also want to highlight that the goods producing sector posted a net private payroll gain in March, with these increasing by 80,000 as some of those weather-related impacts we saw in February dwindling and allowing hiring to pick back up. We saw the construction and manufacturing jobs rose by 32,000 and 49,000 respectively, although we did see a small decrease in the number of payrolls in mining jobs. Now, as usual, this report comes 2 days before the Labor Department's official monthly jobs report for March. That release is expected to show that non-farm payrolls grew by about 650,000. That would be also the most in 5 months and include more than 600,000 private payroll gains as well. But as many economists have noted, we're likely to see even more job gains in the months ahead as more vaccinations take place, restrictions continue to roll back, and that stimulus continues to help support the recovery. Back to you, Miles.
Yeah, it looks like March likely to be the final month that we see. We don't see seven figures on that jobs number. Most economists looking for millions of jobs added back per month as we get into the summer months here in the U.S. Well, let's turn our attention from the economy back to what's happening in the corporate world. Still have some earnings rolling out, focused on the retail sector. Brian Sazzi, let's start with what we're seeing over at Lululemon. Stock is off just a hair this morning following their results. It's been an interesting couple of years for Lulu. Obviously, they were such a big winner, 17, 18, really into 19, a pre-pandemic winner, let's say. And they've certainly benefited from some athleisure trends. They've benefited from the broader market. But the stock now over the last couple of quarters kind of done nothing. It is off its highs, and I think an interesting kind of question mark here for investors about what the next leg of growth for Lulu, which is, again, a brand and a story that has certainly solidified its place, among those kind of elite millennial brands. But where does the stock go from here is the real question.
Well, the stock's so far today, Miles, under pressure, down about 2% in the pre-market. And I would say this, I would call it profit taking, is very much deserved, just coming off of the Lululemon earnings call last night. A couple of red flags worth highlighting here. They noted their product margins, how much margin they make on each product they sell, hence product margins. Product margins down 60 basis points in the quarter, not what you would be normally seeing from a Lululemon. Some concern out there, just in getting the pulse of Wall Street this morning, the analysts that cover the stock, some concern on whether Lululemon's product margins have peaked, which is, worth asking. I just paid $130 for a pair of Lululemon pants. They're great, but how much further can you charge for stretchy pants that you're going to wear probably 4 or 5 hours during the day when you go back to the office? Nonetheless, some concerns about product margins. Also, too, SG&A. I think the investment that Lululemon is spending right now in Mira, that is that connected digital fitness product they spent $500 million on last year. How much they plan to invest this year really caught Wall Street analysts by surprise. There's a big time investment spending to take that brand to the next level in terms of marketing, in terms of opening new studios inside of Lululemon stores. And I think that is weighing on the earnings outlook for Lululemon for the full year this year, which came in below estimates, Julia, Miles.
Yeah, it did come in below estimates, but the revenue forecast came in above estimates. And it's interesting, the investments they're making in Mirror, the company is saying that they're going to pay off, for the full year, because they're looking for a big boost to revenue from Mirror, specifically to $275 million from $170 million for the full year in 2020. So that would be a pretty big boost there. What's also standing out to me about Lululemon is, this is a company that already had a strong direct-to-consumer e-commerce business, and that is still strong. It's still seeing big growth of 94% in the last quarter. At the same time, though, it's still planning to open stores at a decent clip, 40 to 50 locations this fiscal year, 15 to 20 of them going to be in China, which has been a strong growth driver for the company. And it saw, I believe, 45% sales growth in China during this past quarter. So that's a part of the story as well, that international growth by opening those stores.
And Julia and Miles, there is some concern I would also add too. So they have a lot on their plate right now. This management team has a lot on their plate, opening new stores, like you just mentioned, around the world, picked up pace of investments in Mira. And also, they dropped this on the earnings call last night. You're going to see Lululemon launch their first ever footwear line in early 2022. Trying to introduce footwear is a large task for any brand, but especially for a brand that is growing at this pace and has a lot of other things going on. I'm not saying they won't be successful. I'm very curious on what type of sneakers they do come out with and the price points, but it's going to be a big launch, and it could be a potential big distraction for the company.
You know, on the footwear side, Saz, I'm almost interested why they're not just, maybe they will, but why they're not just buying APL. I mean, that's the footwear brand that had been in Lulu's. And I think what's also interesting, if you just kind of go out on the street and see what people are wearing, feels like a little bit of that aesthetic, that APL aesthetic has kind of come off during COVID. It was a nice complement to sort of the normal clothes, if you want to call it that we were wearing in 18-19. But now everyone defaults into, Stan Smiths and Air Force Ones. And, I think it's just a very changing landscape. And Sazi, as you know, nothing is more fickle than footwear trends. So certainly it will be a new challenge for Lulu to take on if they want to indeed go ahead and do that themselves. All right, let's talk a little bit about shares of BlackBerry. Stock is under some pressure this morning following that company's latest quarterly report, talking a bit on the call about the chip shortage, some of how they're seeing their QNX business. That's the car focused business that has had a nice improvement here, coming in, as you see, a little bit light of top line estimates. But really, Julie, it's hard for me to worry too much about the fundamental BlackBerry business. I mean, obviously, the people who work there, and there is a business indeed, but it's a stock story, and the stock went to 25 or whatever it was during the whole GameStop situation. It had been in the low single digits back in March of 2020. It had actually done quite well over the last several years before it got caught up in the whole Wall Street bets phenomenon. And it's been an under the radar stock story over time, coming out, a little air coming out of it today, but I think continues to be an interesting plaything for traders, and also a business that kind of chugs along underneath the surface.
Right, and one that perhaps, was a little more fundamentally sound and quite different from a GameStop story, even though it got attention related to that. To your point, it's done well over the past couple of years. One other thing to point out about the quarter, executives apparently talked about the lowered revenues. As you mentioned, it missed estimates and fell by 26%, the revenue, to limited patent licensing. Also said the company is trying to sell some patents to an unnamed North American party. BlackBerry's already done a decent amount of selling of patents, so we'll see what more it can wring out of its patent portfolio. Apparently, these particular ones, according to John Chen, the CEO, are related to mobile device messaging and wireless networking. So we'll see if there's any further news on that front, but that kind of promise is not helping the stock today.
They can sell their patents to GameStop or
sure.
similar Wall Street bets. No, they'll probably sell to a real company involved in something actually related to that. But at this point, why not just get it together? I think Bed Bath was also involved in that trade. They can all come together and try to figure out a business as meme stocks in this market. All right, a lot more coming up on the other side of this break. We're going to talk to Chewy CEO Sumit Singh about the company's latest quarter. We're back with that discussion coming up right after this break.
There must have been a lot of happy puppies and kitties this past holiday season. Judging by the quarter out of Chewy, shares are surging 15% this morning after the company posted a surprise profit as pet parents continued to order food, vitamins, and toys online during the pandemic. Also worth noting here, Chewy is the #1 most visited ticker page right now on Yahoo Finance. Joining us now is Chewy CEO Sumit Singh. Sumit, always good to see you here. During the quarter, you added 1.4 million new active customers. That's good. Sales up 51%. How confident are you that you can keep this rolling in 2021?
Hey, Brian. Hi, team. Good to be here. Brian, we believe that we can sustain this momentum on the back of tremendous market opportunity and on the back of our ability to win customer hearts and minds and execute behind that market opportunity. Let me elaborate a bit. So when you look at a couple of key trends that are supporting the tailwind into the pet category, they're secular and they seem to be sustainable. One is the increase of pets per household, which grew 5.7% in 2020, bucking the 5-year CAGR of 0.6%. So that's a lot more pets in households. On top of that, when you look at our internal data, we shared yesterday on the call that we saw a 35% increase in new puppies and kittens, profiles created for puppies and kittens, and a 40% increase in profiles created for adopted pets. And that's great because that Chewy puppy, as I've said, is going to grow up, eat more food, shred more toys, require more healthcare. So these should be tailwinds for recurring revenue streams in the future. Number two is the market's actually really large and growing. Like the market this year, the pet market reached $100 billion this year. We used to talk about it being 85 billion 3 or 4 years ago, and it's expected to be 120 billion, 3 or 4 years from now. And we currently play in roughly 70 billion of that, which gives us a lot of headroom to grow into the marketplace. And then last but not least, the channel shift that's happening towards e-commerce, in our opinion, is largely durable and here to stay. And when you look at our years of investment, preparation, people, process, capability, infrastructure, experience, we feel good about our ability to participate and to continue to win hearts and minds. So we think this is durable.
So my former dog owner ears perked up on the call last night when you talked about a wet pet food can shortage. What is going on there? Are you seeing out of stocks, and when will that end?
Yeah, so what's happening is, wet food is a really popular category within pet food. And it makes up roughly 20-30% of the overall category. And what's happening is that it's a bit of a high quality problem to have, actually. Manufacturers, there's concentrated manufacturing, 3 or 4 manufacturers that sort of produce wet canned food in the United States. And they were running high utilization levels anyway, given the secular trends in pet. But then the pandemic arrived and the demand just overshot the supply availability or the capacity constraints. And so as a result, you have an imbalance, and therefore you have a bit of a shortage. The shortage is at the industry-wide level. So players like us are seeing isolated out of stocks in our supply chain. And we're working very closely with these manufacturers and our suppliers and vendors to be able to course correct. It's going to take a few months before new capacity comes online. But ultimately, there should be new capacity released into the marketplace, and situation should go back to normal. We're hyper vigilant on this right now, and we've shared that so far we are not seeing material loss of demand or momentum as a result of the issue.
Sumit, it's Julie here. What about effect on costs from something like that? Are you seeing upward pricing pressure on your input costs? Not just from that, but I'm curious more broadly as well, given some of the other costs that we've seen going up in the economy. I mean, obviously you guys were able to make a profit this quarter, so it didn't push it down into the negative, but what are you expecting for margins for the remainder of the year?
Yeah, sure. It's a great question. So, let's talk about 2 types of inflation. One is the inflation, the price increases that consumers might be facing right now. And that's actually not that prices have risen. What's going on is there's less discounting and less promotional offers out there as a result of general shortage of inventory in the marketplace. If you look at retail broadly, just not pet, just retail broadly, to address the question, the inventory to sales ratio right now is running roughly around 1.2. And that's a 12-year low because typically these ratios were running at 1.5, 1.6. So, in general, there's about 30% less inventory available in the marketplace, given everything that we're going through. And what that does is it keeps your prices generally higher and stable. And so, we're seeing that in the marketplace, and that generally helps your margin in the short term because you don't discount as often or as frequently or as much. Then on the other side, there's input costs that you talked about. And while there's certainly a possibility for that, so far, I think the situation is evolving and we're just observing. So we haven't seen an impact of inflation come into costs. Right now, customers are facing that out in the marketplace, and generally there's a stable environment that actually helped us as well. We, notated 150 basis points of our gross margin, improvement in the quarter came as a result of that.
So, it's Miles here. It's interesting as I go through, the quarter here. I'm just wondering if you kind of see the business taking on a new trajectory post-COVID. Certainly, you've had kind of a boom in pet acquisition, as you outlined, pulled into the last year for reasons that we probably wish hadn't happened, but it's been a benefit to your business. And I'm curious how you think about accelerating free cash flow growth, what you might do in terms of acquisitions and things like that. As again, a lot of growth you may have expected over the next 5 or 10 years really came into 2020.
It's a great question. What 2020 has shown us is the dynamics of the market and our performance. It's provided us a look into the future, and that advanced view is we're optimistic about where we're headed from here. We believe that our pace of innovation and innovating on behalf of customers to bring new products, new assortment. By products, I mean solutions, by assortment, and then perhaps even services to life should accelerate on the back of what we've seen and the technological trends shifting. For example, we've always had telehealth on our roadmap, but it was 3 years out. But the pandemic forced us all into our households and provided this boom to this sort of setting that we're interacting with today over video. And as a result, that's being felt all across the industry. And we said, look, there's an opportunity to connect service providers and customers. In this case, we're talking about veterinarians and customers, and bring them together to help offer a viable solution. And we did with the launch of our teletriage, teleconnect platform called Connect with a Vet. I think you should expect us to think boldly and broadly across, tech, product, assortments, such as we don't really play in temperature controlled supply chain today as much as we would like to. And, something like fresh, something like frozen might be, really interesting because customers have had the opportunity to stay at home, engage more, and categories like these that were slowly building have actually received a tailwind or an acceleration through the pandemic. So we're broadly focused on improving the experience that we can provide to customers across a broad array of business value kind of levers. The trick here is going to be to not get distracted, right? Not take on priorities on top of the team, on top of the priorities that the team's already focused on. And if we do, then appropriately, rank stack them on impact and experience to customers.
That's really interesting. All of the fact that you guys are thinking about so many different possibilities for growing the business. Speaking of distractions, we have made a little bit of a montage of some of our distractions at home, our pets here on the team. We got inspired knowing that you were coming on here today. So let's end with a fun one, if we could, Sumeet. Why don't you tell us maybe some of the top holiday gifts that people were buying for their pets during this season? What were some of the big things on the platform?
Sure. So, last time I was here, I think I was talking about retro toys, the boom boxes and the CD players that were really flying off the shelf. This holiday season was all about our customized goodie boxes that we curated, for customers. We introduced one for cats, the cat pet parents this time, and there really wasn't one that existed in the marketplace, and that was tremendously popular, with our customers. Cute apparel was really popular, and then with our recent launch with Disney, we've brought a customer-centric, company and kind of partnered with them to bring an exclusive line of their franchises to marketplace. And Baby Yoda and Groot and all of the characters that come along with the franchise. They're really popular right now.
Yahoo Finance team never ceases to amaze me. We'll leave it there for right now. Chewy CEO Sumeet Singh, always good to see you. Good quarter. We'll talk to you soon.
Thank you. Awesome. Thank you.
All right, coming up, we'll go from talking about our lovable pets to talking volatile stock market. Stay tuned.
This is Yahoo Finance Live. I'm Julie Hyman. We are watching the futures here just a couple minutes until the opening of trading. And we want to bring in to talk more about the setup today and for the remainder of the year, Lisa Erickson, Senior Vice President and Head of the Traditional Investment Group at U.S. Bank Wealth Management. Lisa, thanks for being here. You know, we talked to a lot of investors who say they like large caps right now or say they like small caps right now. You like mid caps, and which is something that we don't hear quite as often. So I'd actually like to start there. Why it is that you are looking specifically at mid caps right now?
Well, good morning, Julie, and thank you for the question on mid caps. We really do see that as an area of interest right now, and for a couple of reasons. One is our outlook is generally glass half full. And so with economic recovery continuing to apace and abound, really mid caps have a unique opportunity to take advantage of that. And the reason why is if you look at its sector composition, it really is more balanced between both growthier types of names as well as more economically sensitive names. And yet, on the other hand, the reason we actually prefer something like mid caps as opposed to small caps is because if you look at the quality of that sector, it's a little bit higher. And we also see very balanced price momentum between the value names in the mid-cap area as well as the growth names. So all of those are reasons for our interest.
There, the opening bell on Wall Street, a lot of balloons coming down the heads of executives at Coursera. Should be worth noting that Coursera's CEO will be on Yahoo Finance Live today at 12:20. Lisa, what do you I want to look more short-term in nature here. What are you hearing from clients about their desire to put capital to work in the first week of April? As you know, April is usually a strong month for the markets.
Well, absolutely, Brian. We're encouraging our clients to continue to put cash to work. And while certainly there's some nervousness over everything that's happened over the last year in terms of the ups and downs and the volatility in the market, we see clients being increasingly willing to do that. And again, it's really on the pace of what's going on both in the economy as well as with the vaccinations. Again, as we see that opportunity for reaching herd immunity and being able to reopen more broadly, that I think is encouraging us and certainly our clients to continue to move back into the market.
And Lisa, what about the rate story? Ahead of that Fed meeting a couple of weeks ago, all we talked about in this program all day, every day, I'm sure it was kind of the same in client meetings too, is what's happening with rates, what's happening, with overall growth. It's cooled off a little bit, normalized a bit. How are you guys kind of seeing that story today?
Miles, I appreciate the question about rates because it is certainly a factor that we're monitoring. And while on the one hand, rising rates are a positive in that they show that both the bond market and the equity market are positive about the prospects for growth, if rates rise too quickly and in a disorderly fashion, that could throw off the stock market. And simply because then you've just got higher interest rates that are competing with the potential returns of the stock. So it is something we're monitoring right now. Again, our overall view is still glass half full, but it is an important aspect we want to monitor.
Lisa, I have a two-part question that has to do with the big infrastructure plan that is set to be announced this afternoon by President Biden. On the one hand, of course, there's a lot of spending that is planned in that bill. A lot of the stocks that might be affected have run up already. So I'm curious, first of all, if you are making any investments tied to that. But second of all, of course, as also part of this, there's a 28% corporate tax rate that has been proposed. And I'm wondering if you are hearing from your clients that they're concerned about that effect on corporate profits.
In general, our focus really on the infrastructure side has been just the general potential impact on the economy. It is something that we're currently monitoring because while certainly more details will come out today, nothing is set in stone yet, and there's going to be a road to potential passage. So it's something that we do feel is an important part of the policy mix, but we don't want to act on it quite yet. As far as the how do we pay for it part of it, as you're noting, part of that proposal is the tax increases. And so we have heard a number of clients, certainly as I think all Americans are looking at taxes and how that might impact, their particular financial situation. They are concerned about it. Again, I think, we just need to monitor and see how that will evolve. Nothing's set in stone yet. And so we'll continue to look at the path forward.
We don't know if it'll end up at 28%, certainly. Lisa, thank you so much for being here. Lisa Erickson is Senior Vice President and Head of the Traditional Investment Group at U.S. Bank Wealth management. Thank you. Appreciate it. All right, let's get into what exactly is moving here in the markets. The Nasdaq leading the way upward today, up about 2/3%. Our Jared Blickery is back with us with some details on the opening trades. Jared.
That's right. We got tech in the forefront right now. Let's take a look at the Wi-Fi Interactive, where we see a lot of green in America. We got the Russell 2000 up the most, 83 basis points, Nasdaq a little bit less, S&P 500 up 1/3%, and the Dow up 1/4%. That's good enough for 75 points. Looking inside the market, now we still have tech up about 85 basis points, is the best performing sector. And guess what? Apple is up over 1%. So is Tesla, PayPal, and NVIDIA. The other mega caps each up less than 1%. We sort by performance. We can see Walgreens. This is a stock that's been on a tear this year. One of the better performers in the NASDAQ 100. That is in the leader position. Also Applied Materials and Illumina. Those are some of the big leaders there. Lululemon, which we were talking about with Brian Sozzi, after earnings down about 4%. Pinduoduo checking in the #2 spot there. Let's take a look at the sector action. Tech still in the forefront, followed by healthcare. Those are the only two outperforming sectors. So really powering the market higher here. Real estate is the biggest laggard. That's down about 58 basis points. And maybe worth checking in here if we have, here we go. This is a year-to-date look at the sectors. And so this is also quarter-to-date and meaningful because this is the end of the quarter. Check out energy. Now that is up 30%, followed by financials up about 16.5%. Then we got industrials up over 10%. Those are the big leaders. So the value and cyclical trade really playing out here. Let's also take a look at the EV space. Tesla up over 1%. And we're seeing this. We're going to get back to the intraday price action there. There we go. Apple up 1%, NIO up 2%, and Lee Motors is up about 3%, guys.
You know, Jared, I was out last couple of days, so I learned that you were also out the last couple of days. So we've missed all the fun with Archegos and everything that's happening there. Obviously, a lot of run up in some of those names. I'm just curious, kind of what the picture is there, and how the market like calms down after a name the size of Viacom, a business that is that formidable, that household of a name, quintuples or whatever it was, gets cut in half. Like, how does the market maybe level set here and try to more orderly move through this period?
Well, aside from a few individual names like Viacom and maybe there was some price action in Bitcoin, it seems I was just reading that they had a levered bet on Bitcoin, which didn't go very well either. These are idiosyncratic risks. I don't think we're going to see another long-term capital management that requires a New York Fed-led bailout here. And you look at the GameStop maelstrom, that was pretty much contained. The firm needed more capital. Melvin Capital Management had to go to some other people and raise a few $1 billion. Well, that happened. So did Robinhood. So I think the markets are pretty well prepared to handle these events. But unfortunately, due to the lower liquidity, we just see some of these names get hammered. I mean, Credit Suisse, for instance, has a lot of exposure. We can see this stock's down about 3%. Let's take a look at the month to date here, because it is month end, down 27%. So these big banks, they have exposure, but is it going to be 2007, 8, 9? I don't see that happening.
Although for the likes of Nomura, it looks even more dire, but it doesn't trade very much in U.S. trading. So we'll have to keep an eye on that in Japanese trading. Miles mentioned both you and Jared were off over the past few days. Both of you moved, so congratulations to both of you. All right, we're going to take a quick break. When we come back, we will be speaking about infrastructure. We'll be talking about setting new climate goals. We'll be talking about the business at Johnson Controls with the CEO, George Oliver.
Johnson Controls said today the Science-Based Targets Initiative has approved its emissions reductions targets. The industrial giant aims to slash operational emissions by 55% and reduce emissions among customers by 16% in absolute terms for 2030. Joining us for a Yahoo Finance exclusive is Johnson Controls Chairman and CEO George Oliver. George, good to see you again. It's been some time. Good to see you here. So why, we've seen a lot of big companies like yours come out of late and put out some very aggressive longer-term sustainability goals. From its business standpoint, how do these announcements impact your business?
Yeah, Brian, good morning, everyone. It's great to be back. Let me start by saying what we do in Johnson Controls. We're a leader in buildings and infrastructure. And in sustainability, reducing energy consumption has been core to what we do. And we've been leading this over the last couple of decades. Certainly now with the forces that are underway around decarbonization. What I would say is they are approaching an inflection point. And a lot of that is driven by investors, where now they're looking at it being more important criteria. It's also being driven by our customers. Our customers, no different than the commitments that we've made around reducing our carbon emissions and getting to net zero carbon emissions. They're doing the same. So we have an incredible opportunity to bring our technology and capabilities to work with them to reduce their carbon footprint. And then, when you look at federal policies and even some of the stimulus that's been put forth to date and now with potential infrastructure, an opportunity to be able to take what we do, upgrade buildings and get a payback because the buildings are now more energy efficient and productive. And then I would say is that there's tremendous innovation that's taken place, and not only within our company, but across multiple companies that truly now is enabling our ability to be able to achieve these goals.
George, it's Julie here. You mentioned the infrastructure proposal that's set to come out this afternoon from the administration. And as you said, certainly climate initiatives are going to be a part of that. From what you've seen, are they ambitious enough, especially since, if we're being frank here, you got to make up for 4 years where not much progress was made on that front?
What I would say is, as part of the Business Roundtable, we've always sized it to about a trillion and a half needed to upgrade the infrastructure. And I think our view within the space we're in buildings and infrastructure, there's a real opportunity to be able to not only upgrade, but get decent payback with those upgrades. You can imagine with the stimulus that's been provided to date, there's roughly been about $250 billion that have been put into buildings. And it's an opportunity to not only elevate the health and safety of buildings or the well-being of the occupants of buildings, but at the same time, being able to reduce the energy consumed to be able to operate the building. And that is what's unique with Johnson Controls, our ability to be able to play in that space. When you look at some of the local law in New York City, where local law 97, upgrading buildings to a new standard by 2030, that in itself created about a $20 billion market for us. And as we then expand this, as well as take into account the infrastructure bill, there's a lot of opportunity for us to be able to take the technologies that we develop in our products, combined with the digital technologies that enable us to be able to create smart buildings that focus on healthy occupants, healthy places, as well as a healthy planet. And so I think there's going to be a lot of resources here put to work that we believe can not only create efficiency within the buildings, but make it much more sustainable.
And George, thinking about the future of buildings, when the pandemic began, I remember in the summer talking about the need for new HEPA filtration and all the ways buildings could be safer. But we're sitting here in April, or almost April 2021, and buildings aren't really being used. You go to New York City and office buildings are mostly empty. What are conversations you having with folks about how these buildings are just going to be utilized in the future, and what new construction is going to want to be, need to be, and just the reorientation, I guess, we've had of physical space during the pandemic?
Let me start by saying when the pandemic started, it was incredible how companies operated remotely to be able to continue their operations and do what they did to continue to operate their companies. But what we've learned over the last year, not only internally within Johnson Controls, but also as we work very closely with the customers that we support, that although things are going to change, there is a need to come back to the office, that there's a social interaction that is critical to building a culture within a company. It's critical to driving innovation. It's critical to leadership development. And I think based on what we understand today and working very closely with our customers, that ultimately they are going to come back to buildings, and they're beginning to do so as we speak. And so I think based on what I see today, although there's going to be a temporary shift here, which we've seen here over the last 12 months, I think it's going to create new opportunity going forward, not only to reconfigure the existing buildings, but on new buildings being built, they're going to be much more sustainable and healthier and safer, given how they're going to be built with the technologies that we're bringing into the market. So I don't believe that that's going to significantly change the profile. And what I see going forward is a tremendous opportunity for us.
And George, also potentially an opportunity for you is to cut down your costs. And I know that's something that you guys have been focusing on. At the same time, also as part, of course, of that infrastructure plan is a proposal to raise the corporate tax rate to 28%. I believe you guys are domiciled in Ireland, if I'm not mistaken. So what would that hit be to you guys if indeed that were to go through, or is it mitigated because of that, of the Irish domicile?
Yeah, I think it's important to stay focused on the infrastructure bill. And when you look at, number one, it's going to have to be paid for. And at the end of the day, we got to make sure that whether it be through use or through other opportunities to be able to raise, that ultimately has to be paid for. And I think what we do in buildings, what we do in infrastructure, as we're working to take our technologies and capabilities, we can ultimately create an economic return. So we can not only upgrade the infrastructure, make it greener, make it more renewable, but at the end of the day, be able to create a return with the savings that are generated. When we deploy not only our products, but our digital capabilities, create a smart building, we can reduce the operational cost of a building 30, 40, 50%. And so what we see is an opportunity to be able to truly be able to work constructively with all of the constituents we work with to really make the case that you can do both, not only upgrade the infrastructure, but from an economic standpoint, actually generate decent returns.
All right, we'll leave it there. Johnson Controls Chairman and CEO George Oliver, always good to speak with you. Stay safe. We'll talk to you soon.
It was great to be back. Thank you.
All right, on the other side of the break, we are live with Academy Sports CEO Ken Hicks. Fun fact here, shares of the sporting goods retailer have popped 107% since the company IPO'd back in October 2020. And we'll be right back.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. We see stocks higher here to begin the final trading day of the month and also the first quarter of 2021. Nasdaq leading the way higher. Seeing some earnings trickle in as we get set for first quarter earnings season to begin in earnest in a couple of weeks. Let's take a look at shares of Academy Sports, stock under a bit of pressure this morning, but as Brian Salzi mentioned before we went to break, has had a huge run over the last couple of quarters. Joining us now to discuss the company's latest results, Ken Hicks. He is Academy Sports and Outdoors Chairman, President, and CEO. Ken, thanks so much for joining the program this morning. You guys are coming off a record quarter, a record year. On the call, your CFO said that when the pandemic began about a year ago, you guys are looking for a hibernate year, hunker down, get rid of everything that's not bolted to the floor, basically. The year did not play out like that. As you reflect on how the business really evolved over the last couple of quarters, how different does it look today versus maybe even how you were thinking about it, June, July, and August as the summer, kind of started coming back?
It was interesting because we saw the consumer literally move through our store depending on where they were, from survival to safety to staying fit to sanity, and the activities that they picked up, the number of new people who are fishing and camping. We added over 5 million new customers last year, and we had what people want. We were performing well before the pandemic, but the pandemic really put us under a spotlight, and we're excited about the future because of all the new customers and all the people who have new hobbies and things that they're doing.
Ken, are you getting the product you need to sell? I mean, there's been a lot of stocks in outdoor equipment, and I would say only now weights and free weights and gym equipment are only now starting to come back into stores.
No, you're exactly right. There was a period we literally sold every dumbbell in our assortment, which normally turns about 2.5 times in about 10 days when the lockdowns first started. And we are now getting back in what I call an acceptable level of stock. There was a worldwide shortage of bicycles. There were a number of categories where we just had empty shelves. We now have product. We have a reasonable assortment. We're not at the presentation level we want. There are challenges in the supply chain with containers and port backups, truckers. But for the most part, we're in a good position inventory-wise. We anticipate by the end of our first quarter, we'll be with the exception of a couple of businesses, we'll be in a very, very reasonable, very acceptable position.
Ken, it's Julie here. You talked on your conference call, and you were talking just a moment ago about the different phases people are moving through. Team sports is something that people are moving back into, kids sports, for example. You talked about that licensing is not quite back yet. How much is yet to be sort of unlocked with the next phase of reopening and people coming back, and what's that going to mean for your business?
I think, what we'll see is things like licensed apparel as people start to go to sporting events and watch sporting events with friends or at a bar. Things like holidays. We didn't have a Mother's Day or Father's Day last year to speak of. Back to school. And as those things start back, we anticipate, that the consumers will continue to spend and buy our products. This spring, team sports, as you said, has really started back in earnest. The kids are playing baseball when last year they didn't. And so it will continue to evolve over the year, but I think it's like last year as they rolled through the store, we'll see a similar thing happen this year.
Can 40% of your stores are in fact in Texas? Where else are you going to grow this year? Are you going to enter any new markets?
Well, because of the pandemic, we weren't able to get out and find sites. So we're not opening stores this year, but next year we plan to open 8 to 10. We have some fill-in markets that are good markets for us, but we don't have the presence we like in our current marketplace. And then we'll look at adjoining markets to where we are to take advantage of our supply chain. But we are definitely in a growth mindset, and we have the capability and capacity to grow with only 259 stores. in 16 states. And with the .com business that grew over 130% last year, we anticipate good growth both in .com and in physical stores in our current markets and then beyond that.
All right, Ken Hicks, CEO at Academy Sports. Ken, appreciate the time this morning. Good to talk, and hopefully we'll be in touch in future quarters.
Thank you. Appreciate the time.
All right, off for a short break here on this Wednesday morning. Nasdaq up over 1% on this final trading day of the first quarter. Back for more on Yahoo Finance Live coming up right after this.
It is time for Brian Sozzi's Take, and face ripper is kind of a slang term that those on Wall Street use to refer to a big rally, catches you, takes you up by surprise, and it could be coming according to a new note that you're looking at.
Yeah, Julia, and I told our very own Sam Rowe I would use the term face ripper somewhere because it was mentioned in this note, so I am a man of my word. But the term face ripper is finding its way into the note today out of Fundstrat's Tom Lee, who was looking for a face-ripping rally to kick off April for the markets. And he listed some pretty good reasons here why. First of all, the first trading day of the month, the last trading day of the month, which we are coming up on, is usually pretty good. You know, it's where a lot of fund managers buy winning stocks, they dump losing stocks. It's what they call window dressing. Next up, he's also calling to attention the first trading day of the month, which usually works well, keyword there, usually works well as inflows come into stocks and people gear up for the month on hand. And then he also mentions good seasonal performance in April. And now this is a lot, I've also seen this mentioned this week too out of Bank of America, but April has historically been good for stocks. Just looking at the Dow, the average gain on the Dow going back to 2000, 2.5% gain versus a 0.4% gain for all the other 11 months. And then, you know, looking at some Bank of America data from Steven Stutmeyer, you know, it's the first 10 sessions of April have seen an average return of almost about 0.9% going back to 1928. That's the second best month just using that data compared to July. July clocking in at about a 1.5% gain. So again, a lot of seasonal factors could be in play here for potential face-ripping rally. We're seeing some green on the screen today. Perhaps that might be starting to play off. Nonetheless, these are the things Wall Street's talking about.
I love Tom. Love Tom. Guy's been righter than right for years. I'll be excited when he says something that isn't super bullish, because that's why Tom's been right. Everyone gets all worried about, when the stock's going to flatten out, blah, blah, blah. I mean, I remember talking to Tom 3-4 years ago, maybe 5 years ago, about a 20-25 year secular bull market coming out of what was really a secular bear from, the top in 2000 all the way through the financial crisis. Stocks went nowhere for, about a decade. And it wasn't until 2013 we made new highs that we began a new record run. So, Sazi, look, we're in the content generating business. Tom Lee says face ripper, we're going to talk about it, write it up. But when Tom gets cautious, then I'll worry about something happening here.
Hey, you read about face rippers. I'm going to write that up all day yesterday. Miles, you missed. Well, maybe you're watching on the Yahoo Finance app. We were talked about Allianz Bernstein, S&P 500 8,000 call within about 102 months. That story's on Yahoo Finance right now. S&P 500 8,000, maybe 8.5 years away.
All this bullishness. All right, we're going to take a quick break. When we come back, coming up in the next hour, we're going to talk to the lead analyst on a new ETF. It is the 8th biggest debut from a volume perspective of an ETF of all time. And of course, it's from ARK Invest. It's the space ETF. And we're going to talk to Sam Corris in the next hour. Stay with us. It is just after 10 a.m. on Wednesday, March 31st. This is Yahoo Finance Live. I'm Julie Hyman. Miles Udland is back. Brian Stassi still here. And stocks are trading higher on this Wednesday. The Dow just barely, but we've seen the Nasdaq pretty strong out of the gate, and it's just been climbing from there. It's up 1.4% right now as the S&P gains 0.5%. Delivering losses, Amazon-backed Deliveroo tanks in its London market debut. We're going to get a check on trading from the UK in just a few minutes. Growing profits, we'll speak to the CEO of Hydro Farm about the agricultural suppliers' growth with vertical farmers and cannabis cultivators. And to the moon, Kathy. Sorry. ARK Invest launches a new ETF dedicated to space. Its lead analyst will join us later on this hour. But first, let's talk about what we are seeing in terms of market action and some of the challenges with navigating this market. In our morning brief this morning, our editor, Sam Rowe, wrote about some challenges here in the market and in this rotation and sort of getting it right and timing it right, and the difficulties inherent in that. We've all been talking about this reopening trade as it's been going on, but it's trickier to get the timing of it right, especially as we see some sort of volatility on the way there. And Miles, even if you buy the premise that we're going to get a face-ripping rally or 8,000 on the S&P 500 in the next 10 years or 8 years or so, it matters how we get there, and it matters what you bet on the way there. And there were some interesting numbers that Sam cited in that morning brief in terms of who has benefited from this recent rally.
Yeah, and it's another way to dice up a prior morning brief we wrote, which was maybe 3-4 months ago. I think right when the let's call it the vaccine and election rally really got underway back in November, December, and it was stocks that had gone down the most were outperforming stocks that had gone down the least. This was my favorite one. Stocks that had the cheapest per share price were outperforming stocks that had more expensive per share price. Of course, the per share cost of a stock says nothing about the value of the business. It's just an arbitrary number. So I thought that was an interesting piece of data and something that Sam surfaced yesterday. And it comes to us from Charlie Bolello over at Compound Capital Advisors. He's looking at the best 25 performers in the S&P this year and the best 25 performers in the S&P 500 last year. On average, the best 25 performers from 2020 are down 3% so far this year. So down through the first month and first quarter now, or first 3 months and first quarter now of 2021. And the bottom 25 performers last year are up on average 32% this year. Now, you look at the names in these groups, not a huge surprise. Tesla at the top of last year's outperformers. It's down about 12% last year. Don't cry for Tesla shareholders. It was up 743% in 2020. Look at Carnival. Stock was down 57% last year, and now it's up 20% so far this year. Obviously, a 20% gain after a 57% decline last year is not only not making up, it's hardly making a dent, really, we should say, in your losses there. And needless to say, you need to go up more than 57% to recover all of those losses. But it continues to point to how we see the rotation work within the market. And we can call it a move to value over a move to growth. But I continue to think of this framework of it's a rotation to things that didn't work, into things that didn't work and away from things that did. And you can slice and dice that by style, by sector, by valuation, however you want to do it. But it does not take a CFA to look at this list and say travel stocks and energy stocks got clobbered when there was a global pandemic, and those stocks are acting better. And then pretty much anything that was derivative of how you stay at home, how you entertain yourself, how you keep your own power on, how you work from home in a pandemic, that stuff has done a little bit less good as we move into year two here. So obviously exceptions, shades of gray, but I feel like those frames are still relevant. And I think another one, which I'm probably going to write about for tomorrow, is this idea of what is good for America might not be great for financial markets. I think we should all welcome a year where financial markets are more challenged because the growth that was priced in last year is realized, and then investors say, now what? So I think all these themes have worked their way through the market to some extent, to a large extent maybe, in the last few months, but it's not clear to me that this trend is necessarily over because it's still kind of underappreciated, Saz. We're still talking about funds being overweight, all the names that we know and love, all the banks, all the tech plays, and people aren't really rushing into the energy plays and the airlines just yet.
Yeah, Miles, I would say too, maybe we do, Julie just talked about, maybe we do see that face ripping rally, under the premise that As economic data improves, and we had the ADP report out this morning, that was pretty good, likely to see maybe a 700,000 increase on the headline non-farm payrolls on Friday. But as this data improves, all these stocks should do well.
By the way, here's a data point that didn't improve. U.S. February pending home sales were down 10.6% month over month. The estimate was for a drop of 3%. So that's interesting there, and goes hand in hand with some of the other sort of pause indicating data we've gotten on the housing market. You're smiling, Miles, as you sit in your new home.
Way to rain on the party, Julie. Way to rain on the party.
Sorry, I gave you away.
I would just say that is another example, though, of everything that worked in 2020, which was, single family residential homes, maybe not working quite as well. We've all seen the charts of inventory. I mean, you can't buy a house. There are no homes for sale, basically, in most of the major metros. And so, again, I think part of the same theme, if maybe sliced a different way.
Interesting stuff. All right. Well, let's talk about this with Kristen Bitterly. She's Citi Private Bank Regional Head of Investments for North America. Kristen, it's good to see you again. I do want to talk about some of these themes in the sense of where you go right now, right? In addition to what Miles was just talking about, if you look at year to date and therefore quarter to date, because we're on the last day of the quarter, energy is the best performing sector. Is that something you're in? Is that something you stick with? What are you thinking here?
Yeah, the March action is really interesting. One of the indices that we follow at Citi is basically an index that breaks down the U.S. equities, and it ranks them in terms of their exposure to value as a factor. And so it's long, the top 50%, short, the bottom 50. So you could say it's basically a proxy for value over growth. And that has had its largest outperformance. So its best performance since the second quarter of 2009. So this price action that we're seeing, I think there's a couple of things that are going on. So one is what we call the mean reversion trade. So this is obviously the whole COVID, what we call COVID defensives, COVID cyclicals, what all of you were just talking about. What worked last year is not necessarily working this year. That kind of catch-up trade, that as we can see on the horizon, an opening of the economy, more people getting vaccinated, those sectors are basically benefiting in that regard. The other thing that I think is happening that the market is grappling with a little bit, but I think it's healthy, is within the COVID defensives. So all of those sectors, if tech dominated, e-commerce dominated 2020, what the market is saying right now is what's going to drive results going forward. And it's almost a return back to fundamentals and real earnings. So delineating between those companies that really just had a big tailwind in this stay-at-home, work from home, and those companies that are delivering substantial results in terms of revenues and earnings growth and trying to make that distinction. So I think that price action is what we're seeing, both the mean reversion as well as focusing on who's really delivering and has the potential to deliver earnings going forward.
Well, and Kristen, related to that, I'm wondering if there's maybe like a little bit of self-deception perhaps happening to some investors who, stock goes up because it's a COVID cyclical, as you said, and then all of a sudden it's like new paradigm, world has changed, everything's come to this business. How long it might take for someone to realize, actually that was a one-time event, and I know I made a ton of money on the trade, but it's probably time to, kind of bail out and look at something else here. And I feel like right now there is, a lot of denial around how much did or did not change, and I'm just curious how you guys have maybe thought about what you've heard from folks on that front.
Yeah, and this is something that we're hearing a lot from our investors, and I think you have to separate it into two different things. So on one hand, I think for a lot of investors, seeing is believing, right? So we can talk about this catch-up trade and the mean reversion and some of the price action that we've seen, whether it's in energies, financials, and industrials, but we still look at the $1.3 trillion sitting on the sidelines in money market funds looking for a place to go. So there are a number of investors that have been waiting this out. We see this in cash on the sidelines. And I think for them, I mentioned that 15% of the global economy that's still shut down, they're not necessarily going to confidently put capital to work, confidently invest until they actually see that in terms of some of the activity. So you do have some of those headlines that are helpful that, by August, hopefully every adult that wants a COVID vaccine within the US should be able to get it. But I think some of that reopening is going to have to happen before you see those cash flows. I think then what you have to break out is where are these areas that are long-term unstoppable trends, regardless of whether we're in a pre-COVID world, post-COVID world. I want to be invested. I'm not as sensitive to the entry point because these are long-term secular trends that are going to play out over 3, 5, 10 years. Areas like longevity and global healthcare is an area where we've spent a lot of time. Digitization, hyperconnectivity, cybersecurity, those areas, and actually some of the recent price action has created some really attractive entry points. So that's how we've been breaking it down in terms of where to put capital to work.
Kristen, how do you determine what is an attractive investment right now? Are you more focused on PE multiples, price to sales multiples? How do you judge things at the moment?
It's a great question. I think on the PE multiples, there's a couple of different areas where you can say what does seem cheap, because I do think that the indices are not telling the full story. So this is an area where you really have to look outside of the US, right? So if you're looking at PE multiples, what hasn't really experienced that full snapback in terms of pricing in a COVID recovery, a post-COVID world, I would point to areas like UK equities is a great example. They've done a fantastic job with their vaccine rollout. They have substantially underperformed the last year, UK equities versus US equities, to the tune of about 30%. And it also provides that diversification, right? In terms of if you're worried about inflation, if you're worried about some of the headlines that we've seen that could impact US equities, global healthcare is another area. Lowest PE ratio on a relative basis compared to global equities that we've seen in over 10 years. And again, that's an area that we want to be invested for the longer term. So I think to answer your question, yes, we're looking at PE ratios, but I think another fundamental factor that's really driving where we're putting capital to work is the interest rate environment. And this idea that looking at rates, where are you going to find yield, which means that we have actually increased some of that equity exposure within our portfolios to make sure that our clients are not overweight cash and overweight duration in this interest rate environment that we're in right now.
Yes, you can't forget about rates for sure. Kristen, it's always great to get your thoughts here. Kristen Bitterly is Citi Private Bank Regional Head of Investments for North America. Thanks. All right, we're going to take a quick break here. When we come back, we're going to get a check on UK trading, in particular of Deliveroo. Hasn't been doing great. We'll be right back.
All right, well, in U.S. markets, when a hot venture-backed startup comes public, the stock goes to the moon. Everyone goes home happy. We talk about how it's the future of all kinds of commerce. In the U.K. markets, hot venture-backed startup comes to market, and the stock tanks. Oscar Williams-Groot joins us now to talk through what is going on with shares of Deliveroo today, and also, what happened with the IPO, and also the retail angle here, I think is an interesting part of this story as well. 70,000 individuals with about £1,000 of investment in Deliveroo, and it's been kind of a strange offering here, and certainly doesn't bode well, I would think, for the LSE going forward.
No, not at all, Miles. There are a lot of losers today here in London. As you say, Deliveroo conducted its IPO today, officially listing on the London Stock Exchange. It had raised about £1 billion, offering shares at 390p each, which was already at the low end of its initial range. But despite trimming, going as low as it could before the start of trade, shares fell 30% on its debut this morning, a pretty unheard of drop. That wiped about £2 billion off the value of the stock in a matter of minutes. It's still down about 25% as we speak. As you said, this is bad news for retail investors. About 70,000 of them bought in the IPO through a platform called Primary Bid. It's also bad news for Amazon. Amazon is the second biggest investor in Deliveroo, has just over a 10% stake in the business after this float closes. It's also, as you say, bad news for London. A lot of the politicians here and regulators and people at the London Stock Exchange had hoped Deliveroo would be the kind of standard bearer for a new group of tech companies coming to market here in London. Obviously, tech companies have traditionally shunned London in favor of New York, but recent reforms had meant to address that. But it turns out that you can change the rules, but that doesn't necessarily change investor appetite. We've had a string of big institutions rejecting this float ahead of the listing. Aviva, Standard Life, M&G, all start citing concerns around things like the treatment of riders, concerns of the dual class share structure, the company's valuation, and persistent losses. Now, Deliveroo did lose over £200 million last year on revenues of about £1.2 billion. But compare that to DoorDash, which is a very similar business. They lost over $600 million last year on smaller revenues. As you say, it starts to throw the comparison between New York and London into focus. This doesn't bode well for companies looking to list in London in future.
And Oscar, another company, UK-based startup, Kazoo, is they're going to list in the US. I think they're going to SPAC over here. And I'm just curious, so you mentioned some of those big institutional investors that aren't on board with, the dual class share structure, some of the other ESG elements maybe of Deliveroo, the employee, treatment, so on and so forth. Like, is there any path forward in your conversations, in your view of, kind of finance in the UK now that folks might change that view? Or is it just, we're gonna let the Americans, kind of do all these concessions, stocks will go up over there, and we plan to manage our affairs the way that we see fit?
I think we're on a journey here. I mean, when I speak to investors here in London, they recognize that we need to get some more tech stocks listing here in London, because that's where the growth has come over the last decade, and probably where it will come from in the next decade. But there's still a sense that the understanding of how these companies work can be valued, and how to approach them isn't necessarily there for the public market investors. That said, a lot of the people I'm speaking to today also say that many of the issues that have made this such a bad IPO for Deliveroo are quite concentrated to the company itself. For example, concerns around the treatment of riders. They treat them as independent contractors, but as we've seen for Uber here in London, regulatory change could make that more of an issue and push up operating costs. In their prospectus, they disclose they're facing investigations in Italy, the Netherlands, Spain, all across Europe. And so I think that is one of the big question marks here. But certainly, there is a journey to go on in understanding things like dual class share structures. This has only just come in the last few months. So I think investors want to take a little bit longer to get comfortable with this. And particularly when it's married with a business model like this that they already were a bit iffy with, it's not a good combination.
Yeah, it's just, it's interesting, Oscar, from the American perspective to see folks in 2021 say dual class share structures are bad. I mean, it's been table stakes for U.S. new tech companies really for over a decade now. I don't think they're great, but everyone here says they're fine. Investors say they're fine. The stocks go up all the time. So interesting to see how that evolves as we get through the next decade here of capital markets. Oscar Williams Group joining us live from the UK. All right, off for a short break here on this Wednesday morning. U.S. stocks mixed now, but Nasdaq continuing to lead the way higher, up about 1.5% on this final trading day of the first quarter.
Farm. It went public in December of last year, but it's a company that's been around for more than 40 years, and it just reported its first quarter as a public company. Sales up almost 63%. It makes hydroponics equipment, and increasingly, it's been selling that equipment to people who are farming marijuana. The CEO of the company is joining us right now. That is Bill Toler, Chairman and CEO, I should say. Bill, thank you so much for being here. I just saw the headline earlier this morning that Virginia is the latest state that is going to push its date to legalize recreational marijuana forward. We know New York is going in that direction, New Jersey as well. All of this would seem to bode well for your business. How much is it tied to, you guys sell agricultural hydroponics equipment to anybody, but how tied are you at this point to the cannabis business specifically?
Yeah, today we're certainly linked to the cannabis business, but really it's about the controlled environment agricultural sector, right? It's all indoor growing. And so we think of it as we have momentum going in our core business, which is our everyday established states all around the country. And we have a legislative agenda that's accelerating the business. So we have good fundamental organic growth going on underneath. And then we have new states coming online. 4 states passed adult use back in November. As you mentioned, a couple more have added since then. And we feel like that sort of wave is going to continue as we go forward. As really, Americans say they want it legalized, governments need the tax revenue. It's all pointing towards continued growth in the sector and in the category.
Bill, what type of product innovation are you cooking up, no pun intended, cooking up over there at Hydro Farm, just given what you are in fact seeing with regulations on cannabis starting to lift?
Yeah, we work with both our internal product development team and also our external supply base, where we, connect and develop products really around the world. Our latest innovation is really in the LED lighting arena, where we are launching our PhotoBio by Phantom. Phantom has been our leading lighting brand for the last 10 years. Bringing PhotoBio in, which is a third-party tested and validated, leading product in the industry, is something we're very exciting about and have, great momentum on. We really just got started selling it in earnest in the first quarter of this year, and our folks are out selling it. Customers love it. It's validated and tested to be one of the best products on the market. So that's a good example of innovation and how you can really, the best way to grow is to innovate on your own brands. And it's wonderful to see that product starting to have traction in the marketplace.
Bill, you guys called out some commodity cost pressures that you're expecting to run through over the next year. What specifically are you seeing, and kind of how's the global supply chain from your vantage point? What's the health of that, I guess, as we sit here as we enter April 2021?
Yeah, it's still struggling, quite frankly. I mean, coming out of Asia, things are slow. Things are expensive across the water. Transportation overall has been going up for quite a while, so that's been a bit of a challenge for us. We are pricing against many of those actions, so we're recovering those cost increases. Overall, though, we've got issues here locally as well. Some of our nutrient and grow media suppliers last year had such incredible years that they're having trouble keeping up with the growth in the category. So the supply chain, while improving over sort of its weakest positions in COVID last year, it's still not back 100% where it'd like to be. So we're still leaving growth on the table because the supply chain isn't really fully back 100%.
At the same time, Bill, this is an industry that is, as you see demand out there, this is an industry that's still pretty fragmented. So as you guys go through this year and into the coming years as a public company, do you expect to be making more acquisitions or making acquisitions and doing some consolidation?
That's certainly our goal. We believe that the fragmentation in the industry is a great opportunity for us. We're a 40-plus-year-old company. We grew up in this industry. I'm fairly new to the business, but really my leadership team has been around it for many, many decades. And I think that's the exciting part, is that we know the industry. We know these small brand leaders that want to be a part of a bigger platform like Hydro Farm. We're talking to a number of them now in hopes that they'll want to become part of our company and become part of the growth in this industry going forward. So we very much hope that M&A will be a part of our future, and we're working hard to make it true.
And Bill, this conversation began with marijuana, but we've been showing all this lovely footage of indoor farming of vegetables that one can eat. And we've also seen an increase in entrance on the market of companies that do just that: vertical farming, indoor farming, especially given the pace of climate change. How big a factor do you think that's going to be? How much do you think that's going to change agriculture, say, in the next decade?
Yeah, I think it's the single biggest thing in front of us, right? I mean, obviously right now, a lot of the excitement around our company and our category and our industry is driven by the cannabis legalization. But only a certain percentage of the population will ever interact with cannabis. The reality is everybody is going to eat, and everybody is going to need a more innovative and better way to have farming, better way to protect the environment, better way to use water and land. So we believe that controlled environment agriculture not only affects obviously cannabis today, but it's going to affect vegetables and perhaps fruits and other things as we go forward. And we think that there are lots of money and innovation and technology going into that space right now, as you mentioned. And we think through that, they'll find the right models that really execute a profitable way to grow all things, around the world. And there are a number of models now that we are partnering with and working with. And we believe that the controlled environment agriculture for food is going to be a great part of our longer term future.
Well, let's stay in touch as we watch the development of it. Bill Toler is Chairman and CEO of Hydro Farm. Thanks so much, Bill. Appreciate it.
Thank you. Nice to be with you.
When we come back, an early April Fool's joke. We'll tell you about it.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. Today is March 31st, which means we are on the eve of truly the worst of all faux holidays, and that is April Fool's Day. This week, Sazi, what are we doing here? Volkswagen comes out and pretends that they're going to change their U.S.-based operations to Volkswagen. Volts, like, Volts EVs. They're only going to sell EVs, blah, blah, blah. Volkswagen America's. I missed this, and I kind of, it was early when we met this morning. I was a little fuzzy on this. So did everyone cover this story like it was really happening? Like they were really changing their name, and then Volkswagen comes out and says, actually, we're not doing that? Is that the whole story?
First it was leaked. Then the company confirmed they were changing it in the U.S. specifically. They said they were changing it to Volkswagen. And then they came out yesterday and said, no, never mind. So it's unclear still to me if it was accidentally leaked early and was supposed to happen on April Fool's Day. Brian, is that your understanding of this, the way this unfolded as well?
Yeah, I believe that is my understanding of this very pressing matter here. But look, Volkswagen had to do something. I mean, their sales fell of the core Volkswagen brand last year 15%. Well, let's be real. Who cares about Volkswagen? It's Subaru. It's Tesla. So good for them for trying to shake things up a little bit, go a little IHOB. As IHOB did when they tried to change their name and get people interested in what they're selling, because really, everybody can care less right now. Who cares?
Well, I don't know. I would push back against that a little bit, Brian Sazi. At least what is on the slate the company has big ambitions when it comes to electric vehicles, right? So that was behind supposedly this change. But now the way that they've gone about this, you have to draw a contrast with Tesla, right? And Elon Musk's marketing strategy, or lack thereof, just his sort of, tweeting at will, whatever you might say about his lack of self-control when it comes to that, it seems to work for him. Whereas this really smacked of a sort of okay boomer vibe to come out with a prank like this, to me at least.
Well, you know what is exciting in the space? Not just Tesla. I just mentioned it there. It's Ford with their potential electric F-150 next year. It's the electric Mustang. People are even excited still about Lordstown, even though that has been a complete debacle over the past couple of weeks. But Volkswagen, man, it puts me to bed. It's putting me to sleep right now.
Yeah. Yeah.
Go, Miles.
I mean,
All you.
The whole thing is like, now I'm out of focus too, even worse. The whole thing is sort of like, it's too bland to really even care that much about. Like, I thought Volkswagen was fine. And, let's be clear, like, you can go Google it. Are we sure Volkswagen wants to hang on to the brand heritage that comes with that name? Are we sure it's not time for a refresh and moving in a different direction here? So I thought going to Volkswagen was fine. To then make it a marketing gimmick where we're saying that their marketing stinks is sort of like, now they've almost taken it away from themselves to use it in the future if they so chose to, because they are going to sell 100% electric vehicles at some point in the future, probably not all that far from today. So I don't know. I've never worked in a corporate marketing department. Sometimes it seems like it might be fun. Other times it mostly just seems depressing. The IHOB thing seemed fun, but then you realize that it actually had to be fake. So, I mean, even worse. You do wonder, like, who makes the call on this? Who's happy? Who sat there and said, this is a great program. I love this. That's all I got. I don't know. Maybe.
I think that's all any of us have.
It's the second time it's the second time they lied to consumers. You had Dieselgate. You have this now. What's the third? What's the hat trick here?
The other one was a little bit of a bigger deal. The stakes were a little higher for the other one.
I like that we've now elevated a fake mistimed April Fool's joke to the largest emission scandal in the history of internal combustion vehicles. But as it goes, as you mentioned, Sals, they come in threes. We'll see what's next for Volkswagen over there. A lot of Volkswagens on the road. My parents drive them. Not my favorite cars. I had a Jetta when I was a kid. Not my favorite car. All right, off for a short break here. Enough of all this. Nasdaq leading the way higher, up about 1.7% on this Wednesday morning. Back with more right on the other side of this break.
debut yesterday for a new ETF from ARK Invest. So you know there's going to be high demand, even though some of the ETFs have been waning in that portfolio as of late. This was the first new ETF from the company in 2 years, and it was the 8th biggest debut in ETF history from a volume perspective. $294 million in volume on trading yesterday. Sam Corris is joining us now. He is the lead analyst on this new space ETF. Sam, thanks so much for being here. ARK is known for these sort of long-term, in some cases, moonshot, and maybe this one literally plays. Space is tricky, right? Because there are the biggest players, the biggest pure play players are private. So how did you go about approaching how to construct this thing?
Yes, I think that really ties into the strength of ARK's research ecosystem. And as you said, there are so many different components to a space company and what makes space successful. And so, you can see that 3D printing is a large part of this fund. And really, aerospace is this killer application for 3D printing. And, when you're talking about it, right, long-term is exactly the way to think about it. And there's totally new industries that are being created. So you have satellite internet connectivity that could be $100 billion in annual revenue in the next 5 to 10 years. You have hypersonic point-to-point travel, going from New York to Japan in 2 to 3 hours. That could be $270 billion annually. All of these opportunities are just starting to take shape. And so we're looking for the companies that are going to benefit from this, the ones that are enabling it, and then the ones actually doing it themselves. So there's definitely a lot of components and some huge opportunities out there.
And, Sam, when I look at, some of the big holdings, Boeing's in here, Lockheed, L3Harris, certainly there's a government contract component of this. I mean, how big do you think the U.S. government and really international governments, impulse towards investing in space exploration? How large do you guys think that impulse is going to be over the coming decade? Obviously, it was on a downward trajectory, but it feels like that tide is starting to turn.
I'd agree. And I think it's been an interesting dynamic if we look over the past few decades. And really, space was monopolistic, government-driven, and now it's become much more commercial and government-private partnerships here. And so we're seeing tremendous demand from governments. I think there is an emerging new space race, and every government out there wants to have its own satellite constellation and have eyes in real-time communication no matter where they are in the world. But then we also have these companies that are also going after it and really speeding innovation along.
Sam, what's the expected rate of return on this ETF for you?
Sure. So right now, if we look at the portfolio as a whole, I think we're expecting a north of 15% compound annual growth rate. So that would be, similar to all of our other ETFs, where over the next 5 years we'd expect a doubling. And we think, again, as I mentioned earlier, we have these huge hundreds of billion-dollar opportunities that are just taking place today and just starting. So, we mentioned that satellite connectivity, hypersonic point-to-point, which might be a bit further out, but something that we're seeing happen, as we speak, is this air taxi environment. And we have batteries that have come down in cost, autonomous technology that's come into place, that's going to open up this market that never existed before. And I know I'm personally excited to be able to go from downtown New York to JFK for $75 in an air taxi, as opposed to paying the same amount in an Uber or something and sitting in traffic for 2 hours.
And Sam, what about sort of the discoveries that are made through space travel and, products or services or innovations that come from that? How does that fit into the strategy, or is that sort of in one of the other ETFs in the portfolio?
Yeah, so in this, we like to think of those as what we call aerospace beneficiaries. And so that could be a company like Netflix that's benefiting from increased access to internet, and that increases their total addressable market. I think another one that people have been calling out, but John Deere, they utilize satellites for precision agriculture. They utilize drones for information gathering. Same with Komatsu, which is a mining company that's really reducing costs and has the potential to boost margins by using drones to pre-survey scenes, to do measurements on scenes. So there are a number of companies out there that, people aren't necessarily doing the work right now, but we're researching and we're seeing that, we can get both top line growth and margin expansion from some of these technologies.
And finally, if I could, Sam, I want to ask you a little bit more broadly about ARK as well, because wow, you guys have had an interesting year, right? Of course, 2020 was a huge year for ARK. This year, we were talking earlier on the show about the sort of rotation that we have seen out a lot of the popular trades, including those that were heavily relied on for ARK ETFs. You've still seen inflows this year. Now, I know I don't think you're physically at an office, but I'm just wondering, like, what's the vibe like at ARK these days as you have seen all this sort of turmoil around you and involving your own ETFs?
Yeah, we're long-term investors. So the short-term volatility makes things really exciting and is actually when I think ARK shines the most. Given that we do have a longer time horizon, we use this opportunity to consolidate into our highest conviction names. And we think that really gives us the edge over that long term. So the short-term volatility is exciting, and we think it gives us even better opportunities to take positions for the long term.
All right, keeping your eye on the prize. Sam Corris, thanks so much for being here. You're an analyst at ARK Invest. Hope to talk to you again soon as we watch this space ETF maybe take off. We'll see. Appreciate the time. All right, we're going to take a quick break. When we come back, we'll get a check on what's going on in the market. So we've got the Nasdaq at the highs of the session.
All right, welcome back to Yahoo Finance Live on this Wednesday morning, final trading day of the first quarter of 2021, even though I keep calling it 2020. Take a look at the markets here. Nasdaq up 1.7%, leading the way. S&P split the difference between the tech index and the Dow. The Dow just fractionally positive right now. Leader within the Dow is Walgreens. That stock is up some 6% following its latest earnings report. Walgreens right now trading basically at its 52-week high. Walgreens has really not been a standout performer since the stock was added to the Dow Jones Industrial Average. Another stock that's really leading the way on our site today in terms of search traffic, that is Chewy. Shares were up double-digit percentages in the pre-market. We see it's up just under 10% here, right around 9.5%. Brian Salzi, we talked to Chewy CEO Sumit Singh earlier on in the program. Just been a really interesting year for the business that certainly has a lot more eyeballs on it now as we kind of get through the COVID pet boom.
Yeah, a couple things stood out to me here from our chat with Sumit. One is, they're seeing a broadening out of what people are buying on the sites, and so it's no longer just pet food. Number two, wow, Chewy is really dominating this space, and I would be concerned, post-pandemic, a lot of retailers, you operate at physical stores, which Chewy does not. You're going to be in trouble here because a company, an online-first brand like a Chewy, it's once they've gained that loyalty, it's going to be hard to unwind that.
Yeah, and just to mention as well, he talked about the opportunity in treating healthcare for dogs. That's also potentially going to be big for them.
All I can add is my parents just got a puppy, and it took them like 3 tries to even find a vet. So that's the state of the vet market these days. All right, it's going to do it for us here. 9 to 11 block on Yahoo Finance Live. For Julie and Brian, I am Miles Upton. Stocks higher on this final trading day of the quarter. Zach Guzman, Kiko Fujita have you on the other side of this break. See you back here at 9 o'clock tomorrow morning.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing all 3 major indices trading in the green on the last day of this quarter. Taking a look at where they stand right now, the Nasdaq seeing the biggest gains as we see a tech bounce back up 218 points, the Dow up 17, and the S&P 500 up roughly 25 points there. Investor sentiment helped by a strong ADP number. Private payrolls last month expanded at their fastest pace since September of last year. We're going to dig into those numbers later in the show. On course for a big debut, online learning platform Coursera goes public today. CEO Jeff Maggioncalda joins us to discuss the future of education. And Huawei feels the heat from U.S. sanctions, posting a rare revenue decline in the last quarter. We'll be speaking to Chief Security Officer Andy Purdy shortly about the company's financials. Let's begin this hour, though, in Washington. President Biden set to unveil the first part of that infrastructure package, and it is expected to come with a steep price tag. Let's bring in Yahoo Finance's Jessica Smith, who is following that story for us today. What do we know about the details, Jess?
Yeah, Kiko, the president is going to lay out a $2 trillion infrastructure plan. This is going to be the first of two long-term economic recovery plans. The second will be laid out at some point next month, according to the White House. But today, President Biden is going to call for more than $600 billion to upgrade transportation infrastructure. So that will include highways, bridges, roads, public transit systems, rail systems, a big investment in electric vehicles, including rebates and tax incentives for Americans to buy electric vehicles, grants to build out those electric vehicle chargers all across the country. It will also call for another $300 billion to fix and modernize the nation's water systems, broadband access, and the electric grid, all with a focus on clean energy. It has hundreds of billions of dollars for affordable housing, for workforce development, research and development, all to try and strengthen U.S. supply chains and boost U.S. manufacturing. Of course, the big question is, how do you pay for it? And the president suggests raising the corporate tax rate to 28%. That's up from 21%. He wants a global minimum tax for U.S. multinational corporations at 21%. He also is proposing measures to keep companies from using tax havens or offshoring jobs. He also wants to end tax breaks for the fossil fuel industry and ramp up IRS enforcement of big corporations. Now, Republicans are not happy about these tax hikes. They have been saying so for weeks now. And now that we actually know what the president is going to propose, we have heard from the U.S. Chamber, who called the tax hikes dangerously misguided. They go on to say that the tax increases will slow the economic recovery and make the U.S. less competitive globally, the exact opposite of the goals of the infrastructure plan. We've also heard from some progressives like Congresswoman Alexandria Ocasio-Cortez, who says this plan is not big enough. The administration needs to do more. At this point, it's not clear if the administration is going to try and reach across the aisle and build bipartisan support for this, but it's looking more and more like Democrats are going to use reconciliation and try and get this passed with no Republican support. Again, we will hear from the president later this afternoon in the 4 o'clock hour. Zach and Akiko.
Okay, thanks so much for that, Jess. And as Jess mentioned, we will bring that speech to you live. The president expected to detail that $2 trillion economic recovery plan at 4:20 p.m. Eastern. And you can watch that speech right here on Yahoo Finance Live. Well, let's turn our attention back to the markets with our next two guests. We've got Craig Fair, Edward Jones investment strategist. We've also got Francis Gannon, co-chief investment officer at Royce Investment Partners. Let's start with you, Craig, because it feels like all the variables are lining up right now to sort of supercharge the economy. Jess just talked about the infrastructure package that would come on top of that $1.9 trillion stimulus plan that's already been passed. You've said that the road to markets pushing higher is a bit windier, though. What do you see right now that raises maybe some red flags or potential bumps in the road?
Yeah, Kiko, I think you're right in that the stars are lining up well for the fundamental backdrop for this market to continue to be quite positive this year. We've got monetary policy that's largely still quite favorable, although we might see some adjustments there. Fiscal policy is clearly a heavy wind at the back. And then we've got the labor market that continues to improve. That's exactly what combination or cocktail you'd want to see for a growing economy and a positive market. I just think we're going to see a bit of role reversal this year. If you think back over the past 12 months, the economy and the stock market have been in very different places, with the stock market returning to new highs as early as last August and now pushing higher, while the economy was slugging along. And I think this year we're going to get a lot of momentum in the economy, and it's going to be the market that's going to proceed more in a 2-step forward, 1 step back type of fashion. So as you noted, we seem to be unveiling fiscal stimulus plans to the tune of 10% of GDP quite regularly these days. That part has been necessary given some of the damage that's occurred to the economy. I think the complexion is just going to change a little bit with an infrastructure bill relative to, up until this point, what has been direct payments to taxpayers and direct relief to businesses.
Yeah, and Francis, you just heard from Jess there, kind of Republicans talking about this infrastructure plan, flexing their concerns around moving the corporate tax rate higher. When you look at where we're at in this recovery, how much of an impact might you think that would have on businesses who are trying to kind of get back to normal here, and where we sit in this recovery?
Sure. I think we're still in the early stages of the recovery. I think, as Craig alluded to, this is going to be a year of Wall Street versus Main Street. And Main Street this year is going to be the clear beneficiary of this economic recovery. And we're moving really from recovery into expansion. And that's going to be the key. Key to this story in terms of the market, and particularly small caps, is going to be earnings and earnings growth. If you raise corporate taxes, small cap companies tend to pay their taxes, right? They don't have all the different divisions and earnings from outside the US, et cetera, where they can find losses or harvest losses. Most small cap companies tend to pay their taxes. So it will have an effect on corporate earnings within the small cap space. I would say, though, that I think that the earnings story for small caps this year and into next is going to be quite powerful, especially given the fact that we're talking about GDP numbers being north of 5% over the next several quarters.
So, Francis, let's talk about strategy then. What do you like in the small cap space?
I think within the small cap space, we've just had a powerful year. You know, the 1 year number for the Russell 2000 as of this morning was around 91% return. Small caps bottomed on March 18th of last year, and we saw about over 130% return for the index. So I think what you're happy to see now as we rotate into year two of this bull market of recovery within the small cap space is earnings are going to be increasingly more important. I think the type of businesses you own are going to be increasingly more important. And this is an environment where we're going to see the small cap cyclicals continue to do quite well. And I think that's the most important part of the story here, is that focus on the more cyclical, economically sensitive areas of the overall market. That's where you want to be positioned right now.
Yeah, and I mean, when we look at that too, Craig, on the other side, kind of looking more broader market, it does seem like some of those companies that had been favorites before in this stay-at-home trade had been beaten down. You think about, though, a Chewy, which you're going to be talking about later, that showed some renewed strength and maybe expectations were just low there. I mean, what about this rotation might be going too far when we think about some of those big growth drivers before and how the rest of the year might shake out in terms of winners and losers?
The way I would interpret that is I think we're going to see the pendulum, as it has for the last several months. I think we'll see the pendulum swing a little bit too far in one direction or another in terms of the momentum that we're seeing in the market. I liked Francis's word. I think he's spot on. Rotation is exactly what I think we're going to see play out. Now, it's interesting. If you think back historically, the risk on, risk off rotation would be a surge in equity prices or stock prices. And then when the risk off attitude comes in periodically, that's a shift into bonds. What we're seeing more recently is that risk on, risk off is cyclicals and value is a risk on day. And then we're seeing a movement back into growth in those kind of risk off or more defensive days. And I think we could see more of that. But just as you noted, and I know you brought up Chewy, which we're throwing plenty of money at as well, given our dog situation in the house. I think it's that earnings story that Francis had touched on, which is that I think the next leg of this bull market, we've seen the big deep breath rally off the lows of last March. Now the next leg of this is going to be powered by the most compelling earnings stories. And I think that's both at an asset class level. I would agree small caps look quite compelling there. And I think from a sector level, I think you're going to see a continuous rotation. Tech continues to have a compelling secular growth story, but you look at financials, which benefit from a steepening yield curve. You look at industrials that, speaking of today's news, could benefit greatly from increased infrastructure spending. I think we're going to continue to see a rotation back and forth, and the market's really going to pay attention to the most compelling earnings stories.
Okay, great to have both of you on today. Craig Fair, Principal Edward Jones Investment Strategist, as well as Francis Gannon, Co-Chief Investment Officer at Royce Investment Partners. Let's turn our attention to one big stock mover in the session, an upbeat look from Lululemon, failing to lift the stock today in the session. We've seen the company shares under pressure, down more than 4% there. The retailer beat on the top and bottom lines in its most recent quarter and says they expect the athleisure boom to continue well beyond the pandemic. Let's bring in Yahoo Finance's Alicia Sikierska. Alicia, what do you make of the move in the session here, given just how positive the outlook was for the company?
Yeah, it's interesting because the results were so positive in the fourth quarter. Sales were up 24%, hitting 1.7 billion. Comparable sales were also up 21%. It was clearly a very strong quarter, and that momentum is going to continue into the first quarter of 2021. Lululemon issued some forward-looking guidance yesterday after the markets closed, and they released their earnings. And it's a bit of a good news, bad news situation here. That momentum from the fourth quarter is clearly continuing in the first. We're going to see revenues hit between 1.1 billion and 1.13 billion, which was above what analysts were expecting for the first quarter. But then when you look at the full year for 2021, that is hitting below what analysts were expecting. And that's due in part to that $500 million acquisition of Mirror that Lululemon had done back in June. You'll recall they purchased the at-home fitness company, you know, that fancy high-tech $1,500 mirror where you can work out from home. That's going to be costing them money throughout the year because they're going to be investing in that technology in marketing of it. They're going to add more classes, which means opening up 2 new studios. So I think people were perhaps a little surprised. The investor community was surprised by how much that is going to be weighing on earnings per share for Lululemon this year.
Yeah, it's one of those acquisitions I think that a lot of people are scratching their heads over. But you think about the growth still to come for a company like Lulu. They say they're early on in their growth stage. One of those areas had been menswear. Think about a couple of years ago when they were really trying to get that off the ground. I mean, when you look at the growth points here, Alicia, which ones stand out in terms of what they're trying to flex in that story if they do think they're still early on?
I think menswear is a great one to bring up because that still is for Lululemon. Somewhere around the 20% mark. Sales were strong, but you know they saw double-digit growth, but it's still a small portion compared to what women's wear. And especially if you look at companies like Nike, where menswear is so dominant for them, and that's where Lululemon wants to kind of take the brand and have it be almost split is the hope down the road. They also see a lot of potential. I mean, right now, Lululemon is capitalizing clearly on people working from home and looking at buying sweats and comfy clothes. I don't know about you two, but you know, yoga pants were very much my uniform through this pandemic. But going forward, they are going to be focusing on developing innovative products that are much more technical. So it's not targeting the people that are working from home and just looking for some comfy clothes. It's that, high performance athlete, and they're going to be unveiling more innovations in different product categories.
All right, Alicia Sikierska, Yahoo Finance Canada reporter. Appreciate you hopping on here with us to chat that today. Thanks again. I want to turn our attention to another mover in today's session, which would be Chewy shares. We're seeing those pop up by about 9% a little bit earlier on in the session here. Still holding those gains now by about 8.5%. Expectations were pretty much surpassed handedly there by the pet food company, as a lot of people have been buying pets in the pandemic, and you got to feed them. Adjusted earnings per share, 5 cents a share. A loss of 9 cents was expected. Revenue north of $2 billion versus the $1.96 billion expected. The CEO also stressed that it's not just the pandemic that boosted sales, and they're going to be able to hold that shift towards online purchases in the quarters to come. Take a listen.
We believe that we can sustain this momentum on the back of tremendous market opportunity and on the back of our ability to win customer hearts and minds and execute behind that market opportunity.
So there you go. Not just the pandemic by itself. Chewy again seeing a nice pop in today's session, north of 8%. Well, we're going to take a quick break here on Yahoo Finance Live, but when we return, discussing Huawei as that company feels the heat from U.S. sanctions, posting a rare revenue decline in their latest quarter. We'll speak to their Chief Security Officer, Andy Purdy, about the company's financials right after this short break. Stay with us.
U.S. sanctions dramatically slow growth for Chinese telecommunications giant Huawei. Revenue for 2020 totaled $137 billion. That's about a 4% growth. Compare that with the roughly 20% bump it saw in the previous year. China, in fact, was the only region where Huawei saw positive revenue growth. Let's bring in the Chief Security Officer of Huawei Technologies US, Andy Purdy. Andy, it's always good to talk to you. We should note revenue actually declined in Q4 by 11%. So clearly things not moving in the right direction. The company's been very transparent about just how much you've been hurt by US sanctions. But when you look at the path forward, does it really just come down to the home market of China for Huawei at this point?
No, absolutely not. We're making some progress in a number of other places. And since we're talking about the financials, let me just mention that in the spirit of transparency, these numbers aren't what we've had in some years. However, given the pandemic, given the challenges around the world, given the sanctions that hurt us significantly in 2019 and 2020, and will hurt us even more in 2021, we are able to support our customers in 1,500 networks around the world, 20 different industries, 170 countries. So we continue to have, although we're not publicly traded, we provide audits by KPMG. That's a standard unmodified audit opinion. So regardless of how bad things are, we're going to make sure we're transparent so customers, government, employees really know what the situation is. So we know that this year is going to be tough, but we look at the situation as the glass is half full, whereas because of the U.S. sanctions, for the U.S. semiconductor industry, the glass is definitely half empty and getting worse.
Yeah, on that issue, the consumer business has taken the biggest hit. When you look at even just devices, Huawei falling out of the top 5 in terms of smartphone makers. We heard from rotating chairman Ken Hu overnight, who essentially said we haven't been able to see a clear picture in the supply for our smartphones. What kind of timeline is Huawei looking at right now? At what point do you run out of supply, largely because of the U.S. sanctions?
Well, the export controls are not affecting our infrastructure business. And of course, the claim that we pose a national security threat in the infrastructure business as part of the reason for the export controls really doesn't make any sense. So we're hoping there'll be a revisiting of the impact on American employees. But our consumer business is making some substantial progress and will continue to as we focus on things like smart office, fitness and health, smart home, easy travel and entertainment. And when you look at the broader picture, which is innovation in 5G generally, we have 3,000 5G innovation projects in industries around the world: coal mining, steel, ports, production, manufacturing. So we're going to be hurt this year, but we're in this for the long haul. So we're going to be fine.
But on the supply issue of smartphones specifically, what's the timeline? Do you have? I mean, how much more can you continue without the supply coming in because of the export controls?
Well, we are pursuing, as you know, alternatives, which is one of the reasons we upped in this year, 2020. We invested about $21 billion in R&D. I think we're in the top 3 in the world. So we are trying to find ways. We are trying to find alternatives. And we're going to get through. We hope there'll be a reconsideration of the export controls on the ability of us to partner with Google in terms of the Android system. We don't see any argument that there's a national security threat, and it definitely has an impact on Google. And frankly, in terms of the security of the ecosystem, it's really great if we can be an active partner in the Android system. It really helps everyone.
Yeah, and Andy, I mean, to Kiko's point there, obviously, I think it would be very clear why it would be good to get these sanctions out of the way. But you, as your role here as USA Chief Security Officer, I mean, what more can you do to maybe prove that point, if not directly with the Biden administration, beyond just to the public? What is it that you think can be better, I guess, proven out there to put those concerns to rest?
Well, I think we have to look at the larger world and in terms of your question, our priorities. So our priorities are hoping that the export controls can be lifted to allow American companies to sell non-sensitive technologies to Huawei, and that hopefully our CFO, Meng Wanzhou, can be released. So the issue about the export controls, that's going to be between the American semiconductor industry and the U.S. government. There are a number of things happening around the world. There's some very important things happening in the U.S. regarding supply chain risk. We hope, in light of the recent SolarWinds attacks on the Microsoft Exchange server, 2 of the largest cyber attacks in history, the U.S. government, we believe, working with the private sector, is really going to improve supply chain risk metrics. We just saw last week the Information Technology Industry Council released a principles for supply chain risk where they said country of origin is only one of 188 factors. So we're hoping that as the U.S. improves supply chain security for the U.S., working more multilaterally now with our partners, that at some point the government will conclude that it's okay to sell those non-sensitive technologies to us that go into our mobile devices.
Andy, what's the company looking at right now for additional sources of revenue? There have been reports out there that you are doubling down on the EV space, potentially providing technology, although you're not actually building out the cars themselves. Is that an avenue that the company sees as a potential opportunity?
Well, the communications and sensing infrastructure of automobiles is a very important part of our overall consumer device and enabled uses strategy that we believe, as we move from 5G to 5.5G, is going to continue to be very, very important. And that's one of the reasons why we look at our partnership with carriers, with companies, enterprises around the world, that people will have a greater understanding that it's shared success. It's not about us making money. We partner with a lot of folks. And when you see, and some companies in the U.S. are afraid to speak out public because of the toxic political environment, you see folks know that they can make money working for us. It's not about us taking every dime out of it. It's a shared success that's going to come from these technologies. And the impact of blocking our ability to compete where there's no national security connection really has a dramatic impact on American consumers and American businesses.
Yeah, we'll see if that stance from the government changes. But Andy Purdy, Huawei Technologies USA Chief Security Officer, appreciate you taking the time to join us today. We're going to take a quick break here, but on the other side, discussing a startup that's raising $50 million in an interesting investment coming from Apple to help artists out there gain the rights, hold on to the rights to all the music as we talk about streaming being a booming business now. We'll chat that with the CEO and founder of United Masters coming up right after the break. Stay with us. Welcome back to Yahoo Finance Live. Without the ability to put on concerts for fans, musicians and artists have increasingly leaned on streaming, which hasn't brought in all that much money for artists once record labels and platforms take their cut. But what if artists were able to go directly to Apple Music and others while keeping the masters of their songs themselves? That's the premise behind United Masters, a distribution platform startup that just raised a $50 million Series B funding round led by Apple, a rare investment from the tech giant, with follow-on investment coming from Alphabet and Andreessen Horowitz as well. And join us now for more on that is former Sony Music and Interscope exec turned United Masters founder and CEO, Steve Stout, joining us right now. Steve, congrats on the funding round. Big to get Apple on board. But you're really focused on independent artists and catching on and growing their fan base. And I think of Lil Nas X as an example when Old Town Road blew up on TikTok and the route he went to sign with a big label. But you guys present a different route for artists to go for maybe the next Lil Nas X. So talk to me about how it works.
So first of all, thank you for having me. Look, what we believe is that artists should have the option. I mean, they put the time in to make incredible work and invest in themselves. And either you should, if you want to, sign with a legacy label, which is the option that was always available for the last 50 years if you were lucky enough, or now you can sign to United Masters or partner with United Masters and we distribute your music for you. You can upload the music right from your phone anywhere you are in the world, put out the song, and we'll distribute it to all of the DSPs, Apple, Spotify, Amazon Music. And then the artist gets either 90% of the revenue and we get a 10% fee, or they can pay $5 a month and keep 100% of the revenue. But the thing that's very, very important is that the artist owns their rights. They own their IP. This is not a situation that when you sign something, just when you take the money, you also give away your rights, which is what legacy labels have done historically since the inception of recorded music.
Steve, it's good to talk to you. We know Apple doesn't just back any company. You're talking about a $15 million investment round led by Apple. What potential partnerships do you see here? Because in many ways, some would argue that Apple's been taking a lot of money away from the artists.
Well, I don't know who could make that argument. Apple pays whoever, if the artists are signed to record companies, and if the money is not flowing through to the artist that's coming from Apple, I mean, you got to look at the record company, who's the person that's in the middle, and already has a deal cut with the artist. So I don't know who would make that argument. What I can tell you is Apple, and why we partnered, is because they believe in the creator. They have a culture of believing in creators, inventors, and artists. And that's the reason why I thought it was the greatest partner in the world, quite frankly. It was Eddie Q's and I's discussion over the last 2 years on how we could help level the playing field, so that if you're signed to an independent, doesn't mean that you have less than someone who's signed to a major label, which is the stigma with being independent, that you don't get the same opportunities. We are proving with this partnership, our intent is to let great artists know that if you choose the option of going independent, you still have those same opportunities.
Yeah, because it seems like, obvious, the upside's obvious in maintaining your masters and keeping the cut there versus going with a record label. But I guess there is that kind of cachet that would come with it too, and the branding around it. But you guys also have a piece of that in the business here in United Masters built around that. So talk to me about how maybe the trade-offs exist between what you were just touching on, going independent versus the big labels, and the way that you grow the artists that are on your platform.
Those trade-offs have changed dramatically. You talk about back in the day when record companies had to make vinyl and CDs, and they had a monopoly on promoting your songs at radio. These things have changed dramatically, where the new MTV is an artist's social media. What you do on Instagram and TikTok is as impactful as MTV was back in its heyday. And, Apple Music is the new radio/music store. And that relationship doesn't need a record company per se in its older format in the middle. What the artists need right now is a distribution partner. They need to maintain their rights, and they need to have a technology advantage, an edge. So when we start talking about NFTs, the NFTs and blockchain and all that stuff is fantastic for the owner of the copyright, right? So like if you own a copyright, you can sell an NFT. You can actually start to create opportunities for your copyright and use technology to unlock value. Whereas before, if you didn't have ownership of that right, then you could hear NFTs all day. It wasn't like you could do anything about that with your music because you don't own it. The record company did.
So, I mean, if it really is about ownership of artists, and to your point, the ability to control all of that, I mean, it seems like NFTs are kind of the ultimate way to control ownership and be able to monetize things for artists. We've already seen some bands, some artists that have already come forward with an album issued on NFTs. Is that where things are going?
Well, I think NFTs and anything that unlocks technology to unlock the future of growth. It's NFTs now. We don't know what it's going to be going forward, but we do know that the only way to capitalize on the opportunities that go forward is if an artist is signed or part of a technology that can help them unearth those opportunities, and they actually own the rights to do it. So yeah, with an NFT, it enables the owner to put terms and conditions around their master, and everything else that's replicated is a duplicate. That's fantastic because it increases the value of the master. But when you sign that away early in your career as an artist, and you have no chance to take part in those opportunities, it certainly is not a good feeling to know that, if you only knew better back then, you would do something better now. And having this option to democratize ownership and level the playing field is why I partner with Apple. And, You know, United Masters, we've always said from day one, we are a record company in your pocket. You can go in your pocket, you can get, you know, where you are financially, you can promote your music, you can distribute your music, and we're adding more and more features to help keep up with where technology is going and what should be afforded to the next generation modern day artists.
United Masters founder and CEO Steve Stout, it's good to talk to you today. Appreciate your time. Coming up after the break, France braces for a third national lockdown. Plus, Amazon-backed delivery service Deliveroo has a dismal debut over in London. We'll explain on the other side. In our worldview today, France is bracing for a third national lockdown as the country struggles to control coronavirus infections. French President Emmanuel Macron is set to lay out the latest restrictions in a primetime speech in just a few hours. Daily new infections in the country have doubled to nearly 40,000 since February, while ICU patients have surpassed the peak hospitals reached during the fall lockdown. Just 12% of the population has been vaccinated so far. A nightly curfew is already in effect, as well as non-essential businesses being asked to close. Parliament is expected to vote on Macron's new proposal tomorrow. China is pushing against allegations it withheld data from the World Health Organization and stifled an investigation into the origin of COVID-19. The U.S. and 13 other countries issued a statement Tuesday saying the WHO's report was, quote, significantly delayed and lacked access to complete data and samples. But the Chinese lead on that report says experts were provided data, adding it was impractical to present original records and specimens. The report released yesterday found that the virus most likely jumped from animals to humans. It downplayed the likelihood of a lab leak. And the U.S. State Department has ordered all non-essential staff to evacuate Myanmar as violence escalates in the country. Secretary of State Antony Blinken called the crackdown against protesters increasingly disturbing and even horrifying. Myanmar's military and police have killed more than 500 people since the coup in February. The UN Security Council is holding a closed-door meeting today to discuss its response to the escalating violence.
All right, well, let's head across the pond for some action in the European markets. And that's where British food delivery startup Deliveroo is having a public debut that it would like to forget in London. The Amazon-backed company is seeing a plunge at one point of about 30% in the session. For more on that, I want to get to Yahoo Finance's Oscar Williams-Groot, who has more for us on that. Oscar?
Zach, it really has been a day for the history books, one of the worst IPOs ever on the London Stock Exchange. As you said, Deliveroo saw their stock drop by about 30% shortly after the open here in London. They'd offered shares at 390p, and that was already at the low end of initial range. They'd written down the value by about 1 billion ahead of the float. The first day of trading saw about 2 billion wiped off in short order. The stock is still down by around a quarter. Now, this is bad news for Amazon. They own about 10% of the company after this process. Bad news for a lot of retail investors here in the UK. About 70,000 people put in about 50 million into the IPO through this process. It's also bad news for London more broadly as a home for tech companies. The Chancellor Rishi Sunak had hoped that Deliveroo would be the first to take advantage of new rules he introduced just earlier this month, meant to lure more tech companies and also SPACs. That now looks in doubt given the frosty reception that Deliveroo has received from the City of London. I think the attention now is going to quickly move to how did the banks get this so wrong? We had some real blue chip names working on this float. JP Morgan, Goldman Sachs, Jefferies, Bank of America, Citi, really the creme de la creme were working on this float, but it looks very mispriced at the moment. Now, those close to Deliveroo, they aren't particularly fazed by this. The IPO market has been softening just in the last week or so, and we have seen a shift away from focusing on tech towards more recovery plays. They, of course, are in this for the long haul and expect the share price to recover at some point, but certainly not a great day for the company, and we'll be watching the share price closely.
Yeah, far cry from that 85% pop we saw in DoorDash back over here, but we'll see what happens. Oscar Williams-Groot, appreciate you bringing us the latest there. We're going to take another quick break here on Yahoo Finance Live, but when we return, a discussion with the CEO of travel and checkpoint company Clear. Our editor-in-chief, Andy Serwer, will speak to the CEO on the other side of the break and bring us the latest on the travel in the pandemic and where we're at, the state of the industry, navigating its way through all that. Stay with us. We're back in 2. Welcome back. As air travel continues to trickle back in, as more people get vaccinated, Yahoo Finance's editor-in-chief Andy Serwer spoke to Clear CEO about the company's progress in bringing air travel back, the state of travel, and the impact that the pandemic has had on the industry. Let's watch.
So talk about Health Pass and this other really exciting part of your business going forward. And I guess this has to do with vaccine validation, right?
So it's vaccine validation, it's testing, and what we're really calling it is a digital health credential. What we quickly realized, because we saw in February what was happening from a travel perspective, were the need for digital health insights, that they were just another card in your wallet. I had gone to Kenya a few years ago and needed a yellow card. And when I got a yellow fever vaccine, and they told me not to lose it. And I thought, first of all, I lose everything. And second of all, like, really? And that is not secure, not easy. And so quickly, we recognized that a digital health credential was going to be needed to connect whatever it be. At the time, we didn't know antigen tests, right? We were all ordering blood tests for home to see if you had antibodies, testing, PCR testing, rapid testing, or ultimately vaccines. That's just another card in your wallet. And in fact, that's what it's turned out to be. And so connecting you, the same way we connect you, you are your driver's license, you are your credit card, which then connects you to your boarding pass. We quickly built Health Pass, which is a mobile first. We had all the assets in place, whether it be a government certified, really industrial strength backend, HIPAA compliant, very secure, with this customer centric front end from a mobile perspective. So we built Health Pass mobile first, face first. You are Andy, connected to labs, which could then, again, you have to do it in a verified identity, verified backend, not taking a picture, of a card, that you are Andy and you've been tested in the past 72 hours or 48 hours or 24 hours and you were negative, right? Or that you were vaccinated first dose, second dose, right? That you were vaccinated 9 months ago, 6 months ago. These things matter. And so Health Pass was to digitize another card in your wallet and connect it to the other cards. Again, if our North Star is to make it safer and easier to get into a Yankees game, you are your ticket, you are your vaccine status or your testing status. You don't need to share any personal information. All they need to see is red and it can be scanned in, or your face. And so, yeah, we've been working on it since last March. And after 9/11, airports were closed. After COVID, every other industry has been closed. Actually, airports stayed open. And so it is with this global need to make experiences safer and easier, and identity as the foundation, that we've been moving aggressively over the past year to help reopen the economy and make it frictionless for consumers.
Where does this effort stand, though, Karen? Is it something that can be rolled out right now? I mean, and how would it work, practically speaking?
So it's out, it's live, it's happening. Right now, from a testing perspective, we're working with NBA teams like the Orlando Magic or the Atlanta Hawks or the San Antonio Spurs, right? Where you have to be tested, and the Health Pass shows your test results and allows you to get in frictionlessly. We're working with airlines in the state of Hawaii, so that as opposed to having to go quarantine for days, which, your 10-day Hawaii trip, spending 9 days quarantining, not optimal. You can go right off the plane and onto the beach because you're connected to your health results. We're partnered with corporations to help bring back their team members. We're certainly using it here at the Clear office. And so we partnered with the NHL for the bubble. We're partnered with NHL teams. And so it's already happening in travel, in sports and entertainment, in building access and employee validation. And so it's live, it's real. And we recently, I think last week, announced a partnership with Walmart, where if you're vaccinated at Walmart, we will be connecting that to Health Pass and we'll be digitizing that. And so that will be your, we don't call it a vaccine passport, we call it a digital health credential.
Wow. And is this biometric or on an app?
So it's both, right? So it's your face. It definitely has to be you. So this verified identity is very important. And so that's your facial biometric, but it is on a mobile phone. So you can, enroll at home. Over 5.5 million members, most of them had to come and enroll at the airport or a sports stadium. That can be more difficult, but you can do it on your mobile phone and enroll and be there in 2 minutes.
Yeah, it's
All right,
very
we've got much
interesting
more
time.
coming up here on Yahoo Finance Live. We'll be right back.
Well, not only is it tax filing season, but it's also the day that President Biden's set to talk about his infrastructure plans. Republicans criticize the idea of taxes potentially going higher. What a time for Wallet Hub to be out with a breakdown about tax burdens on a state-by-state basis. A very interesting report broke that down from Wallet Hub, looking at tax burden as a measure of proportional tax burdens by people's income, personal income that residents pay towards state and local taxes. And the breakdown shows, I guess, probably something that you and I would already know, Akiko, that New York is one of those states levered highest to when it comes to tax burdens here, number one in the country, followed by Hawaii, Vermont, Maine, and Connecticut. On the flip side, though, lowest tax burden states included Alaska, Tennessee, Wyoming, Delaware, and New Hampshire, which really loops in all kinds of things. Property taxes, individual income taxes, and sales and excise taxes is what we're talking about. That goes into the calculation of tax burdens here. And also interesting, Akiko, to point out, we talk so much about red and blue states, but that was another point of this Wallet Hub finding, that red states did in fact have lower tax burdens than blue states. Maybe not all that surprising if you think about the political discourse we're having around the tax discussion right now, but interesting to always step back and take a look at it state by state.
Yeah, I'm not sure we want to make the direct correlation to the tax increases that we're likely to hear from President Biden later today, given that the focus is largely going to be on corporate taxes there. And to your point, when you look at Wallet Hub, we're talking about property taxes, individual income taxes, and sales and excise taxes as well. But certainly a lot of attention on the tax rate, especially during the pandemic, because we have seen so many executives say they're moving out of certain high tax states, moving to a lower tax bracket or lower tax state. And as you said, it's become increasingly political because it pits blue and red states against each other.
Yeah, and I mean, to the idea of corporate taxes going up too, I think that comes down into this as well. Strangely, as everyone's moving to work from home environment, you know, you can relocate, and we're seeing headquarters relocate too. to all these states that have lower tax burdens. And I know this one includes the personal side of it, but increasingly, as everyone can work from wherever, we've talked about it a lot on this show, people moving away from California, New York to Florida, Texas, states like that, to kind of escape some of these higher tax rates. Interesting to see the way that that's all played out. But again, perhaps a reminder out there that New York sits above all the other states with the highest tax burdens. We're going to have much more coming up here after this short break, including the final conclusion of our Stock Madness bracket. We're going to be breaking that down with Ross Gerber and Ryan Payne to finally crown a winner. Will it be Tesla? Who knows? Stay tuned. We'll have the final championship battle right after this. Stay with us. Welcome in to Yahoo Finance Live. Right now, all three major indices are in the green. I'm Zach Guzman alongside Akiko Fujita as we have tech stocks, the big gainers today, even despite a weaker than expected private payrolls report. We're going to break that down in just a second. Plus, the Final Four in March Madness, all set for weekend matchups. But we're here to make money and talk stocks, of course. And we've got our Final Four set as well. Our esteemed stock pickers are back to crown a national champion in the final edition of Yahoo Finance's Stock Madness. Get your brackets ready. Won't be Tesla, won't be Cisco, TrueLeave, or Disney. Who knows? Tune in for that. Just a couple seconds away. And celebrity message startup Cameo raising another $100 million to triple its valuation across the unicorn threshold. Competition, though, is heating up, including from the likes of Facebook. Cameo CEO will join us to break down how they're staying ahead of the curve. And last but not least, online learning platform and education company Coursera making its big debut at the New York Stock Exchange. We're going to have that stock's first opening trade and an interview with Coursera's CEO as more courses move online in the pandemic. But first, let's kick things off with those private payroll numbers. As I said, a little bit weaker than expected. And let's bring in Yahoo Finance's Emily McCormick, who has those numbers for us. Emily?
Zach, U.S. private employers added back more than 500,000 jobs in March for the best gain that we've seen since September. Now, specifically, we saw private payrolls grow by 517,000 for the month of March, and that's according to ADP's closely watched monthly report. Now, this was slightly below estimates, with consensus economists looking for private payrolls to rise by 550,000 for the month. We should note that this did still accelerate from that upwardly revised gain of 176,000 jobs in February. Now, taking a look by sector for March, we saw the services sector again handily lead the way in recovering jobs, with those payrolls rising by more than 400,000. Now, some of the most badly beaten down industries saw the biggest gains last month in hiring, with leisure and hospitality payrolls rising by 169,000. So those easier restrictions around indoor dining and some other high contact services likely playing a big role there. We also saw trade, transportation, and utilities jobs rising by a notable 92,000. And even the goods producing sector posted net private payroll gains in March, with those increasing by 80,000 as some of those weather-related impacts from February dwindled and allowed hiring to pick back up in these industries. We saw construction and manufacturing jobs rise by 32,000 and 49,000 respectively, although we did see a mild net job decrease for the mining industries. Now, we should note that this report comes as usual 2 days before the Labor Department's official monthly jobs report. That release is expected to show non-farm payrolls grew by about 650,000 in March, or the most in 5 months, and include a gain of more than 600,000 private payrolls. Unemployment rate is also expected to tick down by 0.2 percentage points to a fresh pandemic-era low of 6%. But again, Zach and Akiko, many economists saying that we should brace for even more job gains in the months to come.
Yeah, it's going to be a big report when we get that on Friday. Of course, we'll have that here on Yahoo Finance. Appreciate that, Emily McCormick. Of course, the other thing that we've been watching, if you're a sports fan out there, is that the Final Four matchups are finally set for this weekend, featuring a surprise team in UCLA, the first team since VCU in 2011 to advance from the first four matchups all the way to the Final Four. And that's cool and all, but we talk stocks here on Yahoo Finance and make money. So that's why we've been waiting for the culmination of the championships in our Final Four. The stocks left in Yahoo Finance's Stock Madness, and the coaches, if you will, that brought them to the big dance are back with us today. Two money managers you know and love. We got Ryan Payne, Payne Capital Management President, and Ross Gerber, Gerber Kawasaki Wealth and Investment Management CEO, who have battled all the way to the Final Four with me and Akiko here. And guys, it's taken weeks, but here we are, down to Tesla, Disney in the East, and we got cannabis company Trulieve and Cisco in the West. And I think we should start over there on the west side of the bracket. And earlier this week, we had Dan Niles also saying Cisco is a top pick. But Ryan, I guess we'll start with you here in the Final Four matchups. Pitch me on why Cisco should be our Cinderella again.
I mean, obviously, Dan Niles heard my pitch last time, was so compelled by my brilliant insight. So you're welcome. And I think it just comes back to, again, look, we're going to go back to work. We're going to go back to the office. And you're going to see a lot of CapEx back on corporate spending on boring things like switches. And a lot of the software needs to be upgraded and switches need to be upgraded. So Cisco's perfectly positioned for this. And it's the only tech stock I can find that has a reasonable valuation. It's 16 times forward earnings. You're getting almost a 3% dividend. I know for Ross, this stuff is very foreign. He likes to pick stocks that have no earnings or, basically have hundreds of years of profits priced in. So I think, the market's going to come back to reality and investors are going to be looking for profits. You hear that word profits, Ross. I know it's not familiar to you as the economy reopens, and that's where the focus is going to be. And that's why Cisco here is obviously the winner of this tournament.
I mean, Ross, you're just you got to come back and battle.
I fell asleep for a minute there. He was talking about Cisco. And last time I think Cisco was exciting, I was 28. So the moral of the story is actually true. We're talking about Trulieve, right? So, this is a very profitable company. And I think just today they legalized cannabis in New York. So when you look at Schumer on the floor of the Senate talking about legalization and you see the enormous margins and profits that are made in cannabis, I mean, it's like not even comparable. It like Trulieve is one of the best companies in the stock market for cannabis, and Cisco is one of the oldest, most impressive companies over the last 25 years. Now, to Cisco's credit, it's always had a 16 PE. It always will have a 16 PE. Maybe they get earnings going higher. But the bottom line is it's not going to grow 100 or 150% like Trulieve.
Well, it's already up 400%, Ross. And, I don't know. I don't think the market knows that we're going to get legalization in other states. That's probably not priced in. You're right. That's probably eluded everybody. So it's
all about the
news
future. It's about the future, Ryan, and the future is cannabis.
I sense some sarcasm on the part of Ryan Payne there. That is one of the things that we have been talking about, though. In the year-to-date run-ups, right? Trulieve up 35%, Cisco up about 17%. We're not necessarily using that as a scorecard in picking a winner in these matchups, and you guys have put me in a tough spot of maybe here picking against a cannabis company that has shown real growth and real profits. But I mean, I'm not saying I'm picking them because when you look at the other side of the bracket, we got 2 picks from Ross. But Cisco is one that we heard about earlier in the week, catching some bids. Kiko, I think I got to choose Cisco here.
Wow, look at that. Kind of like, it pains me to talk about UCLA, by the way.
I'm telling Kim Rivers. I'm telling Kim.
Don't tell Kim.
They were the
Zach,
11th
I
seed,
know
but
it's
it feels,
against your morals to vote against weed.
We need one Cinderella story in there, right? Where Cisco's going to become it, maybe. Let's talk about Disney and Tesla, which is the other matchup here. Looking at numbers, of course, Disney up 2.5% year to date. We are also seeing that, we've seen the gains on the stock on the back of the strength in Disney Plus, but now we're talking about the parks reopening. Certainly it seems like all things are lining up for the company. And then you've got Tesla, which has been under so much pressure over the last few months, down 7% year to date. These are both Ross's picks. So Ross, let's start with you. Which one do you pick?
Well, I've got to pick Tesla if we're thinking longer term, because I think the bottom line is they're going to have a phenomenal year. Q1 is going to be tough for Tesla because they've got a lot of things moving at the same time. But I think when you look at the Cybertruck and the semi launch and the Austin Gigafactory completion, as well as Berlin, all happening this year, when we get to the end of the year, Tesla is going to be in a phenomenal position, and we expect their deliveries to double over the next year. So, we think in 12 months, they'll be doing over 1 million cars a year run rate. And this is very exciting. You've never seen a car company grow this fast. And we're not even talking about energy or the fact that they've cornered the market on cell production. Disney is a great company, which I love and own a ton of, but I think it's fully valued here for the reopening. So Disney Plus is a huge winner. They're going to have, I think, some struggles in the reopening, making it as profitable as it used to be with all the COVID protections. But I think longer term, Disney's in a great spot too, but it's just not as exciting as an opportunity that Tesla is.
Well,
Ryan, I know it pains you to talk about these two stocks. We're talking about growth on both ends, right? Which one do you pick?
And no pun intended with pain, P-A-Y-N-E, of course.
I know,
There's a lot of
seriously.
pain right
That
now.
was not intentional.
You
That
live
was
in
not
pain. You're a
intentional.
value guy. You
Clever,
live with pain.
Kiko. That's clever television. I like that. And, Ross, you leave me with two stocks that trade for 150 times forward earnings. Thanks, man. Thanks. And the only redeeming quality I can find between either stock is at least Disney's not trading for 20 times sales. So, given the fact that only about 2% of Americans drive Teslas, and Ross, I know you live in Santa Monica, the only place in the world people actually drive Teslas. You come anywhere else in the country.
That's not true.
No one else drives electric vehicles.
You haven't been to Shanghai, obviously. You haven't spent a lot of time in China.
Where there's another 200 electric vehicle companies. So I think competition is going to be stiff. I think, the adaptability to electric vehicles is going to take a lot longer. And I think the market's priced years upon years upon years of growth. So the less, I guess, the more palatable of two very unpalatable options, I've got to say Disney, which again, I think is a bit overpriced here too, because to Ross's point, we already know the growth is already baked in about Disney Plus. And I think there are going to be restrictions when you get back into the parks. But, if we're just trying to go with the less painful option, P-A-Y-N-A, I think we have to go with Disney on this one.
I have to say, I like how both of you have upped your trash talking over the last few weeks. I feel like maybe there's a segment beyond the March Madness
UCLA's
bracket.
in the Final Four.
But it seems like there's some agreement here, right? I mean, Ross, I heard you say you still like Disney. You think there's more upside on Tesla. And then Ryan, you're saying if you have to pick between these two, it's Disney. So I feel like you've already sort of advanced the team. And so let's go with Disney. That might be an upset, even though Disney is a higher seed. When you look at the upside on Tesla, I don't know, can we call it an upset, Zach?
I don't know if we can. And to be frank, I mean, I don't know if the seeds really mattered heading into this tournament either, but there they are in our graphic. But yeah, so that sets up our championship here. And these picks do matter because now it all comes down to finally one winner in what had started as 16 stock picks. We're down to 2. Disney versus Cisco. And Disney, interestingly, because we were talking about kind of the latter half of that, the parks reopening, you can make it a reopening value play here. And you can also look at Cisco, as we've been debating, kind of a boring legacy tech company, even in the words of the man who presented Cisco as the stock pick, Ryan Payne. So Ryan, why don't we start with you on Cisco? We know we already heard about kind of why you like it here, but really sell me on it. I mean, because we're finally here at the big dance. You got to sell me on this one, beating Ross's pick in Disney.
Well, as the old saying goes, you have to skate where the puck's going to be. And for the record, I spent more time thinking about my trash talking this week than studying fundamentals. I have to be honest. I was like, what can I say to Ross that's going to be really offensive today?
Nothing you can say.
But then I started looking into the actual fundamentals of these stocks, just for the record. And, basically, I think what it comes down to, again, is I think you have a stock where a lot of the reopening is not priced in. We haven't factored in all the CapEx spending, and invariably markets look forward. They don't look backwards. And, a lot of the reopening is really going to bleed into next year, because Ryan Payne's not thinking about 2021, Zach. Ryan Payne's thinking about 2022. And that's where capital expenditure gets really interesting. And, I think, again, because Disney has already priced that, that's basically a work from home stock at this point, because Disney Plus, you put your kids in front of the TV while you were working. It's all priced in. It's old news.
Real quick, though, Ryan, real quick, because I want to drive in on that, because we talked about it. How much of your pick here on Cisco really hinges on people going back to the office? Because that seems to be important for Cisco.
I think it is, and I think we've discounted how much we're going to go back to the office. I know personally with my firm, I'm going to keep pretty much an open door policy, but anecdotally, people are just going to the office because they want to. So I think there is a strong desire to get out of the house. I'd like to hang on the set with you at Yahoo Finance again. You're doing it from afar. It just hurts, Zach. It's just not the same.
Okay, because that's important to know, because on the other side.
Can we just acknowledge the fact that Ryan Payne's now talking in the third person? I mean, that shows you the confidence of an athlete. You're talking like an athlete now.
It's 3 weeks on TV. My ego goes like this.
It was a half-court heave. I noticed it. I noticed the shot. I'm not going to say it went in the basket. But Ross, on the other side of the pick, I mean, you're looking at Disney, which doesn't seem to hinge as much as a return to normal, because you got basically both plays. Either you got Disney Plus, and people stay at home, or you got the parks.
In fact, that's what makes Disney 100 times more attractive than Cisco, is the fact that it's got a double whammy of earnings growth drivers. And I know Ryan lives in the past because his picks are like Cisco, which was one of my favorite stocks in the 90s, actually. And the 90s were a great time if you were alive.
Weed without a weed pen. Go ahead.
But see, Ryan wasn't alive in the 90s, so he just wants to ride the past still. And so I think one of the things that investors have to think about is the future. And the future is a combination of having the greatest streaming service besides Netflix and the greatest family experience that somebody could want to take their kids to. I don't know if Ryan's old enough to have children yet, but when he does, do you have children, Ryan?
Not yet.
When he does, yeah, see, he's just not even old enough. So once you have children, you'll realize that it's not just about Disney Plus. It's about the synergy between the parks, the products, the attractions, the movies, going to the plays. I mean, it's just the synergy of Disney's unbelievable. So opening everything up again will leverage their success with Disney Plus in a way they've never had before. So with the enormous optimism we're seeing here in Southern California, with almost no COVID cases and the success we've had, Disneyland is going to be like overrun like you've never seen. So, I mean, I'm sure they're going to have security just to keep people out of that place. It's such a winner.
You want to just refreshing the Ross. The only time you're not talking about weed or gambling. First time. Really.
No, I talk about video games and kids stuff all the time too. So I do kids and I do adult. I do both.
Stock picks for all age groups.
Ross, I'm not sure about no COVID cases in LA, but there's no question there is pent-up demand.
We had 350 yesterday. That's unbelievably low.
It's going down at a rapid rate. No question about that. And to your point, there's a lot of people who've been wanting to go out. Finally, Disneyland opening up. I mean, it seems like there's a lot of upside there. You ride that with the momentum coming from Disney Plus. And Zach, I don't know. I'm not sure Cisco has a comparable business on the other side that grows at that kind of rate.
Yeah, we tend to avoid risk here at Yahoo Finance, being the network that carries Warren Buffett exclusively here. Let's just stress that fact. And after hearing these arguments back and forth and the fact that Ryan Payne referred to himself in the third person, it's very hard to go against Disney and Ross's pick here. I would say that the winner of our Stock Madness tournament here in 16 stocks going head to head over the last few weeks is none other than Disney. After all of that, we're going to go with Disney as the champion in Stock Madness.
Oh, yeah. The day gets better and better.
Despite the fact that you wanted to pitch Tesla in the semifinals, it's Disney that takes the cake.
Yeah. We're clearly going to celebrate at a casino when we reopen.
Ryan, I'll take you out. I'll take you out for a joint and some gambling when we're done.
It's on, brother. It's
Ross,
on.
we're gonna try to get you a printout of that bracket with your hat on, so in fact, you did win the Yahoo Finance.
I will post it daily next to Ryan's picture.
Yeah, although a number one seed winning seems a little predictable, right? But hey, you went at it for several weeks here. We got Disney and Cisco to the finals, and Disney it is for the winner of the March Madness or Stock Madness tournament here at Yahoo Finance. Ryan Payne, Payne Capital Management President, and Ross Gerber Kawasaki Wealth and Investment Management CEO. It's great to have you on for the last several weeks, but we hope to we'll think about another segment we can get going between the two of you.
Stock Olympics.
The void of my life is going to be so dark without this. Yeah, so we got to do something.
Yeah, enjoy your WebEx. Enjoy WebEx. Have a good time.
Great.
Congratulations,
Thanks so much,
Ross.
guys. Congratulations
Thanks,
to Ross. Thanks so much for that. All right, we're going to take a quick break, reset. Coming up, we're going to talk about celebrity video site Cameo reaching unicorn status after its latest funding round. Steven Galanis, Cameo CEO, will join us after this short break. Welcome back to Yahoo Finance Live. Let's turn our attention to Coursera and its big debut today. Shares there popping about 20%, priced at $33 a share. It's opening there above $39 a share. And we will be speaking to the CEO of online learning platform Coursera a little later in the show. Jeff Maggioncalda will join us in the next block. First, though, celebrity messaging site Cameo reaching unicorn status in its latest private funding round, raising more than $165 million. And this latest round brought in some new backers to the platform, including SoftBank's Vision Fund 2, as well as skateboarder Tony Hawk. Let's bring in the CEO of Cameo, Steve Galanis. Steve, it's always good to have you on the show. Last time you were on, we were talking about expanding your services beyond these celebrity shout-outs. You were talking about increasing engagement, having fans be able to have direct conversations with celebrities, as well as the fan clubs out there. What does this additional funding allow you to do, and how are you looking at those offerings?
Well, first off, thank you for having me. Our vision from the last time we talked remains the same. We want to build technology which enables every single talent on earth to have a personal relationship with every single one of their fans. So all of those things that we talked about last time remain on the roadmap. So not just the core Cameo video, which many of your viewers probably have used at this point or know about, but we're also rolling out new features like Cameo Calls, which are synchronous video chats. So imagine like a virtual meet and greet with some athlete or actor that you love. Additionally, we're looking to expand in other verticals right now. Historically, we've been focused mostly on the English-speaking world, but with new investors like SoftBank, we're really looking to take this to Asia, to Latin America, and other places like that.
Yeah, Steve, congrats again on the round. When we look at the competition out there too, it does seem like it's getting intense, and you guys obviously only take a 25% cut of the fees on Cameo. Some of those other platforms might be pressuring you guys to maybe change that. I don't know. Talk to me about profitability as you build out those other offerings, as you still face competition in what you've been offering and offering well, and how that maybe changes your strategy moving forward.
Well, so far with 40,000 talent on the platform, we haven't changed our take rate for anybody. So we've maintained a 25% take rate, which is a really healthy take rate compared to other businesses. We also recently added a booking fee, which is expanding our gross profit margin. So at scale, we think this is a business with closer to 35% margins, which is really healthy when you look at other publicly traded marketplaces. Additionally, we've been getting into B2B as well. Our Cameo for Business segment was the fastest growing segment, and that actually includes concierge fees that come for white glove service to SMB and mid-market clients. So, these are all things that are going straight to our bottom line. So we think like by the time we're IPOing like Coursera did today, hopefully we have some really healthy margins, and everybody's excited about how that looks.
Steve, how are you looking at competition in the landscape? I mean, your Cameo, of course, known as the place for celebrity shout-outs, but it feels like there's so many different platforms that offer a direct connection to celebrities now. It's not just about social media. You've got live audio platforms like Clubhouse too. Who do you see as your main competitor?
Well, first off, we look at that as a validation for the market we're in. When I was raising my Series B 2 years ago, it came on, it was extremely contrarian that direct-to-fan monetization would be a thing at all. And now you're seeing the rise of not just Cameo, but other platforms like OnlyFans and Patreon. Clubhouse has obviously been a sensation. Substack is doing really well for journalists. So I think like it's just really clear that in a world where there's more famous people than ever before, and the underlying business models of sports, entertainment, creation are all growing linearly, people are going to have to go direct to fan, and that's going to be a really, really big business. So we think the whole ecosystem is on fire right now, and we're just glad to be one of the leaders there.
We talk a lot about other companies out there working on all this stuff. I'm not sure if deepfakes also seem to be competitions, and some of those are getting pretty good and scary good, really, when you think about celebrities being used. But the other big tech thing that we've been talking about as well, our editor-in-chief wrote up a great long weekend read on NFTs, and you guys kind of, I guess, you can make the argument that you were kind of ahead of the curve and maybe doing some of that with celebrities profiting and monetizing, their fame through that. NFTs offer a similar route. I'm curious if that is a space that you've looked at and kind of seen maybe potential to move into that too, or if you guys are already doing it because everything you do is so personalized and individualized.
Well, number one, I think personalized and individualized is always going to be, one of the hallmarks of Cameo. Our mission is to create the most personalized and authentic fan experiences on earth, and authentic is in our mission as well. I think in a world where NFTs or where deepfakes, become more prevalent, the Cameo watermark becomes a certificate of authenticity. So we're definitely looking at how we can develop core competency there. And the NFT market is super interesting. I'm actually spending my weekend doing a deep dive on it. So we want to learn a lot about it. It's crazy how much it's popped, whether you're thinking about things like Beeple or NBA Top Shots, parent company Dapper Labs raised a big round yesterday. So the space is on fire. We're going to evaluate if it makes sense for Cameo to get into, but on the surface, it feels like something that I could totally see us getting into in the next few months here.
And Steve, every time you come on, we like to ask you about who's doing the best on the platform. What do the latest rankings tell you about? I mean, who's commanding the most money? Who's getting the most demand? Is it still Kevin from The Office?
I mean, he continues to do really well. I saw Floyd Mayweather had a really big day yesterday. So it kind of depends like day to day. But one of the things that I want to call out, our Cameo Calls product, which is the newest flagship product that we're offering, which is synchronous video chats. It's really the Weasley twins from Harry Potter, James and Oliver Phelps, who are absolutely crushing it on there. And they've been some of the early winners on the new format. So, it's really exciting to see. And then our fan club product, which is right now, it's like a new CRM that we're essentially building to help talent manage their fan base. Someone like Tom Felton, who is Draco Malfoy from Harry Potter, is really at the top of the leaderboard on this new product. So there's some new names that are going to come out as we offer new formats, but we're really excited for the whole ecosystem.
It's interesting to see Carol Baskin still going strong more than a year after Tiger King was released. But there you go, Steve. It's always good to talk to you. Steve Galana, CEO of Cameo. Coming up, staying the course in its big debut. We're talking about online learning platform Coursera coming to the public markets today. CEO Jeff Maggioncaldo will join us to discuss the future of education after this break. We've got a new entry on the Nasdaq today. Online learning platform Coursera seeing a big pop in its debut, up about 20% after pricing its shares at $33 a share. That means the company raises about $500 million there. Let's bring in Jeff Maggioncalda. He is the CEO of Coursera. First of all, Jeff, congratulations on the big debut. This is the second time you are bringing a company to the public markets. What's different this time around, and why come to the markets now?
Yeah, well, the difference is probably clear. Not only do people learn online and work online, now they do IPOs online. The roadshow was clearly very different in terms of just sitting in a room and being on Zoom. More efficient in many ways, but to some degree not quite as exciting an experience. On the question of why now, I mean, generally speaking, a company will go public when the company is in a position where that makes sense for them. Usually there's a certain size, a growth rate, sometimes a need for capital, and sometimes it's about really investing in expanding your resources and your brand. The second piece of that, of course, is the market. So the market's receptive to these types of offerings. Our early investors included John Doerr from Kleiner Perkins and Scott Sandell from NEA. They clearly have a lot of experience with these kinds of things. And we just thought that this would be a good time for Coursera.
I mean, you're certainly coming off of a year where you had a lot of momentum as so many universities were forced to go online. Your revenue up 60% last year. How do you keep this momentum going as more and more schools think about going back to in-person classes?
Yeah, I think from the earliest days when Andrew Ng and Daphne Koller, the two Stanford professors that started Coursera, when they did, they thought out over many decades, I'm sure, to say the world needs more access to high quality learning. Many trends were in place many years before the pandemic hit. There will be a new normal that emerges. We don't know what that will look like, either in terms of how we work remotely versus in an office, and how we will learn online and also on campus. But it's pretty clear that the world will never be the same again, and that online learning will be a big part of it. So we really think about the long term, all the structural reasons why people will need to learn continuously through their lives, to learn new skills as the world goes more digital.
Yeah, and Jeff, it's interesting because you're coming out at a time where obviously I think a lot of people have experienced exactly the shift to online you were describing there. It's obviously not just you guys, though. I mean, there are other companies out there as well to you. Which is interesting because they kind of shifted from, degrees to alt certificates in the education space. You guys are looking to build up, it seems like, the degree side of the business. Talk to me about how that expansion has gone and what kind of growth you see ahead if we are to return to normal.
Yeah, what we've seen for centuries is that college degrees are the most meaningful, recognized learning credential that there is. And the credential type hasn't really innovated that much over the last period of history. We think with technology, the ability to create not only degrees, but other types of credentials, those are professional certificates and industry certifications, even things that we call specializations, that the world will be populated with both new forms of degrees that are more affordable and flexible for working professionals that can be earned online, but also other credentials like professional certificates and certifications. It will be a portfolio of credentials, we believe, that will serve lifelong learning needs in a world where people need to keep learning even as they're working.
Is there
Jeff,
more, more, when we talk about monetization on that, sorry, Kiko, when we talk about monetization on that front though, talk to me about how those might actually bring in more dollars. Because you look at the revenue from a 2U, and that was up 83%, at least when you look at their alt cred side. But fiscal year 2020 revenue is up 35%, north of 750 million. You guys were at 294 million last year. So talk to me about kind of how much upside there is relative to these alternative certificates in the education space.
Yeah, it's hard to really break out. We don't know how the landscape will shape out in terms of which credentials are the most valuable for different people at different parts, at times in their lives, and in different jobs and in different regions. We do believe that there's going to be a portfolio of credentials that meet the needs of a lot of people. We see, especially in emerging markets, college degrees are very important. And still, though, these alternative credentials, as you say, will be an important on-ramp into digital jobs for people who don't yet have a college degree. So it's not really clear which credentials for which people will be those stepping stones, but we do believe over time, most people in their lifetimes will earn a number of credentials, including college degrees and industry certifications as well.
Jeff, you've already touched on a number of pillars that the company operates on. Direct to consumer, of course, one that I think our viewers are most familiar with. You've got the enterprise side as well as the degree programs. Which one do you find the most stickiest? And ultimately, you've got a lot of users that came on board during the pandemic. How do you convert them into paid users?
Well, what we've seen is, as you say, about 30 million individuals registered on Coursera in 2020. So it grew from about 47 million registered learners up to 77 million learners by the end of the year. Now, what's going to be interesting is it's not necessarily the case that in the first day or week or month or year, people will need a learning credential. Sometimes it might be many years later that someone decides it's time for me to get a college degree, or I'm in a technical field and I'd like to get a new certification, or maybe I have a bachelor's degree and I'd like to get a master's degree. So converting and providing services to learners, we believe, is sort of a lifelong opportunity and a lifelong, almost obligation for us to really meet the needs of people from the day they start college until the day they retire, and even beyond that. So in terms of stickiness, I think it'll really depend. I do see a world where college degrees are not going away. They will be reinvented. They'll be more affordable. They'll be more flexible. They'll be earned online so that people who are working don't have to quit their jobs. It's one of the most expensive things about on-campus degrees, especially master's degrees, is quitting your job. With online degrees, you don't need to quit your job. It's a lot more flexible in that way.
Yeah, you guys obviously already have a lot of people coming to your platform, and I assume it would be pretty easy to leverage that and work with partners to approach profitability, but not there yet. The net loss has actually increased to 67 million from 47 million over the last 2 years. But talk to me about where profitability comes in your guys' timeline now that you are a publicly traded company, and investors do like to see that. So how quickly do you think you can reach that threshold?
Yeah, well, it's not something that we're really racing towards. What we typically do, as most growth companies do, is really think about what's the size of the opportunity and the size of the need. Let's make sure we have the resources and invest the resources to not only create great products and great content and great credentials for people to learn with, but also the technology that supports it and the marketing and sales that helps us reach people. We're at the very early stages of a global need that we think is going to persist because of technology and globalization, where many, many more people are going to need access to high quality education. So in these growth phases, we typically focus most on making investments for the long term. We focus a little bit less on the profitability piece. As a percentage of revenues, obviously, we are trending towards profitability, and we think we're in the range that we're pretty comfortable with at this point.
Jeff, I was thinking back to a conversation we had early on in the pandemic when we saw so many universities struggling financially. You said that you thought there was going to be a lot more consolidation in the space, especially among smaller universities, and that Coursera could provide additional support there. How much of that has actually materialized? I know we're only talking a year here, but it feels like there has been a dramatic shift in higher ed overall.
There's definitely a big shift. I mean, the big part of it has been COVID related. The idea that most professors had never taught online and most students had never earned, university, college credit online. Suddenly every teacher teaches online. Now every student has learned online. What we see with universities, and it's different in different parts of the world, but in the US, and I think this is true for most parts of the world, the rise of alternative credentials, of boot camps and other types of specializations that you can learn online is really stepping up the bar of expectations that students have as to the quality of education and the currency. When I say currency, how cutting edge, especially in computer science and data science, how cutting edge the curriculum is. Coursera is turning out to be helpful for universities who are trying to make sure they're keeping up with the latest advances in computer science, data science, business practices, et cetera. And in that way, we are really an enablement partner with universities who are now seeing a faster changing world that's moving online and more alternative credentials out there that learners could seek rather than going to college.
Well, things on day one seem to be going well. Appreciate you coming on here to chat with us today. The CEO of Coursera, Jeff Maggioncalda, thanks again for taking the time. Be well. We're going to take another quick break here on the show, but when we return, an interesting partnerships being formed here between two giant cybersecurity companies in CrowdStrike and Zscaler. We're going to be discussing that and what they're working on after the break. The CEO of CrowdStrike, George Kurtz, will join us once again. Stay tuned. We're back after this. Welcome back to Yahoo Finance Live. Two big cybersecurity darlings of last year, CrowdStrike and Zscaler, both up more than 300% in 2020, are teaming up in a new partnership as Zscaler becomes CrowdStrike's first cloud security partner to leverage CrowdStrike's tech to enable secure access to applications from any endpoint, regardless of the user or location. And joining us now for more on that partnership is CrowdStrike CEO and friend of the show, George Kurtz. And George, good to be chatting with you again here. I mean, it's always interesting to see some of these companies in the cybersecurity space pairing together. So talk to me about what this partnership does for both you guys and what each brings to the table here.
Well, great to be here. And when you look at what each of us bring to the table, we're a leader in endpoint and workload security and protection and visibility. And if you look at Zscaler, they're a leader in network security and cloud security. So customers, we have many joint customers together. They want us to continue to work together and really focus on helping secure access. So if you look at what this particular announcement is focused on, we have a very good view of the system health. What is your computer state? Is it healthy or not? The identity of the user that's logged in. We do a lot of analytics on that. We create a score, and we can supply that score to someone like Zscaler or another partner that'd be able to use that to drive conditional access requests. Should they be allowed on the network? Should they be allowed to a certain application, et cetera? So we're very excited about it, and more to come.
It certainly sounds like there's a lot of synergies there between the two companies, but I wonder how much of this is dictated by the evolving threat, out of necessity, really, the evolving threat that we have seen on the cyber front.
Well, the threat landscape continues to evolve, and it continues, unfortunately, to get worse. 2020 was a pretty bad year, certainly in the pandemic, and what we've seen is a lot of e-crime actors take a lot of the techniques that the nation-state actors use, and they've been able to weaponize those and deliver those. In particular, one of the worst trends we're seeing is really ransomware, and I think that's very obvious to anyone who reads or watches the news. Just the impact that can happen. It's no longer just a single computer getting infected. It's entire organizations being brought down and compromising the resiliency of their overall operation. So the more that we can supply in terms of visibility and telemetry that others can use to make decisions outside of just our view of the endpoint and workloads, the better for our customers.
Yeah, and George, I mean, when we talk about it too, you come on here all the time. You keep telling me that the pandemic, the growth that you saw in the pandemic isn't going to slow. Each time I say, is that really the case? And each time you keep proving me wrong on that front. And it was interesting to see in your guys' latest investor presentation talking about the percentage of subscription customers you guys have with 4 or more cloud module subscriptions. So those ones who are already existing and keep adding. It was up from 30% in 2018, 63% now. So talk to me about maybe it's not just adding new customers for you guys at CrowdStrike, but also the way that they're interacting with what you're offering and adding that ability to protect themselves as we get farther and farther back to normal.
Well, that's true. As we talked over the last year, we certainly viewed this pandemic as an accelerant to digital transformation where you need security transformation to go along with it. And I think we've seen that play out certainly in our results. And I do think it's a sustainable trend. When you look at the platform itself and you look at the attach rates for various modules, 4 more modules, it's amazing how many customers are using the modules that we have. And I think that's just reflective of the platform that we've built. We always like to say we're the Salesforce of security, who, by the way, became a customer. We announced that in our last quarterly update. But that really lends itself to the security platform of the future, right? So we create modules based upon the data we collect, which is over 5 trillion events per week. And then we allow customers to interact with that. And it could be anything from endpoint security all the way to identity and threat intelligence. And we started with 1 when I built the company, and we're up to 19 right now.
George, there's no question the digital footprint of individual companies has drastically expanded during the pandemic, largely because the market has dictated it, that so many people needed to go online, build out their digital strategy. I'm curious what the investment outlook looks like for a lot of these companies that beefed up over the last year. And what do you think has been the fundamental shift in terms of how these companies see the importance of cybersecurity?
Well, I think there's a couple of big events that really have focused how important cybersecurity is and will continue to be. Obviously, the Sunburst attacks that we saw at the end of the year and some of the latest Microsoft attacks on the Exchange servers. And I think that's just, those are just 2 topical areas that we can focus on. Obviously, this has been building up for some period of time. But given the importance in the boardroom, and it's the 1 or 2 top topics in any boardroom right now, companies are saying, okay, we're digitally transforming, we're moving to the cloud, we're containerizing, we're going to a SaaS architecture. We need security that can keep up with that. And again, that's one of the reasons I think we've been so successful is because we have the ability to secure these endpoints and workloads wherever they are. And for me, I think it's just, again, reflective of where companies are going, needing a partner like CrowdStrike, and having technology that's contemporary, not outdated like a lot of the legacy providers.
George Kurtz, CrowdStrike CEO, always good to have you back on the show. Appreciate your time. And we'll be right back.
Welcome back to Yahoo Finance Live. Right now in the session as we approach 1 p.m. Eastern, we got all three major indices in the green. The Dow, the S&P, the Nasdaq up. You can see the Nasdaq, the biggest gainer so far, up just shy of about 2%. We're also watching shares of Walgreens, one of those big companies, out with earnings as we continue to watch how earnings are going to shape up here. You can see shares up more than 5% after that company topped expectations. The company also increased its guidance for 2021, saying it expects mid to high single-digit growth versus its prior estimate of low single-digit growth. Of course, that company is being watched as its new CEO comes in and takes over where Walgreens will go in today's session, enjoying a nice 6% pop. We got much more on the show. We're back in 2 minutes. Stay with us.
Welcome back to Yahoo Finance Live. You are watching their shares of Coursera, seeing an 18% pop roughly in its debut on the Nasdaq. And Zach, you know what's interesting to me? I saw this pop and I thought, we're so used to seeing these significant jumps that we see in some of these startups on its debut, but certainly looks like this was priced fairly right here because they did price in the higher range at $33 a share. We just spoke to the CEO, Jeff Maggioncaldo, talking about the opportunities in this space. Feels like there's a lot of momentum, especially given the last year.
Yeah, and also giving a nice pop to competitor 2U as well. And that's kind of the question. We opened the show, Akiko, talking about Chewy and the idea of some of those beaten down names, things that have done well in the pandemic, the stay-at-home plays. This one seems to be one of those as well, but investors on board with the idea that we're still going to be learning online, buying pet food online. So maybe that trade not over just yet. But that'll do it for us here on our hours on Yahoo Finance Live. Stay tuned, though. We got much more coming your way. Krista Myers will pick up the action to carry you through the trading session right after this.
Good afternoon and welcome to Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous. Here's today's top news. President Biden will unveil his large infrastructure plan later today, and the package is estimated to cost more than $2 trillion and will be funded in part by a spike in the corporate tax rate. Now, the plan is expected to boost economic growth by more than 6%. And according to the CDC, coronavirus was the third leading cause of death in the United States last year. That's behind heart disease and cancer. But in good news, Pfizer's vaccine is found to be 100% effective in children aged 12 to 15 years old. And the labor market recovery continues to limp along. ADP's monthly report found private employers added back 517,000 jobs in March. Now, that's slightly coming under expectations. So there's a lot of information here for the markets to digest right now, Alexis.
You bet. And, you know, this is a busy day for Wall Street, Kristen, because we've got the final day of the month. It's also the final day of the quarter. We could see a little window dressing going on here as money managers try to pretty up their portfolios. Right now, we've got stocks higher across the board. We get a load of the Nasdaq, right? Those tech stocks, they're bouncing back from the sell-off we saw over the past few days as we continue to see investors oscillate between those value stocks and the growth stocks. The Dow is up 51, S&P up 32. This would be the S&P second straight month of gains there for the S&P 500, by the way. And the Nasdaq Composite, strong tech rally led by Apple, up now 243 points. We have got shares of big banks. Some of them still declining, others, though, trying to bounce back from those losses we saw earlier this week. And I want to bring your attention to some trending stocks today. In fact, the number one trending stock on the Yahoo Finance site, Chewy. Now, the stock is surging after the pet products retailer turned a surprise profit in the quarter, a profit of 5 cents a share versus a loss of 15 cents a share in the prior period. Also, as you can see there, Walgreens Boots Alliance, it is having a pretty nice day and leading the Dow higher. The pharmacy giant beating earnings estimates, also raising its fiscal 2021 guidance. And we also have Delta Airlines. Now, Delta was higher earlier today. The big news here, it's going to remove the middle seat for passengers beginning May 1st. It's following a lot of other airlines in doing this as more people get vaccinated and feel more comfortable traveling and taking to the skies. Also got to show you cannabis stocks. They're lighting up after New York lawmakers formally voted to legalize and regulate recreational marijuana for adults. Governor Cuomo expected to sign that into law, making New York the 15th state to legalize recreational marijuana. Don't get too excited. It's not going to happen until 2022, even after he signs it into law. Let's get a quick check of the bond market. The yield on the benchmark 10-year Treasury note is relatively flat now. That's down to 1.71% compared with 1.72% on Tuesday. Kristen?
All right, let's go now to our chief political correspondent, Jessica Smith, and get the details of that massive infrastructure plan, which is sure to meet opposition from the business community given those corporate tax spikes. Jess, what do we know so far?
Well, President Biden is going to unveil this proposal later this afternoon in Pittsburgh. This is going to be the first of two long-term economic recovery plans that the White House is going to put forward in the coming weeks. This one is a $2 trillion infrastructure package, and it does have tax hikes and changes to the tax code in order to pay for that. The spending will be over the course of 8 years, according to the White House, and then the tax changes will fund this bill in 15 years. So what it includes is more than $600 billion for transportation infrastructure. Think highways, roads, bridges, airports, a big investment in the electric vehicle space. It also has $300 billion for modernizing water systems, replacing lead pipes, updating the nation's electric grid, and expanding broadband access. All of those things are going to have a focus on clean energy. There is also hundreds of billions of dollars for affordable housing, for workforce development, for R&D aimed at boosting U.S. manufacturing and strengthening U.S. supply chains. And of course, the big question that we have been asking over the past couple of weeks was how the administration wants to pay for this. President Biden says he wants to raise the corporate tax rate to 28%. That's up from 21%. He wants to increase the global minimum tax for U.S. multinational corporations to 21%. He also is proposing measures to keep companies from using tax havens or offshoring jobs and profit. He also is asking Congress to end tax breaks for fossil fuel industries and ramp up IRS enforcement of corporations. Now, as you mentioned, this is going to face pushback from the business community. We've already heard from the U.S. Chamber of Commerce, who called these tax hikes dangerously misguided. In a statement, they went on to say that they will slow the economic recovery and make the U.S. less competitive globally, the exact opposite of the goals of the infrastructure plan. We are also seeing a little bit of pushback from progressives as well. Congresswoman Alexandria Ocasio-Cortez says the plan is not nearly big enough. So we're waiting to see how President Biden plans to try and push this through Congress, how he plans to work with lawmakers. It's looking more and more like Democrats will have to use reconciliation, the process that would allow them to pass this without any Republican votes. But we'll hear more about what the president has to say about that later this afternoon. Alexis and Kristen.
All right. Thanks so much, Chief Political Correspondent Jessica Smith, for bringing us all of those details. Of course, that plan is going to be unveiled a little bit later this afternoon. Yahoo Finance Live, of course, will be keeping up with the coverage on that infrastructure plan. Now, the city of Oakland is following in the footsteps of cities like Stockton, Richmond, Mount Vernon in piloting guaranteed income programs. But unlike some other UBI programs, Oakland is doing it a little bit differently. To qualify in the city, families must identify as people of color. We have Oakland, California Mayor Libby Schaaf here with us now. So, Mayor, why was it so important to really tie race into the qualification for this program, especially as so many cities that have been piloting UBI have really just been focusing more on low-income households, more so than low income and race?
Well, we are hoping that demonstrations like Oakland are going to lead to a federal policy. And so we want to learn things so that we can develop the best policy, the most effective way of letting families live in dignity and get to self-sufficiency. And we have a well-documented racial wealth gap in this country, 10 times asset poverty. We have in Oakland documented 3 times a difference in median incomes between our white families and our Black families. And so as a demonstration, as a piece of this policy development, we believe that we can contribute to the question of how to close the racial wealth gap, as well as designing a program that's going to work for the families that are facing the most barriers. That is an equity approach, and that's what Oakland stands for.
Mayor, I know I'm sure you're very familiar with the critics of universal basic income who say it disincentivizes people to go out and work. It doesn't help make them financially independent. What have you found in your own analysis when you saw what other cities were doing when it came to UBI?
That's why these demonstration projects are so important, not just for policy change, but for narrative change. We were so impressed when Stockton's demonstration showed that people receiving a guaranteed income got full employment at twice the rate as those who did not. And it vastly improved their mental health, their capacity to care for their children and actually go out and get that certification to get a higher paying job. It actually accelerated self-sufficiency. And that is something that everyone should be in favor of.
Mayor, is Oakland considering expanding this program to white households, perhaps, that are lower income in the future?
We are intentional about who this program is for, who we are targeting as we do our outreach. Of course, anyone can submit an application. We will randomly select the families that get the $500 per month, no strings attached, for at least 18 months. This is something that cities across the country are really excited about. We believe this is one of the fastest and most transformative ways to close the racial wealth gap, but more importantly, to help families raise children that are going to have upward mobility economically and let every family thrive. Everyone should be in favor of that.
Mayor, can you share with us a little more about how you're funding this initial pilot program. And I know the intention is not to make it permanent. So what would you be looking for from the federal government if you were to do this on a longer term basis?
We are very lucky to receive 100% philanthropic funding for this demonstration. No taxpayer dollars are going into this experiment, which will be rigorously studied. And it is that evaluation, it is the findings from demonstrations like Oakland's, like Stockton's, and like cities across the country that we hope will inform a federal policy. Of course, we have things that are very similar. The child tax credit, the earned income tax credit. These are all ways to try and help even that playing field and recognize that even our hardest working families are not meeting their basic needs.
So, Mayor, you know, considering that you are looking to reduce that racial wealth gap, you know, we've been talking a lot about Evanston, Illinois recently because of the reparations that they've decided to enact there. I'm curious to know if a city like Oakland would consider doing something similar.
You know, the truth and reconciliation process is one that I think every community should go through. And when we think of reparative policies, and in fact, even Biden's infrastructure bill that he's announcing later today makes reference to systemic inequities that have been baked in through policies. And in the infrastructure plan, he references exclusionary zoning policies. We have to recognize that poverty is not a personal failure. It's been a failure of our policies and our systems, and that repairing those systems is an important part of our journey to justice for all Americans.
And Mayor, you brought up infrastructure. We're all waiting with bated breath to hear from the president around 4 p.m. Eastern when he gives the details of that $2 trillion infrastructure plan. What are you hoping for in particular for your city, and what would you plan to do with some of the money allocated to you if you can?
Oh, we are very excited about this announcement. Again, something that I think is different from what we've seen from past administrations. One, a recognition that affordable housing is infrastructure. In California, we are in desperate need as we grapple with a homelessness epidemic. I'm also excited about his commitment for climate change work and to really take seriously our commitment to the Paris Climate Accords and our collective need to stop global warming. And then, of course, very proud to recognize that some of the jobs investments also would invest in evidence-based violence reduction initiatives like Ceasefire, which Oakland has had tremendous success with in reducing gun violence in our city. These are just a few of the innovations that I'm seeing in this infrastructure proposal, what we've seen of it so far. And then, of course, the Bay Area needs transportation investment. Oakland is home to one of the busiest ports in the world. Getting our goods moving and stopping the congestion and pollution is something that we all will look forward to.
All right, Oakland, California Mayor Libby Schaaf, thank you so much for joining us today. And coming up, promising data from Pfizer shows that their vaccine is 100% effective in children. We'll be bringing you those details next.
Welcome back. We got a sobering statistic today in the fight against COVID-19. According to new analysis from the CDC, coronavirus was the third leading cause of death in the United States last year after heart disease and cancer. The data also showed that overall death rates were highest among Black and Native Americans, adults ages 85 and older, and men. Joining us now is Dr. Cedric Dark. He is associate professor at Baylor College of Medicine and a board member with Doctors for America. Dr. Dark, thanks so much for being with us. Just would like your reaction on what we heard today from the CDC.
Well, it's not a surprise. We've had a very bungled effort at the beginning of the coronavirus pandemic, and it led to many unnecessary deaths. As you said, COVID-19, the third leading cause of death for the United States. It's neck and neck with cancer mortality. It's pretty sad that that's the case. Hopefully this year we'll be able to get a handle on it with the vaccines that are rolling out and be able to see that the mortality and morbidity from this disease will decline.
So, Dr. Dark, considering that coronavirus is the third leading cause of death, and very worryingly, we're seeing these spikes of cases all around the country, which of course has caused us to have the debate of if we're in the middle of another wave or if we're at the edge of another wave. Wondering what we should be doing in terms of restrictions, if any, mask mandates, et cetera, especially as we see a lot of states around the country essentially move forward with reopening plans.
Yeah, here in Texas, our governor reopened the Texas economy 100% about 3 weeks ago now, or announced it 3 weeks ago. And it's been closer to about, that's actually 3 weeks ago. And you know, I personally was suspicious that we were going to have another spike. I'm pleasantly surprised that our numbers have continued to decline in terms of hospitalizations, mortality, and I think that's been a great thing, even though it's really concerning. Right now, the latest numbers here in Houston indicate that our COVID cases are slightly starting to level out or maybe trickle up a little bit. And I think people do need to be cautious. We need to continue to wear masks. People need to try to stay away from crowds if at all possible. The biggest thing you can do is, if you're eligible, and everybody in Texas right now that's an adult is eligible to get the vaccine, is to get vaccinated. And if we can do that, if you're vaccinated, you can actually expand your bubble to other vaccinated persons and socialize with them in a safe manner, according to CDC guidelines.
You know, Doctor, I'm hoping you can clear something up for folks where there has been some confusion about if you have been vaccinated, is there still a need to get tested? Because we know that the vaccine doesn't completely stop you from being able to be infected, and there are so many asymptomatic cases. So where do things stand, or what are the CDC guidelines when it comes to, yes, if you've been vaccinated, should you still be getting tested?
If you're vaccinated, if you are experiencing symptoms that are consistent with COVID, you should still get tested, because the vaccine doesn't eliminate the possibility of catching the disease. It just reduces it markedly. And that's one of the things that we can do. But we still, if you become symptomatic, you do need to get tested still. One of the nice things about the COVID vaccines, I've seen some of the preliminary data that suggests that the likelihood of asymptomatic transmission is even reduced, which is one of the things that COVID has been very dangerous, because it's been spreading person to person without people having symptoms. So if that trend continues, that can be a welcome sight for the conclusion of this pandemic.
So, Doctor, speaking about vaccines, I want to ask you about vaccine hesitancy. This is something that, you know, a lot of my friends have been chatting with me about, something I've been chatting about with my parents, my other relatives. A lot of them saying, listen, I know vaccines are good for you. They, you know, believe in vaccinating their children, have gotten vaccinated themselves, but are still a little bit hesitant and a little bit nervous about getting vaccinated with something where we don't have these long-term studies, this long-term data. As you mentioned, what we have a lot of is preliminary data. So how would you address those in that crowd, in that camp? Women, for example, that are concerned it might impact their fertility. Now that we have states opening up vaccines to all adults, what would you tell those that are saying, you know what, I would rather be one of the last people to get vaccinated?
You know, I'm not going to, look down upon somebody that wants to wait and get their vaccine towards the end. I actually was hanging out with one of my colleagues who's a neurologist, and one of the things he told me is, you don't know what you don't know, and that's true. We don't. Fortunately for him and for many people, if you're able to stay isolated and avoid coming into contact with folks, maybe it's okay for you to wait. But for everybody else, if you are a service worker, someone like me that works in an emergency department, someone that's coming in contact with people outside your own home, and you can't isolate away from everyone else, you need to get the vaccine, because in my interpretation, it is far more risky to catch this disease and deal with the long-term consequences of it, even if you survive the illness, than it would be to deal with any potential unknowns that we might have from this vaccine. Many people are afraid of things like mRNA technology. It is safe. The data that we have thus far, it's not long-term for this particular vaccine. However, this technology has been in use for many years now in trials, and it has been deemed safe in those trials. And so hopefully people will be reassured by knowing that it is safe for them to get vaccinated. Now, when you talk about vaccine hesitancy, one thing I do want to mention, a lot of it, early on in the pandemic, we were very concerned about vaccine hesitancy, especially in communities of color, that in the past, the medical industry has taken advantage of. Right now, the biggest problem seems to be getting vaccines, making them available to people that actually do want it. Most of the people that I've spoken to do want to get vaccinated, and they've just had a terrible time trying to get it. My sister, who lives in Atlanta, had to travel to Macon, Georgia to get a vaccine. She was actually looking to get it in Alabama at one point because that was the easiest thing for her to do. And so what we need to do is ramp up our vaccination capacity and to give vaccines to the people that want it as quickly as we can.
How true it is. Myself and my family going through the same thing right now, trying to nail down a place to get a vaccine. Dr. Cedric Dark, thanks so much for being with us. Coming up next, we're going to hear from the legendary rapper E40. He's going to stop by to talk about how he is building his spirits business empire. That and more right after this.
Welcome back. Our next guest might be most well known as a musical artist, but he is so much more than that. He's an entrepreneur and a prolific investor. So let's bring on Earl Stevens, also known to many as E40. So Earl, we do want to get to those investments and some of your businesses in just a moment. But I've been listening, and we were chatting about this in the break. I've been listening to your album Practice Makes Paper a lot, and in it you highlight female entrepreneurs. You talk about diversifying your financial portfolio. You talk about business. And you've also been making a lot of space for other Black entrepreneurs. It's something that I've seen you doing on social media. And I don't think a lot of people expect this of artists, especially Black ones. I'm wondering why it's so important for you to be so involved and to talk so openly about Black economic prosperity.
I think just being Afro-American, what they call an OG, you know what I mean? Doing it for so many years, I just want to be a good example to the new generation, an inspiration to the new generation, and show them that you can, diversify your portfolio. It doesn't also always have to be about just music.
Yeah, it certainly doesn't. You're showing us that for sure. You started out with wine a few years back. You've now expanded into all sorts of spirits, cognac and tequila. You own 100% of your spirit brands. That's very intentional. Tell us why you're doing that when you may have been able to go out and get some other investors for the company. Why did you choose not to do that?
I did the same thing with my music career back in '88. I chose to invest in myself, you know what I mean? And it's just really the same hustle, different product. And I'm, being from the Bay Area, opportunities, didn't fall in our lap that easy. It never did. We had to go get it. So I consider myself a go-getter. You know what I'm saying? A fetty fetcher. You know what I'm saying? So I'll go get that bread. So that's what it's about. And so basically, it was it wasn't by choice. It was by force. And so now it's by force, and I'm so immune to it. I'm used to it that I'm like, hey, I can do it all myself. I don't need no investors. I know plenty superstars and people with money and all that. I'm like, I'm cool. It's nothing wrong with having partners. It's just in this particular, in adult beverages, I don't want any.
So how is the wine business going? And as you're talking about, chasing more paper, what's coming up next? Would you be interested in doing something like a SPAC, for example? We see a lot of artists, a lot of athletes getting involved in that space.
I couldn't hear you when you said getting into what?
SPACs. So would you consider taking a company public?
Oh, yeah. Later, but not now. I'm 7 years in. I'm doing very well. I just signed a multi-state contract with Southern Glazers Wine and Spirits. So instead of me being in 17, states, now I'm about to be in like 41, and that's just all from the ground up, from the grit, getting my license in each state slowly but surely, because some states are controlled states and some states just some of them is easy to get in and some of them are much harder. So I've been doing this for 7 years, and now it's the perfect time for me to take it to the next level. So, who knows in the future? Of course, I'm so creative, and not to be a me monster, me, but I'm so creative, and I thank God for everything, all my creativity and everything, that I can sell my whole portfolio, to one of these big companies, cash out, and create a whole new one that's very interesting and the same thing I'm doing now, so ain't no telling us what Jack told Helen what the future holds.
I want to ask you about NFTs. A lot of musical artists have been getting into this, athletes as well. Would you consider pushing more into the crypto space, selling NFTs next?
Yeah, the NFTs really is, it's new to me by about a month and a half maybe. And I've talked to a lot of credible people, and I have so many things that I can do with NFT. I'm in a group called Mount Westmore. We're thinking of NFT things and so on and so forth. So we'll see.
I know that you are a serial entrepreneur. You're involved in one way or another with dozens and dozens of startups. What's something a startup has to have, Earl, in order for you to get involved?
Well, it's always good to be involved in a startup, a company from the beginning, early stage, and to also, know who's already in it with you. Like if it's somebody that's been in it for years and been getting a bunch of companies or a couple or 2 or 3 big companies acquired and, or IPO, saying it's like always good to know that you're, in the same syndicate as them, or in the same startup investment as them. So yeah, that means a lot. And what it is it's early stage. You get in early, you get in early, you're going to wake up early in the morning and get a phone call one day saying, hey, it got acquired, or, the IPO last night, congratulations. And that's when you take you a sip of that good red wine, Earl Stevens.
Oh, it looks good. You're making us jealous now.
I know.
So look, I know you're focused, still very focused on your music. You've got your hip hop supergroup with Snoop Dogg, Ice Cube, and others. How has this pandemic impacted your ability to get out there with the fans? And when do you hope to start getting back into concert?
Well, thanks to social media, that's how we stay connected with the fans during this whole pandemic. I call it the pandemic, but pandemic. And so, with all my fans, they show tremendous support, and I can't wait to get out there on the road. What it has done for me, during this whole thing is, it gave me time to, work on my passion projects, to think more, focus more on my adult beverage empire, and also my music as well. I have 2 studios in here. And, I have a built-in engineer, which is my youngest son. He's 26, and he has been such a blessing. I guess that's why you have kids, to be right there for you, because he's right there, And so, I can't wait to get out there and, hit some of these major sporting events, be on the court side at the Warriors games, be behind home plate at the Giants games, be on the 50-yard line at the 49ers game. I'm a big sports fan as well. And, but I want to get out there and perform and show my fans some of my new stuff and let them get a dose and let them know how much I miss them, and I hope they miss me.
All right, Earl Stevens, aka E40, thank you so much for joining us today. It's been an absolute pleasure.
Thank you so much. Thank you for having me.
Absolutely. And coming up, private payrolls figures came in lower than expected. We'll be chatting about that next.
Welcome back. Time is flying because it is the final day of the month, also the final day of the quarter, and we're seeing a pretty nice performance from stocks. In fact, the S&P 500 has reached an intraday record high, up now 35 points, knocking on the door of 4,000. The Dow is up 70. We've got the Nasdaq off to the races as investors pile back into those recently beaten down tech stocks, up now 2% or 265 points. I want to bring in Katie Nixon now. She is CIO at Northern Trust Wealth Management. And Katie, before we get into the nitty gritty of the markets, would just like your view there at Northern Trust about this infrastructure plan that we're waiting to hear about later today from President Biden. You know, some economists are saying it could provide a sugar rush for the economy. What's your take on it?
Well, it would be a sugar rush on top of a sugar rush. We're taking it as it comes. We look forward to hearing more of the details at 4 o'clock this afternoon. And then we sort of view this as the beginning of the beginning. This is a very complicated and very large plan with both revenue and costs associated and tax increases associated. So it's going to be complicated. And there's no sense of emergency the way there was with the American Rescue Plan. So this is probably going to take some time. We would view what we hear today as sort of the first bid. And we'll take it from there. But clearly, there will be something done this year on infrastructure.
Wondering what kind of tailwind or perhaps even headwind this might provide the markets going forward. Economists have estimated, or at least according to the Biden administration, that this could boost economic growth by excess of 6%, which of course is great news. But we know that there is definitely going to be a fight on this, especially as this plan has baked in these corporate tax rates, a hike on those to 28%. So what are you expecting for market reaction going forward from this plan?
It's such a good point you raise because there are headwinds and tailwinds associated with this. And that's on top of what is sort of a cross-current economic environment that we have already, with a lot of investors and certainly the bond market getting a little bit nervous about inflation, even without the infrastructure plan. So yes, this is going to add complexity and perhaps confusion to an already uncertain environment. And it will really rely on the contours of the plan. What will happen immediately? What has a longer tail? A lot of the things that are in the infrastructure plan do have a very long tail in terms of how they'll be chunked out over time and what the ultimate economic impact will be over time. So we'll have to see when we get the details. But you raised the right question, which is, will this add more fuel to an already pretty hot fire?
And I think you hit the nail on the head when you talked about inflation. I mean, this infrastructure plan, for all the good that it is expected to do, could also stoke inflation. I'm wondering what you're doing with regards to your client portfolios as you try to hedge against that impending rise in inflation. And when do you think the Fed might have to react? The Fed's still saying they're not going to have to raise interest rates until 2024, but some economists and strategists are saying it's going to have to be earlier than that.
So we actually side with the Fed on this one. We agree, and I think there's a growing consensus that the inflationary push that we're going to see over the next few weeks and maybe even months will be transitory. It's going to be a result of that sugar rush that we talked about at the beginning of our conversation. We do think that will be transitory. Our base case is that once we get past the effect of the stimulus and once we get to the other side, whether it's 2022 or even early 22 or even later and into 2023, you're going to see these things really tail off, and sort of the base effect that we're worried about right now will completely reverse, and we'll have sort of this base effect that's going to take inflation down perhaps below trend. But longer term, we believe the sort of structural impediments to inflation remain in place. The debt that's only gotten higher, demographic challenges that have only gotten more acute, and this increased use of innovation that's been really accelerated by the pandemic. So we see these things as structural ceilings to inflation over the intermediate and longer term. That said, I think it's only fair to admit that we are in uncharted territory. And as we were just chatting about the infrastructure bill, that could change the dynamic over the next 12 to 24 months if we see some of these programs have longer legs. So we'll see. Right now, our base case remains stagflation. It doesn't mean that we don't want inflation protection in our client portfolios, though. And one way that we've been getting that is through global natural resources, equities. So we have, on a tactical perspective, a double weight right now to global natural resources. And there you get kind of the best of both worlds. You've got the equity beta, and we're constructive on equity markets, but then you also have the protection against unanticipated increases in inflation. And that's really what we want to protect our clients against if our base case turns out to be wrong.
All right, Katie Nixon, CIO of Northern Trust Wealth Management, thanks for being with us. And don't go away, because on the other side of the break, the LA Rams safety Taylor Rapp is going to join us to talk about launching his very own NFT to help the Asian American community. We're back after this.
Welcome back to Yahoo Finance Live. We are sadly seeing a rise in anti-Asian hate and attacks. And here in New York, a man was arrested after his brutal attack of a Filipino woman was caught on camera. Now, our next guest, hopes to do something about it using NFTs to fight racism against Asians. We're joined now by LA Rams safety Taylor Rapp. So Taylor, you're launching these NFTs tomorrow, and will donate a portion of the proceeds to organizations as a part of this GoFundMe to stop Asian hate. Why did you decide to go this route, selling NFTs instead of, just making a donation or publicizing the campaign?
Yeah, I think, we've all seen the NFT craze, especially in these past few weeks, kind of blow up, and it's the next big thing. In my opinion, I think NFTs they're very interesting. They're so cool to wrap your head around the idea of, basically, if you're buying a Taylor Rapp NFT, you're buying a stock into Taylor Rapp, and say I go out next year and, I have a great year and I make a Pro Bowl, that Taylor Rapp NFT appreciates just like a stock. And so I think it's a very cool idea and a cool way to connect with your fans, cool and innovative way to connect with your fans. But just going back to just seeing all the rise in anti-Asian hate crime, really it's been going on for over a year now, ever since COVID-19. But for some reason now they're really getting brought to light in the national spotlight, which deservingly so. It needs to be brought into that spotlight and that much awareness. So I just thought it would be a great opportunity to get in on the NFT marketplace, and a great cause behind it, great meaning behind it, to try to raise some money to help out my suffering Asian community.
Taylor, I know you're one of just a handful of Asian Americans currently in the NFL. Have you yourself, over the past year or longer, experienced racism in your own personal life?
Yeah, I mean, not so much in person. I'd say more. You can see more on social media. People hiding behind their keyboards and their phones and stuff. But it's certainly there. It's even sometimes even some of my good buddies. They'll just crack a little Asian joke, and it's partly my fault because I'm never one to like tell them, hey, that's not cool or something like that. But like, it's definitely there, but it was so sad and heartbreaking about all of this rise in anti-Asian hate crime is that really all the victims are old, elderly grandmas and grandpas that can't defend themselves, are the most helpless, innocent, vulnerable people out there. And so it breaks my heart. It seems like there's a new video every day that gets leaked online that we see of these brutal attacks.
That is such a really important point, but I think a lot of minorities have really been indoctrinated to making other people feel comfortable for making jokes and comments at our expense. So that definitely resonated with me. I hope you never, ever, however, blame yourself for anyone levying any kind of those kinds of comments against you. The NFL has a history of not just racial divides, but also not for really standing up in support of the players who do want to use their voice for activism. I know that these NFTs were not done in conjunction with the NFL. Curious to know, however, if you think that through doing this, you could get the NFL, other players, other teams on board with what you're pushing for here.
Yeah, I mean, not only do I want to be able to raise funds to donate directly to the AAPI community, but my effort is, or my plan and my vision is to really try to bring more awareness about this anti-Asian hate crimes happening around the country. Because honestly, I still think, even though it is bringing more to national spotlight, I still think the awareness isn't where it should be. Everybody should be knowing about what's happening. And when I post about it on my social media, I get a lot of people not even knowing what's going on and asking me, oh, why are they attacking her? Like, why are they attacking him? And so really, I'm just trying to bring as much awareness as I can to this topic and just try to spread awareness. And I hope everyone sees. I hope the NFL sees. Why not only of this NFT collection, but the reason and the motivation behind wanting to do this collection.
Now, the collection is called Year of the Ox, and one of the things that you're offering is a meet and greet with you, 2 tickets to a game during this season. Lots of cool stuff. Talk to me about why you think NFTs are the future of sports memorabilia and trading cards.
Yeah, I mean, obviously crypto has been around for a while now. But what I really think is interesting about NFTs is, like the point I brought up earlier about, buying a stock in a player or a celebrity, whether their name and their likeness and their brand goes up and appreciates, then that NFT that you buy of them will also go up. And so I think that's such a cool idea to wrap your head around. And, but also it's such a cool and innovative way to connect with your fans as well. And honestly, I think the NFT market and the NFT world could take on and take over the sports trading card world. And I wouldn't be surprised in 3 to 5 years if every player in the NFL, every player in all major professional sports has their own NFT collection. And so, I'm a true believer in NFTs, and I think this is just the start.
All right, we only have about 45 seconds left with you here. I wanted to ask you really quickly, one, would you want to get paid in cryptocurrency? And two, are you investing in that space?
Yeah, so I've been I got my feet wet a little bit back in 2017 in crypto, and a lot of the a lot of the platform on OpenSea, you need crypto or you need Ethereum. And I have my portfolio on crypto is mainly Ethereum, and so I think I might just leave it in Ethereum. The rest of the percentage that I'm not donating. I saw Russell Okung's story about him getting paid in Bitcoin, and how much more money he's made because of Bitcoin appreciating. So that's something that I'm gonna talk to my agent and I'm gonna call him and make sure the second contract that's something that we're definitely looking into.
All right, Taylor Rapp, LA Rams safety. Thank you so much for joining us for this really important conversation. And coming up, Goldman Sachs on the verge of offering Bitcoin and other digital assets to their clients. We have the details next.
Welcome back to Yahoo Finance Live. We know that stocks are higher today. We've got yields in the bond market basically flat, but want to get you a check of cryptocurrencies. Lots of news in this space, of course, regarding Goldman Sachs today. So really quickly, we've got Bitcoin up about 0.75%. But Litecoin coming under some pressure there, down 2%. Ripple off about 1.5%. The news today regarding crypto, the big news, Goldman Sachs close to offering its first investment vehicles for Bitcoin and other digital assets to clients, but only in its private wealth management group, at least to start. Now, of course, this is after Morgan Stanley said earlier this month that it would be able to offer Bitcoin funds to some of its clients starting in April. And you'll remember not too long ago, a lot of these big firms thought that Bitcoin was too speculative, too volatile for clients. But it seems like client demand won out here. And it's also not a question of if, but when we get a Bitcoin or crypto ETF. Apparently, that remains in the works. All right, coming up next here on Yahoo Finance Live, we're going to hear from David Clooney, Executive Director of the Black Economic Alliance, on a letter about 70 Black executives are writing to corporate America about those controversial voting laws in Georgia. We're back right after this.
Welcome back to Yahoo Finance Live. I'm Kristen Myers here with my co-host Alexis Christoforous. Let's take a look at some of today's top news. President Biden will be unveiling his large infrastructure plan later today, and the package is estimated to cost more than $2 trillion and will be funded by a spike in the corporate tax rate. Now, that plan is expected to boost economic growth by more than 6%. And dozens of Black executives are signing on to a letter calling for companies to fight against voting legislation, which activists say makes voting harder, particularly for voters of color. Now, the letter is being spearheaded by some big names in business, including the former head of Amex, Ken Chenault. And the labor market continues in its recovery. ADP's monthly report found private employers added back 517,000 jobs in March. That did come slightly under expectations. Want to do a quick look at the three majors right now. We have all three major indices in the green. The Nasdaq up about 1 0.8 percentage point. Tech making a nice rebound there after we had seen some sell-off in tech shares earlier in the week. I want to bring on Yahoo Finance's Jared Blickery now to go over some of today's top tickers. Jared, there has been a lot of fallout from Archegos. That fire sale. Discovery had been massively impacted. What's happening there?
Yeah, the fall today is spread into Discovery shares. Now, they have several classes which trade. I'm looking at A versus B, and B just shot up. In fact, on the Wi-Fi Interactive, these are all the stocks that have been affected. And I'm going to go to a comparison chart so you can see exactly what went on here. Now, the B shares don't trade the B shares don't trade that much because they're very illiquid. About 95% are held by insiders. So you have to have assumed that if you're going to arb these things, and that's where you buy one, short the other, and bet on a convergence of those two, you got to bet that you can get caught in a short squeeze. We're looking at a 5-day chart here, and these are theoretically supposed to track the same amount of value. You can see one is down 30%, the other is up 92%. It just boggles my mind the level of recklessness that Bill Huang, who was barred from the securities industry, at least in Hong Kong for 4 years, has taken on here. And then also the prime brokerage firms that lost billions of dollars here. I think JP Morgan has estimated could come to about $10 billion. You're looking at some Credit Suisse fallout in the billions. It's just incredible. Back to the main point here, a lot of these stocks have seen incredible movements. If GameStop wasn't a shot across the bow, I just don't know what was.
Yeah, Jared, in Greek, Archegos means the one that leads the way. They're certainly not leading the way, up at this point. It really is some staggering losses there. Want to get to some of our trending tickers today because Chewy is one of the top 5 after a surprise profit. They're one of those companies that have really benefited during this pandemic and as more and more people bring pets into their lives.
You bet. And they definitely have benefited from this pandemic pet ownership boom. Let's take a look at the stock first, and we'll get some Wall Street commentary. This is over the last 5 days. So you can see they're up about 8%. I think they were up 15% a little bit earlier. But let's check out what they've done over the last year. And you can see they reached an incredible peak here. They've fallen off quite a bit as we've rotated out of some of those work from home superstars. But you got to imagine people aren't doing any, they're going to keep their doggies and their cats. So here's what Morgan Stanley is saying. They said that the company is set to deliver another solid year of top line growth. They remain bullish on Chewy's market share gains and the pet category in general. Price target is raised to $83 from $76. And also Jefferies is raising their price target to $105 from $100.
All right. Well, if Chewy is doing very well, sadly, BlackBerry is not. That stock, of course, getting hit after their fourth quarter came in lower than expectations. Tell us a little bit more about BlackBerry, Jared.
Yeah, their entire business model kind of revolves around their patent licenses and their IP. So let me give you what RBC is saying about this. Fourth quarter revenue missed and full year 22 software guidance should come in below expectations. Patent portfolio is underpinned turnaround for the company, and the sale could be worth $1 billion. Valuation already sufficiently reflects the core software operations and estimated value of the patents. They're rating it an underperform with a price target of $750. And this is one of those stocks that caught up in the GameStop Reddit phenomenon earlier. You can see that was at peak there. Still up 28% year to date. There may be a fundamental story there, but not playing out today. Stock's down 9%, guys.
All right, we have to talk cannabis stocks. New York is about to become the 15th state to legalize recreational marijuana. I know Governor Cuomo, I think he just signed that legislation into law just a short time ago. So tell us the impact it's having on those stocks.
Well, there are winners and losers, and the winners are those that are set to take advantage of the marketplace in the U.S. And I'll sort by performance here so we can exactly see who they are. Bloomberg Intelligence was writing about this, and they're saying those companies that serve the New York area are Curaleaf, Cresco, Columbia Care, and Acreage. And also, I'm going to throw this guy into Grow Generation. That's up 11%, 22% year to date. It's been choppy for a lot of these stocks over the last few months, but they did benefit in the late last year. So we can see on a one-year basis for this particular company, up 1,200%. So nice run there. I do want to throw out some other figures here. New York's total legal pot market is expected to reach $1.2 billion in 2023 and $4.2 billion by 2027. And we need the tax revenue here, don't we, guys?
All right. Thanks so much, Jared Glickery. We will see you a little bit later in the show, of course, to go over what oil and the energy market is doing. Let's talk now about those private payrolls figures. They did come in under expectations as the labor market continues to recover, however, at a sluggish pace. So let's bring in David Nelson, Bellpoint Chief Strategist now. So David, we hear all the time that these reports are, nothing more than really a 1-month snapshot. But curious to know what you made of the report. Does it at all indicate any bad news ahead, considering there was that miss on the expectations, perhaps for Friday's jobs figures?
Look, it's a backward-looking number, as they all are. But I'm actually very encouraged here. I think the vaccine rollout is going pretty well. And even if these numbers are a little sluggish right now, I expect them to pick up dramatically. We're looking for a lot better reports as we move down the road. I think consensus for this Friday is somewhere around 600,000. This number shows that we still have a lot of work to do. Tomorrow's claims numbers will tell us more. The work that we have to do, you can see, because we're moving money, we're kind of moving money from one pocket to the other. If you have 600,000 in new jobs, and then you have another 600,000 in claims, it shows you still have a lot of work to do.
David, I want to talk to you about what we're seeing happening in the housing market. We got some data out today. Pending home sales down for the second straight month. Existing home sales were down last month. We've got this tight inventory. We've got a situation where historically low interest rates are starting to creep higher. What are you doing in that space at all? Maybe the home builders or building related stocks right now?
I have one name right now. I have Lennar right now. It's been a very good stock. We also had D.H. Horton. That's actually exited our portfolio about a week ago. It's a great space to be in. These are really cheap stocks relative to the rest of the market. I think in part what's happening here as 10-year yields rise is putting fear into people, and they're starting to get off their chair, and they want to get out and get that house right now. I think the exodus from the city has also been a contributing factor. I see it booming right here in Stamford, Connecticut. I've heard even some people have said they've come home and found a note on their door, stapled to their door, saying, here's my offer. So it seems like a seller's market.
Really?
Right now.
That's crazy.
Oh, yeah.
People are knocking on doors. Yeah, I mean, we're hearing a lot about bidding wars too, because we saw that home prices are near a record high. I think the median home price was $313,000. That was a record high for the month of February. Do you think, though, that things have peaked, that maybe there is a housing bubble that's about to burst? And if you're exposed to that space, do you need to make some moves?
I suppose that could happen, but right now, the numbers that I'm hearing here in the local area, people are getting above the asking price. That's what's happening. So as long as that continues, it's going to be a very hot market.
All right, David, I want to go look at the broader market now. I was reading your note and you said that it's deja vu all over again. You ring some alarm bells there. I'm going to read actually what you wrote. You said that valuations for some momentum stocks stack up right now against some .com favorites. Pets.com had Amazon as an investor and raised $82 million in February 2000. It filed for bankruptcy 9 months later. Of course, we have done a lot of talking about valuations, especially in tech. So what are you expecting here? It doesn't sound good. And when do you think it'll happen?
Look at the market right now. Look at it this month. The leading sector this month is utilities and consumer staples. Tech is actually underperforming this year. Today is kind of a reversion to the mean day. Today looks like your typical bull market. Large cap secular growth is moving. The elephant in the room, we just mentioned it, is the 10-year yield. Each stair step higher is going to be a challenge for long duration equity, and that points you right to technology. For the last couple of years, we've been telling ourselves we can pay very high valuations because rates are low. Now, 1.7%, it's not all that compelling for the 10-year, but the velocity in the move implies that it's going to move a lot higher. Look at commodity prices right now. They are soaring. Inflation is everywhere. I know the consumer price index and other metrics that we use seem benign, but everything that I'm buying is going up. The pumps are going up. Housing is going up, you just mentioned it, and in the store you're seeing it rise there as well. So it's an issue for some stocks out there. The good news is is that you can move down the valuation curve. There's a lot of very attractive sectors that are trading at very reasonable prices right now.
Okay, so then enlighten us, David, and tell us what some of those sectors are, because there are still so many highly valued, rich sectors out there. Where can you still find some value and some bargains?
I'll give you a couple. First, you can look at financials. It's not a good day for financials right now, but they've been a leading sector for the last 6 months for good reason, because the steepness of the yield curve speaks to net interest margins, which is their lifeblood. Look at commodity stocks. Companies like Nucor, it's seen its estimates rise 72% in just the last 4 weeks. You've got an infrastructure plan that could pass. That certainly has to be good news for them. The good news about commodities, it's only 2% of the index. So if you have a 5% weighting, which is fairly modest, you're getting a lot of alpha added to your portfolio.
All right, David Nelson, Bell Point Chief Strategist, thanks so much for all of those insights today. And coming up, Black business leaders have started a rallying cry to fight voting bills similar to the one passed in Georgia, which many say will restrict voting for Black and brown people. We'll have that conversation next.
More than 70 Black executives, including the CEO of Merck and the former CEO of American Express, are calling on corporate America to fight a wave of voting rights bills similar to the one that passed in Georgia, a bill they say will make it harder for Blacks to vote. Our next guest also added his name and his organization's name to that letter. David Clooney is executive director of the Black Economic Alliance. David, thanks for being with us. Earlier today, it seemed like this letter is starting to do its job, because we saw Delta's CEO Ed Bastian, who is one of the largest employers in the state of Georgia, say that now he believes that Georgia law on voting is unacceptable. And I know that he was facing a boycott of Delta because of his stance on that law. What's your reaction to what Delta did this morning?
So thank you, Alexis and Kristen, for having me on. This is exactly the type of response that we're hoping for with the full page ad that 70 plus, as you said, Black executives took out in the New York Times today, and that Ken Chenault and Ken Frazier and others have been talking about throughout the day. We really want corporations like Delta, who are large employers in the state of Georgia and beyond, because this is not just about Georgia, but companies to use their platforms to, they say they value communities of color, value their Black employees, their customers, and the communities they serve. This is the way that you show you value them, by opposing laws that would restrict the right of particular people to vote, particularly on the heels of an election where nationally we had more people participate in an election than we ever have in American history. And what we want to do is be bringing more people into the election process and not restricting access to the ballot.
All right. So, David, as you were, hinting about just a moment ago, Georgia is by no means alone when considering this kind of voting bill. And a lot of folks are saying that these voting packages are really just a snap reaction to the big lie about fraud in the 2020 election. So what are the, action steps that some of these corporations that say that they oppose these policies or that they support the Black community, what are the action steps that they need to take, perhaps even beyond signing a letter? Is it saying, hey, we're not going to do business with a state that promotes or passes policies like this? We're not going to hold events, for example, in a state that has policies like this. It reminds me a lot of North Carolina and those transgender bathroom bills. We saw a lot of corporations coming out and actually pulling money out of the state in response. Does that need to happen here? Is that the role that corporations need to take in this?
That's exactly the right comparison, Kristen. So to set the stage, there is pending legislation. There are numerous pieces of legislation at the federal level: the For the People Act, H.R. 1, the John Lewis Voting Rights Act, H.R. 4, and in over 42 states beyond Georgia are considering legislation right now to, similar to Georgia, restrict access to the ballot. So I think a good place to start in terms of actionable steps for companies is to call out the big lie and say there are not verifiable recorded instances of voter fraud. One example is in Pennsylvania, for example. The Attorney General there was on the record the other day saying there were 3 instances of voter fraud out of all the thousands of people who voted there. It bears noting that the 3 instances were people who were trying to fraudulently vote for Donald Trump. But this is really not a partisan issue. This is about companies saying that they will not do business in states and support people who essentially are prohibiting Americans from engaging in the democratic process. And we know for Black Americans and for all Americans, voting is a fundamental right. It's something that Black people have had to fight for over generations. And it's really part and parcel and the first step to actively contributing to and participating in a democracy. So calling out the big lie and saying, where there are not instances, recorded, verifiable instances of voter fraud, so-called voter fraud, there should not be prohibitions put against the right to vote. But also, like you talked about with the NCAA in North Carolina a few years ago, and a similar playbook was run in the state of Texas against bathroom bills protecting the LGBT plus community. This is a place that corporations can band together, both individually and together, say they will not do business in states that prohibit the rights of particular people, particularly Black people, to vote.
One of the challenges, David, is this letter is a baby step for sure, and having companies like Delta come out and say that Georgia voting law is unacceptable is definitely a start. But as time goes on, how do you hold these companies accountable? How do you make sure they're not just offering up some lip service when it comes to issues like this?
So I think this is putting us in the greater context of the action we've seen from the business community in the past year, particularly in response to the racial reckoning we've been going through in the country since the George Floyd murder over Memorial Day weekend, and really the awakening to the Black experience in America, and companies saying they want to do more, they have to do more, and they will do more. I think this is a perfect example. If you want to do more to protect the ability of your Black employees, customers, and communities you serve, to fully participate in the American experience, the right and the ability to cast their ballot is step one to that process. And I think there are a number of ways we can hold folks accountable. Another playbook that I think can be used here and that we're thinking about is right after the insurrection at the Capitol on January 6th, a number of companies came out and said they would not support with their PAC dollars or other political action or any kind of support, they would not get behind elected officials or even committees, political committees who supported people who were voting against certifying a free and fair election. I think a similar approach can be taken here to the state legislative measures that are pending in 42 plus states, where there are a number of companies who have political action committees that contribute to both the legislators, the leadership, and even political committees that are supporting the people who are propagating the laws that are purporting to restrict the right to vote.
You know, David, a lot of the folks that signed on to this letter are actually members of the Black Economic Alliance. Curious to know, as a point of accountability, and I thought it was interesting that we saw Amex, or Ken Chenault, signing on to this letter as the former head of Amex. They have a huge partnership with Delta. I think a lot of folks have one of those, Amex Delta cards. I'm curious to know if you think, or if you're hearing from some of your members that they're considering that amongst holding each other even accountable. If a company like Amex had come out and said, hey, Delta, you know what, we didn't really like your response. We don't like what your lobbying is doing. We might consider cutting ties with you. Are you hearing your members saying that perhaps they're going to take perhaps those kinds of drastic measures against each other, or are moving to holding each other accountable as business leaders?
Absolutely right. And that's why we thought it was important for this group of Black business leaders to speak to their peers and essentially say, we know the position you're in, we know the hard decisions you have to make, but this is one that is not hard. This is about the fundamental right to vote, and it's something that when we're talking about voter fraud or the big lie, we know what is behind these laws. There is a long history, even before the election of 2020, of using voter fraud as a proxy to essentially restrict the right, particularly for Black voters in a number of states around the country. As an attorney, I worked with the NAACP Legal Defense Fund and Brennan Center for Justice on cases in Georgia, Indiana, and elsewhere that were fighting against voter fraud measures that would require restrictive voter ID requirements, for example. And this was over almost 15 years ago at this point. So there are a number of things that business leaders can be doing, and essentially them banding together. One, this is one of the fundamental principles of the Black Economic Alliance and why we were founded, because there is finally a critical mass of Black business leadership who can speak to their peers in a way that we never could before. And Vernon Jordan, who just passed away a few weeks ago, when this organization was being started, said, we finally have a critical mass. It's time for Black business leaders to take their seat at the table and to use their platforms to make sure companies and corporations and really the entire business community are making more responsible decisions that are more sensitive to the Black experience in America. And that's exactly what this is. So whether it's around partnerships, whether it's around the places we do business, whether it's around certain events or even sponsorships, we have an opportunity to have a unique voice at the table that we never had before. And that's exactly what this particular group of business leaders is trying to do. And they're pushing their peers who are other business leaders from outside of the Black community to do exactly the same thing.
All right, David Clooney, Executive Director of the Black Economic Alliance. We appreciate your time today. And coming up here on Yahoo Finance Live, we're going to hear from the CEO of the biometrics company Clear about how they are helping in the battle against COVID-19.
Welcome back. Yahoo Finance's editor-in-chief Andy Serwer spoke with the CEO of biometric software company Clear to discuss which industries she will focus on for growth. Take a look.
TAM is something that we focus on a lot. It's what I focused on as an investor, both domestically and then internationally. Today, I would say that there's 4 main industries that we are very focused on, and while we incubate others over there, and that would be the travel industry, but travel industry is broad, not just aviation, but hotels and cruises and ride share, right? That is the travel industry. Sports and entertainment, location-based things, right? How do you bring back conventions in Orlando and Miami and Las Vegas? How do you bring back CES when you are your ticket and you might be your vaccine status or whatever the case may be? Healthcare, not only the physical environment, but again, we call it this physical and digital. There's telehealth, right? There's home health. There's in the hospital, there's acute, like doctors. So how do you put that whole thing together? Because you're one patient, and nobody would say that the healthcare experience, which is the consumerization of the healthcare experience, it is not customer centric. It's getting better, but I think there's huge opportunities there. And then when you think about trust online, so when you think about getting a babysitter or getting a home care worker online, who identity matters, and potentially testing or vaccine matters as well. And so we think that there's a very large digital identity online. We think travel, sports and entertainment, and healthcare are 4 areas where the TAM domestically and internationally are inordinate.
And you must have a tremendous amount of data. I know you were talking about data security and customers feeling secure, but looking at sort of demographic trends as they're unfolding real time must be a powerful tool for you guys as well, right?
So a really important point on data, if you look at the first email that we sent, I wrote it myself, in June of 2010, it said, we had a member pledge and it said, we will guard your privacy. We have been very clear, no pun intended, in our privacy policy to say, we do not sell or rent your data. We say it in bold letters, we say it early on, and we say it later. I think it's really important that people understand that their data is secure, they control their data, and everything's opt-in. What we can do is look at data internally to optimize the customer experience, right? That we know, for instance, we believe what the volume we would launch with LA to make sure we have the right equipment, the right number of team members to help understanding our business and our members better allows us to better serve them. But I think it's incredibly important, especially in this COVID environment, especially in this digital identity environment, guarding people's privacy, having them opt into everything. You have to know what you're signing up for is crucial.
Let me ask you kind of a micro question going back to biometric security. Many states are considering biometric data protection laws. Is that a good idea, and could that impact the business?
So the answer is, I think it is a good idea, and we viewed ourselves on the side of right from day one. We talk about privacy and security in our DNA. When you buy a bankrupt company that has people's data but hadn't been picking up the phone to tell them where it was, you start with a really high bar to rebuild trust. And I think it's really important that this be done the right way, be done in a way that protects people's privacy. People talk about racial bias and facial recognition, right? It is important to get these things right from the outset and to build it the right way. And with a strong foundation, it can be really powerful and positive. Without it, I think it's problematic. So I think some oversight with understanding is really important.
Is there room here for a national mandate? Is that a better way to go? I mean, this is the classic states versus federal. How do you feel about that?
Are you talking about Health Pass or more broadly?
Just more broadly in terms of biometric data protection, I guess.
Oh, biometric data protection. That's a great question. I think that there needs to be some national framework and understanding. Otherwise, it might be a bit of a mosaic. So some level of understanding and oversight, I think, is probably important versus state by state.
And that full interview can be watched on yahoofinance.com. And coming up, we will be taking a look at how the energy market is doing. That check is up next.
Welcome back to Yahoo Finance Live. Time now to take a look at the oil markets. Jared Blickery here for that. So, Jared, I'm seeing that oil pulling back and now below $60 a barrel ahead of that OPEC Plus meeting on Thursday. What are you hearing about what might go down there?
Yeah, well, the Joint Ministerial Committee, which always meets a day before, decided not to make any recommendations for tomorrow's meeting. And that's significant because that may signal some kind of disagreement. The expectations from the street going into this has been that they're going to maintain the production cuts. We know last month there was a big surprise when Saudi Arabia led the charge and said, we're holding everything as is. There was widely expected that that production was going to be ramped up. Not the case. Expectation is still rolling forward with the production cuts, especially as the reopening is a bit jarred. I just read a header that Paris in France, they're locking down for another 4 weeks. So given that situation, it's hard to see them increase in production, but Russia has been pushing for that for some time. So we'll have to see how it plays out. Now, crude oil just settled at $59.16. And on our commodities heat map, it's right there at the bottom, still trading in the electronic market. Over the last year. Now, the comps are pretty strong because we are entering the lows for crude. That was in April of last year, but up 188%. So a little bit of perspective there, Alexis.
All right, Jared Blickery, thanks so much. Time now for our ETF report brought to you by Invesco QQQ. I want to welcome in Tom Lydon now. He's CEO of ETF Trends. Tom, I know that it's been off to the races here in 2021 for the ETF market. You're seeing record inflows, but give us an idea of where that money is flowing exactly, and has it changed over the past couple of quarters?
Yeah, you're absolutely right, Alexis. So we just are finishing the first quarter with close to $240 billion in new assets. That's putting us on pace for almost $1 trillion this year, which is record breaking considering we hit a high last year of $600 billion. Most of the money is going into growth, but surprisingly, investors are finding opportunity overseas, not just in developed countries, but especially in emerging markets. Those have worked really well when we've seen a lower dollar the last 18 months. However, most recently, we've seen the dollar creep up a little bit, and more money is starting to come back domestically, especially back into large cap growth.
Now, Tom, I know that you've been looking at the decline in Chinese tech stocks. They've been declining for the last couple of weeks. Do you view this as a buying opportunity?
Yeah, it was kind of the perfect storm for tech stocks, considering the fallout of Archegos last week. There was political pressure that Biden was putting on in his news conference last week with the idea that, especially with Gary Gensler coming on board as the new SEC chair, that those Chinese companies that are not adhering to proper accounting rules and regulations might get bounced from exchanges. This is something that came up a few months ago, but with Biden, I think we're going to see a little bit more scrutiny. However, last week, especially with Chinese tech stocks, it seemed like the baby was getting thrown out with the bathwater. Some of these companies are down 35 or 40%. And when you look at the growth opportunities, especially in the fact that there are a lot of Chinese citizens that still don't even have computers or cell phones, and the amount of growth in these, let's call them Chinese FANG stocks, are just going through the roof. So if you're not diversified overseas, especially if you're not diversified in China, which is continuing to grow at a fast rate, it is definitely a buying opportunity. And a couple areas to look at are the Crane Shares Chinese Technology ETF. KWEB is one area that you might want to consider. Another is the Harvest 300 China A shares, which is ASHR. These are A shares, which are mainland China companies where we normally, or up until just a couple years ago, wouldn't have access to if you lived outside of China. These stocks are finding their way into major market indices through MSCI, but at a very slow rate. So if you want to get out in front of the line, this is another opportunity for you.
Speaking of getting out in front, is it too late for people to jump into some of these infrastructure plays when it comes to the ETFs? I know we're getting that infrastructure plan from President Biden in about an hour and a half from now. What are some of the big players there? And do you think that perhaps it's a little too late to jump in at this point?
Yeah, NFRA and also PAVE, P-A-V-E, are two ETFs to take a look at. it's not too late. They have kind of underperformed the general markets, but in the last 6 to 8 months have seen a lot of love and they've seen a lot of assets. It's going to be very interesting to see what the Biden message is, to see how much money is put towards these companies. And remember, these are not just domestic plays, these are international companies as well. So it's a way to diversify your equity portfolio and also diversify your currency risk. So take a look at those. I think with the support that we're going to see with the infrastructure bill, these might have a long way to run for sure.
Tom, how should investors be approaching the tech sector right now? I know you, at least when you were mentioning the Chinese FANG stocks, a lot of room there, a long runway for them. But how should investors really be approaching those FANG stocks over here in the United States? We were having a conversation a little bit earlier, again, highlighting the concerns around valuation.
Yeah, for sure. So great question. First of all, we've had a high amount of allocation when you look at the S&P 500 and how those FANGs have a disproportionate weight. What we've seen is a lot of folks have looked to active managers, and you talk about Kathy Wood and the folks over at ARK who've done a great job from a thematic standpoint. Also, the QQQs is another way to diversify. If you're looking for future FANG stocks, a great ETF to consider are the QQQJs, which are kind of the baby Qs that were just launched about 6 months ago. Also, Moon by Direction, MOON, is another way to take advantage of innovative companies. So thematic ETFs, especially in the tech space, have gotten a lot of attention for all the right reasons, because a lot of these companies you're not going to see in your S&P 500 allocation, which many individual investors have very high correlation to. It's a way to further diversify. It's a way to, let's say, future-proof your portfolio and not just have these big mega cap stocks.
Tom Lydon, ETF Trends CEO, thanks so much for being with us. Coming up next, we're going to discuss the boom in NFTs and collectibles with the company Rally.
Yeah, right. Yeah, about right there. Great. Thank you.
Yep, sure.
The sale of collectibles is on the rise as the price of items from cars to alcohol are soaring. But our next guest is hoping to democratize that process. We're joined now by George Limer, CEO of the application Rally. So George, how does Rally, really work? I think a lot of folks really understand, purchasing a car or a rare vintage of wine, but how does it work to get involved in being a part owner of a painting, for example?
Sure, thanks. Thanks for having me, by the way. Rally, what we do is we take rare collectible assets and we turn them into tradable securities. They're SEC regulated tradable securities, and then we offer those securities to investors, and investors invest in those securities just as they make any other investment. And so the process is really simple for the investors, and that's how it works.
I know you've had a number of different items IPO on the platform. I actually had covered Rally when it first came on the scene back in 2017. I spoke to your founder, Chris Bruno, who I know has stepped down as CEO and is now president of the company. And at the time, the company was just dealing with vintage cars. I got to sit in one of them. It was super cool. You've now expanded to a whole bunch of different things. And I just want to tick through some of these items that you've recently IPO'd and walk us through this. This one caught my eye, a piece of the Staples Center court from Kobe Bryant that was actually signed. Tell us how much that's going for.
Right. Well, we offered that for $800,000. That piece really is the greatest example of what Rally's all about, right? So an item that people are passionate about, a person that people were passionate about, and then of course, an artifact from, a very historic night, right? Not only was it Kobe's last game, not only did he sign the floor, but he scored 61 points that night. I think the story goes that Shaq bet him that he couldn't score 50 in his last game, and of course he went out and put up 61. And so really that item is really sort of the best example of what Rally's all about, because we're bringing together things that people are passionate about, and also things that are rare and that, quite frankly, they otherwise would just never be able to participate in.
George, when a person decides to invest in a company, they can look at the company's balance sheet. They can look at their quarterly earnings, and they can consider the growth forecast of that company, for the year or for the following quarter. But when it comes to collectibles, and we've seen some collectibles do incredibly well over 2020, but just like anyone who might have invested in, some Beanie Babies, for example, not all of them are doing so well. So for some of those investors who are getting involved into this space, how do they navigate around that potential volatility, or the fact that, someone might not find, that painting or that car to be that valuable anymore 2-3 years from now?
Yeah, I think what is absolutely the same about the items that we offer investments in, and the same as the similarity between those and investing in a company, right? Is that information these days, there's no inside information these days, and so the people that are passionate about these items often know just as much about these items and the sort of investable nature of these items as people that are able to afford to buy the item, outright. And so I think a lot of the same process happens. And I think if you talk to people that are heavy users of our platform, you'd be astounded at the amount of research and knowledge that they have about each of these items and the level to which they go to understand them. The other thing that I would say about these items that's interesting is that the nature of these items is largely immutable, in a lot of ways, in ways that companies aren't, right? So a company can change its management team, a company can change its focus, the competition can change. But the item, that Kobe Bryant floor, will be that Kobe Bryant floor. We're going to store that floor and care for it. And the very nature of that item will be the same today, tomorrow, 10 years from now, 20 years from now. And so I think that, coupled with the fact that our users use information in the same way they use it to value a company, is sort of the winning formula for making the right pick and investing in the right item.
What you're saying there, No, go ahead, Alexis. Go ahead.
Well, I was just curious about NFTs in the time we have and wanted to know if these non-fungible tokens or these digital assets are part of your strategy going forward.
Yeah, look, I think NFTs are an emerging asset class. I think like any asset class, there's going to be examples of NFTs that land across all parts of the spectrum. I think NFTs are actually very complementary to what we do at Rally. We're excited about them, and we think that NFTs largely prove the point for Rally's reason for being, right? As you've noticed, these NFTs are starting to increase in value, and just like a Honus Wagner baseball card, for example, in a lot of cases, the value of these NFTs are starting to outstrip the ability of the normal everyday person to participate in that. So I think we're watching it very closely, and I think I think it's fair to say that at some point NFTs will fit into the strategy.
George, I want to ask you one last quick question here. I think when most folks collect something, a car, wine, art, for example, they're also interested in being able to see it, being able to touch it, for example. But of course, your investors are not really going to be able to do that, which brings me to an item that you guys have going here. It's a Triceratops skull worth almost $300,000. Talk to us about that item. And again, about, for example, some of those investors who are never going to be able to see some of the items. Where is it stored? Where do they live?
Sure. Well, you brought up my favorite item, by the way. That by far is my favorite. I think there's two things. One is we have a museum in Soho in New York City where some of the items are housed. And I think one of you've been there. So I think that's one thing. And I think increasingly what we're going to do is lean into physical experiences and partner with a number of institutions and venues to sort of let these assets be shared and seen. And in the case of this asset's actually in an archaeological museum in Utah. So it can actually be seen and viewed. And I think increasingly what we will do, both through our own facility and our own museum in Soho and partnerships, is make these items available to the public to be viewed.
All right, Rally CEO George Limer, thanks so much for joining us today for that conversation. And coming up, Walgreens earnings came in strong. We'll be breaking it down next.
Welcome back. Looks like Walgreens, one of the top performers in the 30 Dow today. Sabeel Marcellus joins us to break down what's behind the rise in this stock. And it's about their profits, Sabeel, right? I mean, this pandemic has been beefing up the bottom line, especially as the vaccine rollout continues.
That's right, Alexis. What we're seeing is, especially when it comes to COVID testing and vaccinations, Walgreens really benefiting from that. Also, its rival CVS is also benefiting. But Walgreens came out with their quarterly results, and they definitely beat expectations. And what we're seeing with Walgreens is that it beat its profit. It raised its profit forecast and it beat profit estimates. So the drugstore giant in the second quarter saw same-store sales rise 4.5% in the US. It rose 3.2% in pharmacies in the UK. And this is all due to, over the past quarter, a rise in sales at pharmacies both in the US and in the UK. Now, in the second quarter, revenue rose 4.8% to $32.8 billion, and net income rose by $1 billion from $946 million during the previous quarter a year ago.
All right, Sabeel. Well, thanks a lot. We appreciate the wrap up there on Walgreens Boots Alliance, one of our trending tickers today, actually. Coming up on Yahoo Finance Live, the CEO and president of Hawaiian Airlines is going to join to talk about the state of the airline industry during the pandemic. And once again, markets mostly higher here, but tech stocks, the big winners of the day. We're back right after this.
President Biden set to unveil a $2 trillion infrastructure plan this afternoon, and it includes raising the corporate tax rate to 28% to help pay for that big spending push. We're going to have his remarks for you live next hour. And ready for takeoff, airline bookings are picking up as more people get vaccinated. We'll talk to Hawaiian Airlines CEO Peter Ingram about whether it's the start of a true recovery. And it's a big day for IPOs. Two names, Coursera and Deliveroo, making their public debuts. Coursera surging on the New York Stock Exchange, shares up just around 30% right now. But on the flip side, the Amazon-backed Deliveroo, those shares crashed. It's a disappointment for the biggest listing on the London market in a decade. We're getting ready to close out the first quarter here on Yahoo Finance. Welcome back. I'm Shauna Smith.
And I'm Adam Shapiro. Real quick, let's take a look at these markets because we are kind of in record territory when you're talking about the S&P 500. In fact, we're possibly looking, dare I say it, S&P 4000. No, I won't say it. Let's go to Jared Blickery. Let's let him say it. Jared, what have you got for us?
S&P 4000. There, somebody had to say it. Let's take a look at the Wi-Fi Interactive for an update. We got tech in the forefront, really leading the way. Check out the Nasdaq up 2%. And I just want to switch over to the VIX here because it looks like we're going to close out the quarter below 20, unless we get something really hinky into the close. I think that's substantial. Think about where we were exactly 1 year ago, just off of those lows. What a memory. Also checking in on the bond market, we got the 10-year T-note yield up 2 basis points, pretty close to this 13-month high that we had only yesterday. So we're going to want to keep an eye on that as well. The mega caps in the green today, they are the leaders. We got Facebook, Apple, and Microsoft each up over 2%, Amazon nearly there. But the big story is Tesla. Tesla's up over 5%. And in fact, if we look at the EV space, pretty lit. We got Li Auto, that's up over 8%. NIO is up over 4%. And this leads me to the sector action for today, because we got the three FANG sectors. That's tech, discretionary, and communication services. All of those are the outperformers. To the downside, energy down 0.75%. We just settled below $60 per barrel, and that's ahead of tomorrow's OPEC Plus meeting. The Joint Ministerial Committee, by the way, decided not to make any recommendations, but the street believes that OPEC Plus is going to stay pat with those production cuts, guys.
All right, Jared Blickery, thanks so much. We're going to check in with you a little bit later on in the show. But first, let's get to George Perks of Bespoke Investment Group. And George, let's just start off with what Jared was saying. We're seeing a rally almost across the board today. Certainly technology is leading the way, consumer discretionary, communication services being the outperformer. I bring this up because it also comes on a day where their 10-year yield is getting a bit of a bump. Do you think markets have kind of come to terms with higher yields? I guess, why are we seeing a different reaction today?
I think you can only go so far for so long with the extreme inverse correlation between interest rates and tech stocks that we saw in earlier this year. I mean, we hit record levels of an inverse relationship there, i.e., it was too sensitive in the tech space to moves in yields. And now we've sort of had some time here with yields at 52-week highs for markets to adapt and sort of get the positioning squared away to the point where it's not all one big trade anymore. So I think that's been an important process. These sort of market relationships that we take as sort of dogmatic. Another one used to be, for instance, crude oil and the S&P 500 moving together. They don't always last for that long, right? And they can be very strong for a period of time, but then sort of fade off as participants adapt and as the narrative changes. And I think that's what we're starting to see in terms of tech and interest rates.
I want to talk about something that seems to be falling into the rearview mirror, Archegos. And you said in a note just yesterday talking about the fallout. We know the banks, Credit Suisse, Nomura, Mitsubishi, all taking a hit. But we got a statement from Senator Brown, who is on the Senate Finance Committee. And he said that we must make sure our financial watchdogs work together to protect the financial system and our economy. I expect the SEC and other regulators to take a closer look. Is the market going to price in some kind of regulatory crackdown to perhaps one day prevent what we saw happen with these large blocks getting dumped or sold on the margin call with Archegos, or is this going to be history?
It's really hard to look at the Archegos story and come away with the view that regulation is, dramatically too easy and we need to really crack down hard. I think the important thing to remember here is that the Archegos story was very bad for the people that were actually exposed to those stocks. But we didn't see any sort of metastasization into a broader financial disruption via funding markets or via defaults by prime brokers or anything like that. And the reason for that is because leverage in the system is relatively moderate. If you compare today to 2007 or 2006, we're living in a completely different world in terms of bank capital levels. Credit Suisse is one of the less well-capitalized SIFIs around, and they're still, 12% of risk-weighted assets in common equity tier 1 capital. So, it's really hard to look at the story and say, oh, well, the obvious thing we need to do here is make sure this never happens again. It depends on what Senator Brown wants to do in terms of preventing this from happening and what sort of regulation that would involve. But from my perspective, I think, both as a market participant and as someone that thinks about policy, it's the takeaway for me is that having high capital levels in the banking system works really well. And when these sorts of blowups happen, as they always do, inevitably, the important thing is to make sure that they're contained and they don't spread like a wildfire across the financial system. And when capital levels are high, that's relatively easy to do, and that's what we saw in this instance.
And George, and going off of that, we talked to Mohammed Al-Arian yesterday on the program, and he was telling us that this was a third near accident this year so far, and it was driven by people taking much more risk just because of the amount of liquidity in the market. From your perspective as a market participant, is there too much exuberance out there? Have we seen us maybe back off of some of those record highs, so we're at a more healthy level right now?
I think it was really easy to see earlier this year, and I in fact wrote an opinion piece about this, that certain parts of the market were clearly in a bubble, whether it was SPACs, whether it was green energy stocks. I mean, there was just parabolic price action, absurd valuations. You couldn't lose money. Everyone was piling in, and then we had GameStop hit, and then we had interest rates start to rise. And now we've had Archegos, and we've just had this series of sort of shocks to the system to sort of get people back to reasonable levels. I think a really good proxy for this is something like the iClean ICLN ETF. If you look at that ETF, it was similar to ARKK, the ARK Innovation ETF, and just parabolic moves last year that continued into this year. And it's since broken. You've seen notable outflows. You've seen a breakdown in price and a big drawdown. And, things are starting to look like they've been stress tested a little bit. Does that mean all these sort of very speculative plays are about to go to the moon like a junk cryptocurrency? Not necessarily, but I do think that the series of sort of dramas we've had in markets over the past 3 or 4 months have shown that while valuations are very elevated and there is some stuff that's priced unreasonably or was priced unreasonably, declines in that price and moderation doesn't mean the end of the world, and markets are robust enough to handle that without leading to some sort of larger contagion effect.
George Perks, great to speak with you of Bespoke Investment Group. Coming up next here on Yahoo Finance Live, airline bookings, they're picking up as more people get vaccinated. We're going to talk to Hawaiian Airlines CEO Peter Ingram right after the short break.
Welcome back to Yahoo Finance Live. We're about 47 minutes to the closing bell. Got to talk about the latest COVID-19 news. Angelique Kemlani is watching the concerns over a fourth wave. And then, of course, there's this news out of France, another lockdown. Bring us up to speed.
That's correct, Adam. We did just hear about France going into that lockdown once again, and that sort of sets the tone for what health experts, including the top health officials in the U.S., have been warning about. We heard this week alone from the CDC director, as well as all of last week, warning against those slight increases that we're seeing around the country and the concerns that that could lead to yet another wave. We know that now we have that look back as well on the 2020 overall death cases. The CDC just releasing a report today that said that COVID-19 accounted for was the third leading cause of death in the U.S. in the full year, and that deaths overall in the country increased by about 16% overall with that input. So really just, showing just how much of an impact that has had. We know that we're past and still increasing beyond that 500,000 mark of deaths in the U.S. So really concerning number still. Meanwhile, we also got some news out of Pfizer today with their results of adolescents, testing that vaccine in adolescents 12 to 15 years old, showing a high efficacy. Some experts are saying that not to hold that number into too much of a high regard, that 100%, but just to note that it is high efficacy. The company said they're hoping to submit that information to the FDA and have some results and some approval to roll out this vaccine to that age group by fall, by the start of the new school year.
Angelique, we appreciate the COVID-19 update. Of course, COVID has an impact on several businesses, major businesses like the U.S. airlines. Coming into the stream right now is a guest we've had on before, Peter Ingram. He is the president and CEO of Hawaiian Airlines. And Peter, while high and tight might refer to a military haircut, I think it also refers to the fact that your team runs a tight ship with Hawaiian, and you are flying high right now. You're doing very well. You just started selling tickets nonstop from Phoenix to Maui. And I read an interview in which you said you expect to be flying 60 to 70% full as more planes are taking to the air. Why the optimism?
Well, we've seen a good uptick in bookings over the last couple of months, really. Since the end of January, our domestic U.S. bookings have really started to accelerate, and as we are finishing the month of March, we'll end up with a load factor in the 60s during the month of March. We think we've got an opportunity to better that in April. We're starting to see people optimistic about booking out into later in the second quarter and even into the third quarter. So as vaccinations are rolling out, the pent-up demand for travel is really manifesting itself.
We hear about this pent-up demand in travel. We had on Nick Callio from Airlines for America talking about this, Mike Boyd, the airline consultant, talking about this. In regards to Hawaiian, I think in the previous interview with you, was it 30% of pre-pandemic traffic was actually coming from Japan? Help us understand how important the Japanese passenger is and when that person might be coming back aboard Hawaiian Airlines aircraft.
For our airline, international prior to the pandemic represented about 25% of our revenue. And the biggest piece of that, more than half of that, is from Japan. And Japan represented about 1.5 million visitors for Hawaii overall. So a really substantial part of our traditional visitor base here. Japan is a little bit behind the U.S. in terms of vaccine rollout, and I think that is being reflected in a little slower return to normal travel behaviors and lifting of restrictions. We have in recent weeks seen the Japanese government start to lift some of the restrictions on domestic travel, and you've seen JAL and ANA announce some expansions of their schedules in the months ahead for domestic travel. As far as coming to Hawaii and coming to the rest of the U.S., I think that's going to depend on the vaccine rollout. And we had some good news in that regard this past week with the Japanese government announcing that they were going to have a fairly significant amount of supplies of vaccines available and start rolling them out in earnest over the next couple of months. So it's a little early for me to predict the timing of when the Japanese traveler is really going to come back in volume, but we're optimistic that there is a chance to get some of them back. Certainly for the summer, and we're definitely optimistic about later in the year. So that is a key variable we're watching for our business going forward.
Peter, you're very optimistic. We've seen this uptick in bookings like you're talking about. How are you going about rebuilding your schedules? Have you abandoned the historical travel data because so much is up in the air right now?
A lot of what we're doing is looking at what demand patterns were in 2019 to really understand in a more normal demand time frame when we're not dealing with the restrictions that we've had since this time last year. We are really already back by the month of May. We'll be back almost to 100% of our North America to Hawaii schedule. We've started to rebuild our schedule for flights within the islands as we have more demand coming in there. That is still being held back a little bit by the cost of testing, which is restricting how people move about the islands. But the best thing we can look at it in terms of where demand exists is the history from 2019. Our business is primarily leisure, and we think that the leisure business is going to come back to 100% very quickly and potentially grow beyond as flexible work and other things drives people to think about travel a little bit differently.
There are two topics we want to get your opinion about. One is perhaps some kind of passport, they call it, to show who's been vaccinated, and that would be for all the airlines. But before we go there, I want to go to Hawaii one day. I'm going to do it, but I am curious, will the fares that you're able to charge, will they be higher than they were pre-pandemic? Because Helen Becker over at Cowen said that they're running at about 20% below what they had been before the pandemic. And we know that fares were pretty cheap before the pandemic too. So what's going to happen to fares, do you think?
Well, it's difficult to talk about future prices because it depends on so many things. It depends on our cost structure as an industry. It depends on supply and demand in the marketplace. I can tell you what we're seeing right now is it's a great time for people who are looking for attractive pricing to fly, and you should think about doing that Hawaii vacation as soon as you can. And that's really just a factor of what I think is unsurprising is that as demand is coming back, we're still in a condition where there is some extra supply out there throughout the industry. Business travel hasn't come back as robustly as leisure travel. And I think that is manifesting itself in traffic coming back before pricing. But I think as demand ramps up, that may not always be the case. So you should get those great fares when you can.
Peter, Adam just mentioned the vaccine passport. I was just reading that Hawaii is exploring this for inter-island travel. I'm curious just to get your thoughts on this. Is this a good idea?
Well, I think ultimately we want to get to a place as the pandemic recedes where we think about not having some of these restrictions, when we don't have concerns about the spread of the disease, when we don't have widespread pressure on our hospitals and our medical infrastructure. For the time being, though, the pandemic is still a reality. And even as things have been getting better, we're not out of this crisis yet. And having the government play a role in setting the standards so the private market can go develop tools for people to demonstrate their credentials for travel based on whatever regulations are in place in different domestic or international places, whether that is having a certain type of test, being vaccinated, having that infrastructure in place to make it so it's more frictionless. One of the things we're dealing with in Hawaii right now is it's with the testing regime that has allowed us to start traveling. it's a really cumbersome experience for our guests, and we would like to see that eased and smoothed out over time to make travel more effortless, which is one of our long-standing goals as an airline, is to really make it easier for our guests to be able to transact with us and get to enjoying the things they want to do when they're on a trip.
You know, we don't have the time to jump into the successful steering of the airline with you at the helm. You know, the cash burn down to 1.5 million per day, calling back the 800 employees. I promise you, the next time you visit with us, we will jump down on those numbers so that you can brag, rightfully so, as you steer your airline to success. Peter Ingram, Hawaiian Airlines President and CEO, all the best to the 7,000 women and men who are part of your team. When we come back, Harlem Capital is raising money to invest in more minority and women-led businesses. Partner Brandon Bryant on why more investors want in and the incredible $134 million raise they just had.
Harlem Capital raising $134 million for its second fund. That's well above its target of $100 million. We want to talk about this with Brandon Bryant. He's Harlem Capital's managing partner. Brandon, it's great to see you. Congratulations on this. Let's talk about your second fund. You're maintaining your commitment to minority and also female founders, but you're shifting your focus a little bit with this fund. How so?
Yeah, we're going even earlier stage. We saw that in the past. There was times where we wanted to wait for revenue or even some type of strong traction. But with the technical founders who are in the space these days, how hot the markets are, how much capital other venture capitalists are putting under their helms and putting to work, like it's just too hot of a market to wait that late. So we're building it as early as we can right now. We're super excited to be jumping in with this second fund.
So, Brandon, I'm going to brag about you a little bit. First, you're a Cleveland native, and you know I love Cleveland, having spent so many years there. So already, to me, that's about 70% of the ingredient you need to be successful. This fund that your team is launching, when you say that you're going to shift the focus to early seed stage investments in companies that are post-product, I'm not a business guy. What does that truly mean? They're already up and running with the product so that you don't have to walk them through those steps?
Yeah, so post-product means that the product is built out. There might not be revenue or customers, et cetera, but there's a clear roadmap of how you're going to build out that product, how you're going to put people into the pipeline to pay for that product, and how you're going to scale, go-to-market strategy, et cetera, et cetera. So there's another kind of stage called pre-seed, which is basically idea stage, pre-product, et cetera. So we're moving from seed, where things are already built out, to post-product right after the pre-seed round.
Brendan, talking about you being so successful, this fund was oversubscribed by quite a large amount. How did you attract so much interest? I mean, what is the key to getting so many people and so much funding here on board with your vision?
Well, look, we've been doing this for 5 years. We started investing in people of color and women-run startups with our personal capital. And then we started building research in a space where we had the opportunity to build the largest report of Black and Latinx founders who have raised over $1 million. We also built a big report of diverse VCs in the space. And so after becoming a thought leader, started to do great relationships with folks like Techstars, who's one of the largest accelerators across the globe. TPG became one of our anchor investors in our first fund. We also have a social media following of well over 300,000 across all of our platforms. And we also have been finding extremely talented founders who are letting us play a small part of their journey to accomplish their dreams.
So when you're looking for these 45 companies, how does this work? Do you approach them? Do they approach you? Who have you already got in your sights?
Yeah, so we saw 1,600 deals for our last fund last year. We invested in 10 each year. And so for this fund too, we'll be investing in 15 each year. And we don't think there will be a problem for us to find anywhere between 1,600, 2,000 plus deals. For the founders that we're looking at, we're looking for folks who have strong business acumen. They're good storytellers. They're in $1 billion plus market. We've invested in enterprise software, future of work, future of e-commerce, the fintech space, wellness technology. We're also looking at real estate as well. We're really, since we're investing so early, we're focused on the founder, their storytelling capabilities, the vision, and the people that they can get around the table.
Brendan, I also want to bring up a point here with this fund because you're also introducing the idea of culture carry. Can you explain to us what exactly this means and why you think this is a good idea to include this in this fund, fund that you have?
Yeah, in the venture capital space, there's a power law of returns where typically out of a fund, only 1 or 2 companies really have outsized returns. For our company, or for our companies that we invest in, we want everyone to participate in upside. So we're giving folks the opportunity in our fund to have 1% of our carry, so that if it is the power law of only one person or one company winning, we hope that everyone else still get a chance to win. So it's more of like lifting all tides and lifting all boats. And that's the kind of point of what Harlem Capital is supposed to be doing here, right? Like we're changing the face of entrepreneurship, but also changing the face of what a typical investor looks like. And we're also building the tech ecosystem on the diversity side. So we thought that this made the most sense. And we're doing this for Fund 2, but also we're implementing this for Fund 1 as we close with these last 5 investments.
You know, as we were coming into the stream, I don't know if we pointed out that Fund 1, $40 million, but now your firm is managing, $174 million in assets. What is the trajectory for Harlem Capital post Fund 2? I mean, you're going to be a big player, not only in New York City, but nationwide.
It's a good question. I think our goal is to invest in 1,000 diverse entrepreneurs over the next 20 years. That means we definitely plan to be big players in the space. We've been able to invest alongside some of the tier 1 VCs. We have some breakout founders who are building companies. And we're expanding the platform where we're inviting other folks. We're hiring a community manager to help us with storytelling, to also help us with events, both virtual and in person post-COVID. And we're excited to really be at the place that we are right now. 45 deals, we got a long way to go before we can start thinking about the future, but we feel like we're in a pretty good position right now.
Well, Brandon Bryant, we're excited for you. We loved having you on. We hope you come back to join us here at Yahoo Finance again soon. Harlem Capital's managing partner, Brandon Bryant. All right, coming up next, DHL Express America has new data out showing why U.S. companies are bullish on international growth and trade, and also share the view of the biggest challenge that many of these companies consider their biggest challenge, I guess is a better way to put it, this year. We're going to have that for you right after the break. It's time for our 2 and 2. Two stocks that I'm watching. Adam has two for you here with just around 30 minutes to go in the trading day. First up, let's take a look at Walgreens. It's one of the gainers here in today's market with shares up just around 4.5%. They beat earnings forecasts. They also surprised investors by raising their guidance. Shares hitting the highest level today that we have seen since January of 2020. So in about 14 months. Also, Walgreens is on pace for its best quarter since 1982, with shares up more than 40%. You can see trading just around $55.33 a share. Flipping over to Chewy, another outperformer in today's market, posting its biggest pop that we've seen in just around 7 months. Strong sales growth getting praised by analysts. Their CEO saying that they are bullish on more sales growth in e-commerce. That, of course, has been a strong driver for the company over the last several months. Morgan Stanley out with some comments on these earnings results, saying that Chewy is positioned to deliver another solid year of top-line growth. The company has been benefiting, of course, from the pandemic pet ownership boom that we have talked about a couple times here at Yahoo Finance. Shares getting a boost today, and you can see the stock up just around 6.5%, Adam.
Sean, I'm going to stay on my Cleveland love affair and let you know about Cleveland Cliffs, because this is a local company in Cleveland. They're a steelmaker. A lot of people have heard of LTV or ISG or ArcherMittal. Cleveland Cliffs bought ArcherMittal. They're now the largest producer of flat rolled steel in North America. So here's what's going up. Shares of this stock, they're up tremendously right now, almost 17%. And anybody who's lived in Cleveland knows that's worth cheering about, especially when you go through the LTV bankruptcy. But it's their guidance that investors are loving right now. Cleveland Cliffs sees their full year EBITDA of $3.5 billion. And this was greater than what analysts had been expecting by almost $700 million. So Cleveland Cliffs, things heating up at the furnaces. They're over in the flats just off of downtown Cleveland. Then there is Viacom. You know that feeling when you go to the dentist and they give you the number so that your jaw drops down? You're like, oh my God. All right, Viacom shares off about 3%. I want to put in perspective what happened with Viacom. They were part of the Archegos margin call. A lot of big banks dumping large blocks of this stock. The shares closed at $100 on March 22nd. That was soon after they had hit a 52-week high on March 15th. They fell to $66 by March 26th. And that was during the time the banks were selling the blocks because of the margin call default over at Archegos. They have now fallen even more. At one point, they were down to $39 a share. Right now, they're trading at roughly $48, not $45 a share. So, you know, Viacom CBS can't get a break, and a lot of it has to do with the fallout from that margin call that blew up with Archegos. Let's turn to something more pleasant that we can talk about. Everybody loves getting a package on time, and DHL Express America CEO is here to talk to us about not only how we get our packages, but the signs that the economy is steaming up. Mike Parra is the DHL Express America CEO. Good to have you here. And for some of us who are ignorant to the logistics and delivery business, your parent company is Deutsche Post, but it's not a government entity, it's a private company. So how does that all work in the United States for you, and what signs do you see the economy is heating up?
Well, first and foremost, thanks for having us. Thanks for having me as well. I think it's important to know that we've been in the U.S. for 51 years now, back to 1969 when this all kicked off. And really what we're seeing is an absolute rocket ship growth that we started to see after the month of April of 2020. So we saw a quick V-shaped recovery in 2020. Our lowest point was April. And then from that point on, all the way till today, March 30th, as we move into close of end of month, we continue to see double-digit growth, specifically in the area of e-commerce. And equally as such, we've also seen a nice rebound in the space of business to business as well.
Mike, you're out with a survey of business executives, and I want to get your thoughts just on the disruption that we've seen to supply chains during COVID. When we heard the prediction going back to the start of COVID or shortly after, that companies would respond by maybe shortening their supply chains and moving some production back to the U.S. Has that happened?
Well, you know, we saw a bit of both. You know, we saw that change obviously in the front end of the pandemic, where there was a shift of the supply chain more from the U.S. towards Asia. And then once Asia started to stabilize and the U.S. and Central South America and Europe started to go in COVID, we saw a shift in the other direction from Asia Pacific more towards Europe and then the United States. What we've seen now is that things have stabilized for us, and we've seen nothing but growth. The biggest opportunity came with when the airline industry or commercial airline industry started to basically reduce and hunker down and reduce the number of flights, reduce capacity. And then there became a big need for companies like ourselves, global integrators, to be able to move the goods all around the world. So, and that hasn't stopped, by the way, even though we're starting to see passenger flows starting to increase, 1.2, 1.4, 1.5 million a day, more specifically in the United States. The need for capacity in the air continues to be pressing, and we're adding more and more planes every single day.
So as Shauna just pointed out, I think it was 9 out of 10, 89% of CEOs in the survey expect the global recovery to depend on robust international trade flows over the next 12 months. But then you get news like what we saw out of France today. How much of a hiccup does one country locking down the way France is doing present for what these CEOs are expecting?
Yeah, no, I mean, look, during the pandemic, we saw the biggest growth, and with the move of everyone moving to work from home, and even here in the United States with stimulus checks that recently went out, people are working from home and then they're buying online. And even though there's a lockdown in France, our business continues to flourish because shipping must continue, either people importing goods that are needed into France as a country or France exporting goods. So being a business essential business that we are at DHL, we're still working and people are still shipping. And that economic recovery, as you saw in the study at 89%, is basically conclusive around international trade flows. And it also in the study, it said that 83%, well, we got out of the 500 folks, senior decision makers that we surveyed between the 12th of January and the 5th of February, what we saw that 83% of businesses are planning to increase overseas investments this year, with North America being the favored destination, being 78%. The US for us continues to be the largest destination from the world into the US. And we grew greater than 50% inbound, and that hasn't stopped even through March as of today.
Mike, another part of this survey that we haven't hit on yet, and something that jumped out to me, was international travel. And of the business executives that you surveyed, 44% said that their organizations are planning to increase international business travel beyond even pre-pandemic levels. And this isn't something that I've necessarily seen before. Any idea as to when they plan to ramp this up and in what industries this is the case?
Yeah, that's interesting. And that was an interesting fact that came out of the report, that even, there was a bit of questioning around it, because we don't see international travel for our company taking off to at least fourth quarter of this year to the beginning of 2022. So I would say that it's going to be, if there's going to be any international travel, it's going to be towards the end of the year, the beginning of 2022, especially with some of the recent lockdowns, whether it's Germany, whether it's Italy, whether it's France, from a Paris perspective, or some of the Eastern European countries where we've seen a return of numbers spiking, or even here in the United States as of late, coming off of spring break, we've seen, many different states starting to see a rise in COVID. So we're keeping a close eye. But if I were betting, I would say it's going to be the end of quarter four of this year in the calendar year, or the beginning of 2022.
All right. I think the Germans would say alles in Ordnung, poorly translated. Everything is okay. Mike Parra, DHL Express America CEO, thank you for being here. When we come back, our editor-in-chief, Andy Serwer, on this concept of COVID-19 passports and much more.
Vaccine passports is an idea that's been floated around, and here's how it would work. Businesses or local governments may require you to show it in order for you to get access to certain events, or if you want to go inside and eat in certain restaurants, and the list goes on and on and on. So we want to bring in Yahoo Finance editor-in-chief Andy Serwer to talk a little bit more about this. And Andy, of course, as with everything these days, it seems it's the battle over this is getting political. The idea is getting criticized heavily by a number of Republicans. And we had Governor DeSantis down in Florida saying that he would sign an executive order banning this.
Yeah, I hoped you weren't going to say, here's Andy Serwer to make sense of this, Shauna. So I'm glad you didn't say that, because it's a tricky one. And yes, it has become a political football. Although, to be clear, it's not like Democrats are saying we absolutely need to do this. They're equivocal about this as well. Some Democrats have said that they would look to do this. The President Biden, has not said that. It really is tricky stuff. So, and there's a number of facets. First of all, when you get the vaccine, you get that little card. So that's your vaccine passport, old school, right? And there's some businesses that are looking to laminate that for free for you. You can see, look up that story on the news if you'd like. But people are talking also about turning that into a digital format, so you'd have it on your phone, or even a biometric company like Clear could do that for you as well. Now, then there's the distinction between private companies and government. And I think where the foes are most vehement here is the government requiring you to show a vaccine when you walk into, say, the DMV. I really don't see that happening. And by the way, what would you rather do? Would you rather be around people who are vaccinated or people who have negative COVID tests? You know what I mean? Remember that. Like, a vaccine just shows that they can't get it. It's not that they couldn't give it to you, although that's extremely unlikely, to be completely clear here. Then there's foreign governments. There's airlines. When you needed to get on one air carrier and not another, if you flew to a country, would they require it? I mean, it's kind of mind-boggling stuff. And of course, it's going to be confusing and a hodgepodge. I'll tell you that.
Andy, you just brought up the issue of the government requiring it. This was settled over 100 years ago. Jacobson versus Massachusetts, United States. State government has the right to force or require that you get a vaccine. It was a pastor who challenged the vaccine against smallpox. And the Supreme Court said, no, Father, you're going to get the vaccine. So, hey, this is already settled. Why not just have the federal government say, you know what? Everyone must get vaccinated.
That was then, and this is now. That's the simple answer to that one. And by the way, Adam, it's not so clear cut that the government can get you vaccinated. There's still a number of exemptions out there, religious and medical. And we know that there's a number of a slice of the population, I guess you could say, a slice of the population that won't get vaccinated. I think that's a mistake, but that's my personal take. I think that I don't think states are going to absolutely require you to do this. Now, you've seen private entities do this. Rutgers University, you're going to need a vaccine to go to school in the fall there, reportedly. And you're going to see restaurants, you're going to see certain places. But I think everyone needs to really calm down and chill out on this one, because with any luck, I think this is going to be a non-issue by the fall. You know, that we're just going to go about our business. I think for the next couple months and over the summer, people are going to go crazy over this thing. And it's unfortunate, but I think it is a reality and potentially a business opportunity and potentially a big line at an airport. So just calm down on this one and just be patient, people. That's all I can tell you.
Only time will tell how all this plays out. But Andy Serwer, as always, thanks so much for hopping on here with us. We're going to take a quick break. The Dow losing some steam here heading into the close, now off just around 28 points. We're back with more on that in just 2 minutes.
Nothing says loving like the 10-year yield. Let's talk about interest rates. Let's talk about 1.75%. We're going to do that with UBS Global Wealth Management Senior Strategist Leslie Falconio. Thank you for joining us. If we were at this, actually it was higher. The interest rates or the yield, at least on the 10-year, was higher before the pandemic. If it's only at 1.75%, why is everyone freaking out as it goes up?
Well, I think when you think about it, I mean, the intraday low in 2020 was 31 basis points in the 10-year yield. So it's really, to your point, it's just that net change that everyone has people, sort of a shock and awe. And not only that, but how quickly that change occurred, which is, from 90 basis points at the end of the year all the way up to 1.77 within a 3-month period. Now, overall, you're right. I mean, historically, these are not high interest rates, but the velocity and the amount in such a short period of time is what really has people concerned.
So Leslie, then with that in mind, how are you suggesting investors position themselves right now with so much uncertainty and the fact, like you're saying, historically speaking, at least the 10-year yield isn't that high?
Well, listen, we came into the year bearish, but there's no question the volume of the bearishness we grossly underestimated, as I think everyone else did as well. Because when you think about it, the first quarter saw almost a doubling in GDP forecasts, given what they had at the start of the year. So because of that, you saw this really large move in interest rates. Now, when you think about going forward, we know that the second quarter is going to be strong, and then it's going to become more of a show-me market. So, our outlook for the end of the year is probably around at 2%, right? So that velocity or the change going forward in 10-year yield will be much less, given where we're sitting right now. And again, we have to see a lot of this data happen in the second half of the year, because all this positive news on the vaccine rollouts has pushed forward the reopening of the economy, which was once thought of as late summer, is now spring. So you have a lot priced into the marketplace right now. And so our outlook is still for bearish interest rates to rise at a much slower rate. And what fixed income investors will do, and what they have to look at right now, are things like relative value and spread. And that headwind that they've seen from rising interest rates should abate a little bit.
So the bond market right now is no place for amateurs, with the spread between the 2 and the 10-year is rising. What would you advise people who are apprehensive about jumping in?
Well, listen, I think it depends on why. I mean, diversity is always, no one would tout diversity in terms of your portfolio. Diversify your portfolio. It's always really important. It's very 101. But one thing I will say is that if, in fact, the economy continues to grow on the path that what these strategists are expecting, or even if the Fed does shift to a little bit more of a hawkish stance sooner than what we anticipate, which would be like the end of 2023, it'll be that 5-year part of the curve that gets hit, right? The 5-year part leads monetary policy. So right now, when you think about the 2s, 10s, or the 10-year in and of itself, if you have a large equity portfolio, given these yields, it's not a bad time to start hedging, because we don't expect a large incremental rise. It's going to go higher, but just not as incrementally as much as we've seen in the first quarter. But again, diversifying your portfolio is always the biggest strategy. But in our opinion, the 5-year part of the curve, given it hit historically negative real yields, is the most vulnerable part of the curve, not the 10-year.
Leslie Falconio, UBS Global Wealth Management Senior Strategist. Thank you. We'll be right back. Heading to the closing bell with the top down and the wind in our hair, we've got Christina Hooper, Invesco Chief Global Market Strategist, along with Stephen Dover, Head of Equities at Franklin Templeton. But first up, Jared Blickery watching the markets.
Yeah, a little bit breezy here with the top down. Let's take a look at the close, about to close for the quarter. Oh, how about this? Dow is now in the red, but for the quarter, year to date, same thing, up 8%. Also taking a look at the S&P 500, that's up 6%. And guess what? The Nasdaq kind of trading sideways a lot of this year, but still up 3%. And then also the Russell 2000, that is a big outperformer. That is holding on to gains of about 13%. Well, I want to also take a look at the VIX because as speculated 1 hour ago, about to close below 20. And this would be significant, especially considering where we were just 1 year ago. We got to take a look at some of our stocks. And in the Nasdaq 100, we have Apple up 2%, Facebook up 2% as well. Microsoft, Amazon, and Alphabet each up over 1%. Tesla notably up over 5%, working off some of those losses that we had a couple weeks ago. And also checking out the sector action for today, we see tech in the forefront along with discretionary. Here's a closing bell for the first quarter.
We have the S&P hitting an intraday record today, closing in the green. It looks like, taking a look at where everything is closing up. Dow up just around 82 points, Nasdaq up just around 1.5%. Jared mentioned that it's also the end of the first quarter. We have the Dow and the S&P in the green. Dow up just around 8% for the quarter, S&P up around 6%, Nasdaq up about 3%. The real outperformer, the Russell 2000, with gains of just around 13%. Let's bring back in our panel. We have Christina Hooper. We're also joined by Stephen Dover. Christina, let me go to you first. Just this rotation that we've seen during the first quarter, we can see that in the relative underperformance. I say relative because the Nasdaq still closing the quarter up just around 3%. But as we look ahead to the second quarter, what's going to lead the way?
I think we're going to see more of the same in terms of market leadership. This is an environment in which the economy is likely to accelerate. We're going to likely get improving economic data. And I think that means that we'll see continued outperformance of areas like energy, like financials, like consumer discretionary, materials, industrials, those areas of the stock market that are most sensitive to the economy.
Stephen, I'm curious, anybody who ran track in high school or swam in high school knows if you jump the gun, you got to start over. What are the risks? I mean, are investors a little bit early to what? We don't even have the earnings reports yet for the first quarter.
Well, I don't think investors are early. We're very pro-risk in that we're positive on the equity markets. I think the really big news is that we're at a very big tipping point right now. We're out of the pandemic or getting out of the pandemic. There's a gargantuan change in how our economy is going to be run with the stimulus plan as well as the Build Back Better plan. So I think investors are going to have to look very differently looking forward than they have looked in the past.
Christina, we're expected to get comments from President Biden here later on this hour. He'll be laying out his infrastructure plan. Is expected to be right around $2 trillion. How is the market looking at this and just in terms of its potential impact going forward?
Well, it's definitely a double-edged sword for corporate America. There's some salivation that's being created because that's a lot of spending that could benefit companies. But on the other hand, the Biden administration is laying out a plan to pay for that. And that, of course, involves a hike in corporate taxes, which is not being well received. So I think what we're likely to see, hopefully, is a spending plan that has a lower tax rate attached to it in terms of a tax hike. So corporate America, I think, will probably jockey for about a 25% corporate tax rate, although what's being proposed now by the Biden administration is 28%. So meeting somewhere in the middle between where we are currently and where the administration wants to take us. I think ultimately that will be received positively by the stock market after we see some digestion.
Stephen, when we talk about, paying for this with a tax hike, the original tax cut was supposed to go to 28%. They went to 21% for the corporate tax. We've had Gary Cohn on this platform repeatedly saying, yeah, go to 28%. He was the architect of it. So why wouldn't it be well received, do you think?
Well, I think any tax increases is not going to be well received by business, but let's look at these tax increases on a much broader scale. It's more than just the top case. It's a minimum tax. It's a global tax to try to arrange things across all corporations across the world. So there'll be big agreements with other countries. So a lot of corporations that have paid lower taxes will pay larger taxes in the future. I think this is a real tilting point. 40 years ago, Ronald Reagan famously said, the government's the problem. And now we're coming back to the government as the solution. So I think for companies and investors, there will be much more focus on what's the government's doing and what is the tax policy than we've probably seen in most of the last 40 years.
We have some breaking news out. We need to get to Jared Blickery. Micron releasing its earnings. Jared, what do you have?
That's right. Stock's up about 3 to 4% in after-hours trading. Nice beats on both the top and bottom line. Second quarter adjusted EPS coming in at 98 cents. I don't know if this is an accurate estimate comparison, but it looks like the street had the estimate lowered at about 94 cents. Adjusted revenue for the second quarter coming in at $6.24 billion. That's just slightly higher than the estimate of $6.21 billion. Second quarter adjusted gross margin, 32.9%, beating the estimate of 32.4% by about 50 basis points. And some guidance, some positive guidance that they're raising, seeing third quarter revenue 6.9 to 7.3 billion. That is above the street's median estimate of 6.85 billion. Also seeing third quarter adjusted EPS $1.55 to $1.69. Estimate was for much lower, $1.34, and got a quote from the CEO, Sanjay Mehrotra. Micron's strong fiscal second quarter performance reflects rapidly improving market conditions and continued solid execution. Our technology leadership in both DRAM and NAND spaces places Micron in an excellent position to capitalize on the secular demand driven by AI and 5G. So again, stock up about 3% after hours trading. And we are looking at some nice beats on both the top and bottom lines, guys.
All right, thanks so much, Jared. Certainly a name to keep in mind as we turn our focus to tomorrow's opening bell. But Christina, bringing it back to today, a big headline that we got out on the COVID front was France shutting down here for 4 weeks in an effort to try to get COVID under control. I know you're closely paying attention to COVID-19 infections over in Europe. How big of a risk do you see this being to the market in the short term?
Well, certainly it is a cautionary tale of what could happen in the United States. But it doesn't appear that we are on that course right now. So I don't think it's going to have a very significant impact on the U.S. stock market as of now. Of course, if the numbers change, if we start seeing a significant increase in COVID-19 infections, we've seen a small increase over the last week, but if we see a significant increase, if we move in the direction or get closer to where Europe is, then that's going to be problematic. But I think we're quite far away from that now. And in fact, what we're seeing from Israel is very, very positive, and I think creates a lot of optimism in the U.S. just because we've done a very good job with vaccinations. Israel is the gold standard, and we're seeing how they're benefiting now in terms of their economy and pretty low infection rate. So that could be our future as opposed to Europe.
Stephen, you actually see opportunity in Europe despite what's happening with their inability to clamp down on the pandemic.
Yeah, we see opportunity, some opportunity in Europe as well as in Asia. One of the big changes that's going to happen in Europe is a very large green energy initiative that will really restructure Europe's economy. And if we look at, again, the proposal today with Biden, and if we look at what China's doing in terms of its infrastructure plan, there's sort of a whole global plan to rebuild the economy, and Europe will benefit from that as well.
And sticking with overseas, Stephen, I know you're also finding some opportunity in emerging markets. When you're identifying those specific investments, what are you looking for?
We're looking for economies that either have their own growth or are going to leverage the United States growth. If we look at the growth in market capitalization over the last few years, the United States has vastly outperformed other countries in general, and we don't think that can happen forever. So we think that there's opportunities overseas, sort of a rebalancing, not unlike what we've seen this year between growth and value. And one of the places we see those opportunities are in Japan, but we also see that in emerging markets that are going to do well off of the growth of the United States economy.
Sorry about that. I was trying to keep the siren from interfering. Christina, you've pointed out that Fed speak related sell-offs can be opportunities as well for those who might want to look, at acquiring, whether it be fixed income or equities. When do you think we might get another Fed speak sell-off?
Oh, there's a lot of Fed speak going on. So there are so many different opportunities. And it's not just specifically Fed speak. On days when we typically see the 10-year yield go up, those are days when we often see technology negatively impacted, the tech sector. So I think there are a lot of opportunities that will present themselves in coming months. And for those with a long time horizon, they could be very opportune.
All right, both of you, we appreciate your insight. Christina Hooper is Invesco Chief Global Market Strategist. Stephen Dover is the head of equities at Franklin Templeton. When we come back, we want to let you know that if I can scroll down fast enough to get to the T's, President Biden is set to unveil a $2 trillion infrastructure plan in the next half hour. We got Jessica Smith on deck with some details of what you need to listen to after this.
We are awaiting President Biden's remarks on infrastructure. That's expected to get underway any minute, so we'll take you to that as soon as it starts. But in the meantime, let's get to Jessica Smith for a preview of what we could expect to hear. Jess?
Hey, Shauna. Yeah, we are going to be listening to President Biden and see if he has any response to the criticism that we have seen about this plan throughout the day. We've heard from Republicans who say that they are opposed to the tax hikes included in the plan. And then in just the past few minutes, we've heard from the Congressional Progressive Caucus who say that this plan is not nearly enough. So going over some of the details of what this plan includes, it's a $2 trillion plan that is over the course of 8 years. And it does include tax hikes that the administration says will fund the plan in 15 years. It has $600 $100 billion for transportation infrastructure, so highways, roads, bridges, public transit, rail, a big investment in the electric vehicle space. It has more than $300 billion to fix and modernize water systems, the electric grid, expand broadband access. All of these things will have a focus on clean energy. It also has hundreds of billions of dollars for affordable housing, for workforce development, R&D to boost U.S. manufacturing and strengthen U.S. supply chains. And then, of course, the big question has been, how are you going to pay for it? President Biden wants to raise the corporate tax rate to 28%, up from 21%. He wants to increase the global minimum tax for U.S. multinational corporations to 21%. He's also calling for measures to prevent companies from using tax havens or shifting jobs offshore. He wants to end tax breaks for the fossil fuel industry and ramp up IRS enforcement of corporations. Now, we have heard from the U.S. Chamber of Commerce today. They said that the tax hikes are dangerously misguided. They went on to say that it will make the U.S. less competitive globally, the exact opposite of the goals of the infrastructure plan. So we'll be waiting to hear more from President Biden in the next few minutes. We'll be sure to keep you updated on what he has to say.
We will bring our audience there as soon as those comments get underway. Jess Smith, thanks so much. Well, speaking of President Biden, he, Vice President Harris, and Treasury Secretary Janet Yellen all speaking at the U.S. Hispanic Chamber of Commerce's summit over the past 2 days. And we want to welcome in Ramiro Cavazos. He is the CEO of the U.S. Hispanic Chamber of Commerce. And Mr. Cavazos, it's great to have you on the program. We're going to be hearing from President Biden in just a few minutes, like Jessica was just saying, on his plan for infrastructure and also the post-COVID-19 economy. What does the Hispanic business community want to hear from President Biden?
Well, we want to hear about President Biden and the new administration and investment in small businesses. There are 30 million small businesses in America, and the recovery from the recession 12 years ago was brought about by small businesses, many of them Hispanic-owned businesses who were not just growing their business, creating jobs, but also doing exports and imports. And related to this plan that you're speaking of, any investment in infrastructure or in our industries, we need to consider that there's a return on that investment, and we can't keep on going by increasing our debt without making wise investments that will have a positive multiplier effect.
It's good to have you here, Ramiro, and I am curious if the administration is anyway signaling attempts to make sure when this huge amount of money, whatever it is, because there's going to be some kind of infrastructure, is now going to be dispersed, that everybody gets a fair shake at winning the contracts. I mean, we've seen abuse where people of color and all kinds of people who are citizens and taxpayers don't get their fair share. Anything from the administration to make sure that doesn't happen this time?
Well, Adam, it's very clear to us that most of the contracts historically in this country have gone to the same businesses over and over again. We have shared with the Biden-Harris administration, to your question, that we need to spread the wealth, if you will. The majority of our taxpayers in this country are lower and middle income Americans. And when we pay our taxes, it's a better economic formula if the U.S. government, the largest buying service in the world, especially with Department of Defense, transportation, and other infrastructure projects, those dollars should go back to small, minority, and women-owned businesses, not just for the sake of efficiency, but greater value. But at the end of the day, a rising tide will lift all boats. And for us, we think that innovation and that entrepreneurship by small businesses, that for us to, if we will agree to additional taxes, anytime we know that money's coming back to us in a greater return on our investment. That has not been the case historically. To your question, Adam, we want to make sure every department head within the Biden-Harris administration, that Secretary of Commerce or Treasury or HUD, that they have some spend goals with small, minority, and women-owned businesses. After all, we are the majority of Americans who are paying their fair share of taxes.
Speaking of minority and women-owned businesses, Ramiro, do you think that we've seen the worst of it when it comes to COVID, or are a number of businesses, do you think, still going to potentially fail over the next several months if they don't get the help that they need?
I think we've seen the worst of it, to answer your question. However, we need to be vigilant and make sure that we have lost one of every four of our 5 million Latino-owned businesses. Many of them who did receive Paycheck Protection Program loans are needing a second round of PPP funds. They have also adjusted, and if they've closed their firm, they've started new firms. There's a whole new economy being built because of COVID. That's a good thing, and it's a bad thing. There's a lot of costs that are being incurred, new capital that's needed, creative innovation to deal with our digital and technology future as an economy. So I believe the worst is over. But again, we should not let our guard down. As Latino Americans, we have gone through many crises in the past: 9/11, of course, the Great Recession, of course, the OPEC in the early 70s. Not to mention Black Monday. So as the Latino small business community goes, so does the future of America's economy. And we believe that we need capital for small businesses, and they need be a part of any infrastructure plan and any part of COVID rebuilding plan. We're very impressed so far with the new administration and the investments it's making, but we need to make sure that we help our small businesses and our Latino-owned businesses that historically have built this country, but have been left out of these opportunities for contracts, for capital, and for connections.
Ramiro, if you know off the top of your head, let's put that into perspective, because when we say Latino or we say Hispanic, I mean, my stepdad is Cuban. So, I mean, this is a huge number of people in our country who have some kind of tie or heritage that is Hispanic. We're talking about trillions of dollars in business. What are the stats that you have?
Well, we have 61 million people in this country that self-identify as Latino. We know that Latinos, it's an ethnic group. We're not a race. We are Caucasian. We are Asian. We're Afro-Latino. We are from different religious backgrounds: Jewish, Protestant, Muslim, Christians. And we're also, of course, in all 50 states and of course, Puerto Rico and the DC communities. DC community. So I love to say being Hispanic is a state of mind. And anyone that wants to be Hispanic, because it's a cultural affinity and ethnicity, can embrace this movement, this growth, and the future of our nation, whether we're Cuban Americans or Mexican Americans. Many of us were here when this country was being built more than 300 years ago, or literally arrived last night, or our visa has expired. But that innovation by all immigrants historically have brought about the largest economy in the world. And for us to ignore 1 out of every 5 Americans for investment, for contracts, and for capital is a bad economic formula. So yes, your stepfather is Cuban American. You know the special breed that Latinos are. We are a working community. We have fought in every major American war since the American colonial period. So this is our country too, and America, and the American dream is the Latino dream.
Estoy de acuerdo, y la comida es el mejor. The food is absolutely the best, and I absolutely agree. Thank you so much.
Por supuesto, Adam.
Well, our thanks so much to Ramiro Cavazos. He's the CEO of the U.S. Hispanic Chamber of Commerce. Ramiro, thanks so much for taking the time to join us today. We're going to take a quick break, but on the other side, the big business of betting on global events. We talked to Versus Game CEO John Vitti when we come back.
Okay, put your money where your mouth is. You hear that a lot. But first, we're going to do news on the move. The brains behind the Watergate burglary and talk show host G. Gordon Liddy died yesterday. He was 90 years old. Liddy spent 4 years in prison for his role in the political crime that brought down President Richard Nixon. After leaving prison, Liddy said, quote, "I'd do it again for my president." Florida Congressman Matt Gaetz insists he did nothing wrong, but he did acknowledge the Justice Department is investigating him for sex trafficking charges on allegations Gaetz may have had sex with a Florida minor. Gaetz told Axios, quote, "The allegations of sexual misconduct against me are false. They are rooted in an extortion effort against my family for $25 million in exchange for making this case go away." The Supreme Court heard arguments this morning that could clear the way for college athletes to be paid for their labor. NCAA rules prohibit paying amateur athletes, although colleges and universities can pay for athletes' legitimate educational expenses, things like tuition, fees, room, board, books, as well as, quote, "modest awards for athletic or academic achievements." Now let's put your money where your mouth is. Betting on real-world events. There is an app out there that you're going to want to pay attention to, Versus Game. And to help us explain what they do and why they were just able to raise another $6 million, Sukhinder Singh Cassidy, the former president of StubHub and a founding venture partner at Archegos Capital, is here, as well as John Vitti, CEO Versus Game. So John, let me start with you first. Tell me what Versus Game is, because I'm somewhat of a Luddite.
No, of course, and it's a luxury to be here. Thank you for everyone's time. Before we do that, I just want to let everyone on this call and everyone in the world know that whenever you get from point A to point B, when you're driving around, it's because of Sukhinder. She started Google Maps. Just want to throw props out there to where it's. Let's get right to that. But yeah, Versus Game, it's a prediction game where you get paid if you're right. So knowledge should be rewarded. Right? We're all consuming so much content out there. Why not get rewarded for it? You might have thought Airbnb is a crazy idea, or Meg Thee Stallion's going to win the Grammys, or Jamie is going to do something in the stock market, right? So usually you don't get rewarded for that. Why not?
Sukhinder, what attracted you to Versus Game?
I just love the simplicity of this idea. A simple, easy app where you can bet on any question in sports, culture, media, entertainment. And when we think about what people want to do, I think that both the notion of gaming and betting, in having competitions for your knowledge, we see that everywhere. But I think John and his team have encapsulated it so simply inside the Versus Game app. And I just love that.
Sukhinder, let me first thank you for Google Maps, because I remember when that disaster known as Apple Map first launched, and I still won't use it. But in regards to the investments you've made, I'm going to go back 16 years. I remember when they first started talking about legalized national gaming. And it still hasn't happened at the federal level in the way that the industry wanted. But it seems as if it doesn't need to. Are there obstacles that would prohibit this app to grow? I mean, federal regulation, or is that now out of the way?
Well, I'm going to leave it to the expert, our CEO of Versus Game, to talk about these issues. What I can tell you is the idea of knowledge-based games, I think, is a very powerful one, and one that consumers want to do. And so I think being able to enable that in obviously a fair and open way is really critical. I think I'll let John speak to whether or not he sees any issues on the regulatory side.
Yeah, Sukhinder's right. I mean, we are pioneering this space. People have been doing it since day one. We can't help it. It's fun for us. So we went about it creating something that's fair and fun for the masses. We are classified as a skill-based game. So we don't need licenses. We don't need any of that where someone like a DraftKings might need that. We kind of fall under the regulations as skills, which just went public for like $11 billion. So congratulations to them. So yeah, we are really smooth sailing, just letting people do what they already do in a fair, fun way for everybody.
John, when you raised money during this round, it was an invite-only exclusive funding round, I believe. Why did you go this route? Why does that make sense?
It's funny. It's our whole app is a very inclusive experience. But this round, the people you want on your cap table, in your family, is very important to grow the team. The people are the biggest asset you have. It's the most valuable thing. And so we didn't let anybody in unless they were referred to by one of our other legendary investors, and that they can create a tremendous amount of value. So it's really important for us to get the right people around the table.
So John, I am curious, a $55 million valuation right now, at what point do you become the kind of app like FanDuel, where we all know exactly when someone says versus game, we know exactly what they're talking about?
I think that's on track to happen in the next 12 months. I think this is going to be a really big year for us. We are becoming more of a household name, or considered more deeper inside of the user's lifestyle. Users are spending around 9 to 11 minutes per session on our app, and they're playing multiple times a week. And now they're actually creating their own games and sharing it with their friends, and they're getting paid for that. Right, so it's not only just answering the questions and playing the game, but now it's a user-generated economy, user-generated, content. Right, so now they can go and create their own and share it with friends. So it's a matter of time where everything's on Versus. Whatever's happening in the universe will end up on Versus.
And John, I like this idea. Right now you have just over 7 million users, I believe, actively using your platform as of January. What do you hope that number looks like? And this kind of goes back to Adam's growth question, but a year from now, what do you want that number to look like? And then how do you plan to attract that broader audience besides just the word from mouth like you were talking about?
Yeah, I think, we're mostly interested in getting the right people and influencers, and that trickles down eventually to the general public, like people like me that have no friends in popularity, just getting out there, getting on the app. That's really the key. But the first step to that is partnering up with the right corporate partners and the right celebrities and influencers, and we're on our way there. And so we're really focused around getting the right hosts or creators on board. They're the ones that have all the following, that have the fresh ideas and content, and the referrals is just viral.
John Vitti, I got to interrupt you. I think the control room's trying to tell me, is President Biden speaking at this point? Okay. I apologize for interrupting you, but we've got to take a break because we do have the president coming up. So John Vitti, CEO Versus Game, thank you. Sukhinder Singh Cassidy, all the best to both of you. And we're going to keep an eye on that podium because we are waiting for President Biden to lay out the $2+ trillion infrastructure plan. We're going to take a quick break before he actually steps up to the podium. We'll be right back.
time. Thank you.
President Biden here making remarks on infrastructure. We want to get to him live right now.
Pennsylvania, Mr. President. My name is Mike Fiore, and I'm a senior line worker from Duquesne Light and a proud member of the International Brotherhood of Electrical Workers, Local 29, right here in Pittsburgh. From day one of this pandemic, me and my coworkers have been on the front lines. It's my job. There's no working from home. We've kept the lights on and the power running to communities throughout Western Pennsylvania. Every day I deal with our electrical grid, so I know how critical infrastructure is to our communities. That's why I'm so excited about Joe Biden's Build Back Better plan. Nearly everyone agrees that we need to modernize our roads, bridges, power grids, airports, and railroads. That we need to invest in new energy technologies and American-made manufacturing. But what President Biden is proposing isn't just an investment in infrastructure, it's an investment in good union jobs. It's an investment in good schools and strong communities. It is an investment in the future of so many forgotten paths in America. My brother teaches at Pine Richland High School in Gibsonia, just north of here, the same high school we both went to. The kind of investment Joe Biden is talking about would mean so much to his school and to his students, both now and in the years to come. For example, President Biden proposes a massive expansion of high-speed broadband, and that's critical to the health of so many small towns in this area. I've got 2 little kids at home myself, and I don't want to see them leave the area or even the state to find opportunities. The Build Back Better plan is directed at communities like mine. It's about opening up opportunities, revitalizing local businesses, and creating jobs. For decades, Pennsylvania was a global leader in manufacturing and good union jobs. It can be that way again, as President Biden has a solid plan to make that happen. I also don't want my kids growing up in a world where the threat of climate change hangs over their heads. That means investing in electrical vehicle charging infrastructures and all forms of clean power technology so we can slash carbon emissions and create tens of thousands of green energy jobs. Union jobs. And that's exactly what President Biden is proposing. Here's another reason I'm so excited about this. I'm 100% a union guy. It is in my blood. The union changed my life, and it gave me opportunities I could never have dreamed of. Being a line worker isn't always easy, but thanks to my union, I enjoy a great paycheck, strong health and retirement benefits, and a voice on the job. Here's who else is a union guy, Joe Biden. And he said again and again, unions built the middle class. That's why his plan supports collective bargaining rights. It supports a living wage and making sure the taxpayer money goes to supporting American-made manufacturing. The men and women of the IBEW are ready to get to work, rebuilding our infrastructure, retooling our plants, and revitalizing our communities and the middle class. We're ready to build America back better. So it is my pleasure and it is my honor to introduce the President of the United States, Joe Biden.
Thank you. Gov, Mike asked me, and say to Bobby, my good friend, he asked me back there, he said, do you ever get nervous? And he said, because I got up this morning, made breakfast for my kids, so I got to introduce the president. And what I say to you, Mike, you did a heck of a job, but I'd get nervous if I had to get up in the middle of the night, climb up a telephone pole, replace in the middle of a storm a connection that knocked out everybody's electricity, put a transformer in. That's what would make me nervous. So what you did was really good. I couldn't do what you do, pal. I couldn't do what you do. And I want to, and it's true, Mike, you're a union guy. Me too. I got in trouble, but I don't make any apologies for it. I'm a union guy. I support unions. Unions built the middle class. It's about time they start to get a piece of the action. To all my colleagues, from the county executive to the mayor, to everyone that's here, I want to say Thank you, Congressman, for the passport in your district, and I appreciate being here. I'm honored to be with you. 2 years ago, I began my campaign here in Pittsburgh, saying I was running to rebuild the backbone of America. And today, I return as your president to lay out the vision of how I believe we do that, rebuild the backbone of America. It's a vision not seen through the eyes of Wall Street or Washington, but through the eyes of hardworking people, like the people I grew up with, people like Mike and his union family, union workers in this Carpenters Training Center, people like the folks I grew up with in Scranton and Claymont, Delaware, people who get up every day, work hard, raise their family, pay their taxes, serve their country, and volunteer for their communities, and just looking for a little bit of breathing room, just a little bit of light. Ordinary Americans doing extraordinary things. People who break their necks every day for their families and the country they love. A country that, in fact, which on the day I was elected was in extreme distress, with the virus on a deadly rampage that has now killed over 500, I carry it in my pocket every day. I have the list of exactly how many have died. 547,296 Americans dead from the virus. More than all the people killed in World War I, World War II, the Vietnam War, 9/11. 547,296 Americans, and an economy that left millions out of work and created so much anxiety. That's why I moved so quickly to pass the American Rescue Plan with the help of my friends here in the Congress. I really mean that. It didn't pass by a whole lot, but with the leadership of Connor and Bobby and the Mayor, you got it done because it was an emergency. We needed to act to save jobs, to save businesses, to save lives. And that's what we did. We're beginning to see the results. We're on our way to having given 200 million vaccination shots in the first 100 days of my presidency. When I said I'd get 100 million done, people thought it was a significant exaggeration. We're going to get 200 million done, twice the original goal, because of all the help of all of you. Leading economists are now predicting our economy will grow 6% this year. That's a rate we haven't seen in years and years. We can cut child poverty in half this year. With the American Rescue Plan, we're meeting immediate emergencies. Now it's time to rebuild. Even before the crisis we're now facing, those at the very top in America were doing very well, which is fine. They were doing great. But everyone else was falling behind. The pandemic only made the division so much worse and more obvious. Millions of Americans lost their jobs last year, while the wealthiest 1% of Americans saw their net worth increase by $4 trillion. Just goes to show you how distorted and unfair our economy has become. It wasn't always this way. Well, it's time to change that. I note parenthetically that I got criticized for giving tax breaks to middle class and poor folks this last time. I didn't hear that cry, you and cry, when we were doing the same thing. When Trump's tax bill passed, 83% of the money went to the top 1%. You know, this is not to target those who've made it, not to seek retribution. This is about opening opportunities for everybody else. And here's the truth. We all will do better when we all do well. It's time to build our economy from the bottom up and from the middle out, not the top down. That hadn't worked very well. For the economy overall, it hadn't worked. Because Wall Street didn't build this country. You, great middle class, built this country. And unions built the middle class. And it's time, and this time, when we rebuild the middle class, we're going to bring everybody along. Regardless of your background, your color, your religion, no matter, everybody gets to come along. So today, I'm proposing a plan for the nation that rewards work, not just rewards wealth. It builds a fair economy that gives everybody a chance to succeed. And it's going to create the strongest, most resilient, innovative economy in the world. It's not a plan that tinkers around the edges. It's a once-in-a-generation investment in America, unlike anything we've seen or done since we built the interstate highway system and the space race decades ago. In fact, it's the largest American jobs investment since World War II. It will create millions of jobs, good-paying jobs. It will grow the economy, make us more competitive around the world, promote our national security interests, and put us in a position to win the global competition with China in the upcoming years. It's big, yes. It's bold, yes. And we can get it done. It has two parts: the American Jobs Plan and the American Families Plan. Both are essential to our economic future. In a few weeks, I'll talk about the Americans' Family Plan, but today, I want to talk about the Americans' Jobs Plan. I'll begin with the heart of the plan. It modernizes transportation infrastructure, our roads, our bridges, our airports. I just left your airport. The director of the airport said we're about to renovate the airport. Is that right, Mr. County Executive? We're going to innovate. We're going to employ thousands of people. And she looked at me and said, I can't thank you enough for this plan. It grows the economy in key ways. It puts people to work to repair and upgrade that we badly need. It makes it easier and more efficient to move goods, to get to work, and to make us more competitive around the world. Some of you local officials know when someone wants to come in the area and a company wants to invest, what do they ask? Where's the first rail bed? How can I get to the railroad? What access to the interstate do I have? What's the water like? Tell me about it. It goes on and on. It's about infrastructure. The American Jobs Plan will modernize 20,000 miles of highways, roads, and main streets that are in difficult shape right now. It'll fix the nation's 10 most economically significant bridges in America that require replacement. Remember that bridge that went down? We got 10 most economically significant bridges with more commerce going across it that need to be replaced. We'll also repair 10,000 bridges, desperately needed upgrades to unclog traffic, keep people safe, and connect our cities, towns, and tribes across the country. The American Jobs Plan will build new rail corridors and transit lines, easing congestion, cutting pollution, slashing commute times, and opening up investment in communities that become connected to the cities and cities to the outskirts, where a lot of jobs are these days. It'll reduce the bottlenecks of commerce at our ports and our airports. The American Jobs Plan will lead to a transformational progress in our effort to tackle climate change with American jobs and American ingenuity, protect our community from billions of dollars of damage from historic superstorms, floods, wildfires, droughts, year after year, by making our infrastructure more secure and resilient and seizing incredible opportunities for American workers and American farmers in a clean energy future. Skilled workers, like one we just heard from, building a nationwide network of 500,000 charging stations, creating good-paying jobs by leading the world in the manufacturing and export of clean electric cars and trucks. We're going to provide tax incentives and point-of-sale rebates to help all American families afford clean vehicles of the future. The federal government owns an enormous fleet of vehicles, which are going to be transitioned to clean electric vehicles and hydrogen vehicles right here in the United States of America, by American workers, with American products. When we make all of these investments, we're going to make sure, as the executive order I signed early on, that we buy American. That means investing in American-based companies and American workers. Not a contract will go out that I control that will not go to a company that is an American company with American products all the way down the line and American workers. And we'll buy the goods we need from all of America, communities that have historically been left out of these investments. Black, Latino, Asian American, Native Americans, rural, small businesses, entrepreneurs across the country. Look, today, up to 10 million homes in America and more than 400,000 schools and child care centers have pipes where they get their water from, pipes that are lead-based pipes, including pipes for drinking water. According to scientists, there is simply no safe exposure to lead for a child. Lead can slow development and hearing problems. American Jobs Plan will put plumbers and pipe fitters to work, replacing 100% of the nation's lead pipes and service lines. So every American, every child can turn on a faucet of our fountain and drink clean water. With each $5,000 investment, replacing a line that can mean up to $22,000 in health care costs saved. Chance to protect our children, help them learn and thrive. We can't delay. We can't delay another minute. It's long past due. You know, in America, where the early interest was in internet, this thing called the internet that we invested, we invented the early internet. It was invented here. Millions of Americans, though, lack access to reliable high-speed internet, including more than 35% of rural America. It's a disparity even more pronounced during this pandemic. American Jobs will make sure every single American has access to high-quality, affordable, high-speed internet for businesses, for schools. And when I say affordable, I mean it. Americans pay too much for internet service. We're going to drive down the price for families who have service now and make it easier for families who don't have affordable service to be able to get it now. As we saw in Texas and elsewhere, our electrical power and power grids are vulnerable to storms, catastrophic failures, and security lapses, with tragic results. My American Jobs Plan will put hundreds of thousands of people to work, line workers, electricians, and laborers, laying thousands of miles of transmission line, building a modern, resilient, and fully clean grid, and capping hundreds of thousands of literally orphan oil and gas wells that need to be cleaned up because they're abandoned, paying the same exact rate that a union man or woman would get having dug that well in the first place. We'll build, upgrade, and weatherize affordable, energy-efficient housing, commercial buildings for millions of Americans. Even before the pandemic, millions of working families faced enormous financial and personal strain trying to raise their kids and care for their parents at the same time, the so-called sandwich generation, or family members with disability. You got a child at home, you can't stay home from work to take care of that child. unless you lose, the child's at risk, or you lose your job, or you have an elderly parent you're taking care of. And seniors and people with disabilities living independently feel that strain as well, but we know if they can remain independently living, they live longer. American Jobs Plan is going to help in big ways. It's going to extend access to quality, affordable home community-based care. Think of expanded vital services like programs for seniors. Or think of home care workers going into homes of seniors and people with disabilities, cooking meals, helping them get around their homes, and helping them be able to live more independently. For too long, caregivers who are disproportionately women and women of color and immigrants. This plan, along with the American Families Plan, changes that with better wages, benefits, and opportunities for millions of people who will be able to get to work in an economy that works for them. You know, decades ago, the United States government used to spend 2% of its GDP, its gross domestic product, on research and development. Today, we spend less than 1%. I think it's 0.7%. Here's why that matters. We're one of only a few major economies in the world whose public investment in research and development as a share of GDP has declined constantly over the last 25 years. And we've fallen back. The rest of the world is closing in and closing in fast. We can't allow this to continue. American Jobs Plan is the biggest increase in our federal non-defense research and development spending on record. It's going to boost America's innovative edge in markets where global leadership is up for grabs. Markets like battery technology, biotechnology, computer chips, clean energy, the competition with China in particular. Critics say we shouldn't spend this money. They ask, what do we get out of it? Well, they said the same thing when we first flew into space for the first time. They said the same thing. Well, pushing the frontiers led to big benefits back home. When NASA created Apollo's digital flight control system, unheard of at the time, it led to technologies that help us today to drive our cars and fly our planes. When NASA invented ways to keep food safe for the astronauts, it led to programs that have been used for decades to keep food safe in supermarkets. At least 2,000 products and services have been developed and commercialized as a result of American space exploration. GPS has helped us find each other. Computer chips allow us to see and talk to one another, even separated by mountains and oceans, singing happy birthday and watching the first steps of that new baby grandchild, comforting each other when comfort is needed. Think about what it means to you and your loved ones. We just have to imagine again. I had a long discussion with Xi Jinping, leader of China, and he called to congratulate me. We spent 2 hours on the phone. And he said, and I was astonished, my national security team and the China experts who were on the line, he said, you've always said, Mr. President, that you can define America in one word, possibilities. That's who we are. In America, anything's possible. Like what we did with vaccines a decade ago that laid the foundation for COVID-19 vaccines we have today. Like we did when the interstate highway system that transformed the way we traveled, lived, worked, and developed. Americans could visit relatives anywhere in the country with just a family station wagon. Business here in Pittsburgh could load up a truck and get a product to Portland or Phoenix. To this day, about a quarter of all the miles Americans drive each year on one of those very original highways. Imagine what we can do, what's within our reach when we modernize those highways. You and your family could travel coast to coast without a